A very good morning to one and all, and welcome to Investment Outlook 2014. We request everyone to settle down. We shall start the program in the next 5 minutes. May I request all the guests to please rise for the national anthem.
जनगण अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंधु गुजरात मराठा द्राविड़ उत्कल गंगा विंध्य हिमाचल यमुना गंगा उत्कल जलधि तरंगा तब शुभ नामे जागे तब शुभ आशीष मांगे गाहे तब जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
I now request our chief guest, Mr. UK Sinha, SEBI, Chairman SEBI, Mr. Shailesh Vaidya, President IMC, Mr. Prabodh Thakkar, Vice President IMC, Mr. Ashish Chauhan, CEO BSC, Mrs. Deena Mehta, Chairman Capital Market Committee, Mr. Ashokan, Co-Chairman IMC, Mr. S.K. Roy, Chairman LIC, and Mr. Atul Mehta, ICS of India, to please come for the lighting of the lamp. I request all the dignitaries to please take up seats on the dais. Before we begin with the event, please put your mobile phone on silent mode, and for security reasons, please wear all your badges. Mr. Shailesh, which is 124 years old law firm in India. Mr. Vaidya is currently the president of the Indian Merchants Chamber. He has been the member of the managing committee of the IMC since the past 8 years. I now request Mr. Shailesh Vaidya, President IMC, to deliver the welcome address.
A very good morning to all of you. Mr. UK Sinha, Chairman SEBI, Mr. S.K. Roy, Chairman, Life Insurance Corporation of India, Mr. Ashish Kumar Chauhan, MD and CEO of Bombay Stock Exchange, Mr. Prabodh Thakkar, President-elect, IMC, Mrs. Deena Mehta, Chairperson, Capital Market Committee, IMC, distinguished guests in the audience, dignitaries, speakers, ladies and gentlemen. It is my pleasure to extend to all of you a very warm and hearty welcome for the Investment Outlook 2014 organized by the Indian Merchant Chambers Capital Markets Committee. At the outset, I extend a special welcome with gratitude to Mr. U.K. Sinha, Chairman, Securities Exchange Board of India, and Mr. S.K. Roy, Chairman, Life Insurance Corporation of India, who have spared their valuable time to be here with us today and grace this occasion. I must also welcome and thank all the other eminent speakers of all the sessions throughout the day who have kindly consented to be with us here today. A special word of thanks is also due to our co-organizers, the Institute of Company Secretaries of India and the Bombay Stock Exchange, who have supported us in this endeavor. There is no doubt that this is an excellent opportunity to learn, share, and pool our intellectual resources for the mutual benefit as well as for the investment community at large. The Indian financial system is rich in its innate potential, and the need of the hour is some out-of-the-box thinking to help unleash this. To introduce our chief guest briefly, Mr. U.K. Sinha, as we all know, is currently the chairman of SEBI. He is a member of the Indian Administrative Services belonging to the Bihar cadre. He has earlier served as Joint Secretary in charge of capital markets. He has been a part of various committees formed by SEBI and the Finance Ministry for capital market regulations and brings to the table a unique combination of knowledge and experience. Our guest of honor, Mr. S.K. Roy, currently Chairman of LIC, served as a Managing Director of LIC since June 2013. He is a guest faculty at the Management Development Center of LIC at Mumbai and the National Insurance Academy, Pune. He has undergone training programs at the Indian School of Business, Hyderabad, and the Asian Institute of Management, Manila. He holds a postgraduate degree from Delhi University and a PhD from the University of Warwick. We are honored to have both Mr. Sinha and Mr. Roy with us today. Ladies and gentlemen, please join your hands together to welcome our honored dignitaries. I would now briefly apprise you all about the Indian Merchant Chamber. Established in 1907 and headquartered in Mumbai, the Indian Merchant Chamber is an apex chamber of commerce, trade and industry in the western region with a membership base of over 3,200 members and 220 trade associations affiliated to it. Together, we represent and advocate the interest of over 3 lakh business and industry establishments from diverse sectors of the industry. We have over 35 industry-specific committees of experts through which we provide policy inputs and recommendations at various levels of government authorities. The theme of IMC this year, ladies and gentlemen, is sustainable development, which is committed to the overall growth and development of all sectors and all sections of society in our country. IMC programs this year have primarily revolved around this theme. We also continue to maintain a strong focus on key sectors like banking and financial services, environment, water resources, tourism, education, and also insurance. We regularly organize meetings with senior policy makers to express and drive home our views. As we all know, forecasting the future is difficult, especially in this period of protracted uncertainty. All over the world, investment cycles and business confidence continue to remain weak. Highly leveraged balance sheets continue to act as deterrents to the sustained revival of the investment cycle. In India, the looming elections are adding to the uncertainties of governance, regulation, and entire administrative framework in a manner which is not very conducive to market development in almost every major asset class. Nevertheless, we remain optimistic and believe that this is just a passing phase. Once the new government settles in, and hopefully with a clear majority, we will regain the lost sheen. We will then have a rapid development sphere helping address the fundamental socio-economic issue of inclusiveness and sustainability. That is because the underlying institutions necessary for market development are already well established in India. We can see our markets gradually bouncing back and guiding the economic transformation of the country. On the domestic front, there are several positives shaping up, including a narrowing current account deficit, healthy capital inflows reining in of the fiscal deficit, bottoming out of the GDP growth, a likely boost to investment post the general elections, and an easing of food inflation. All this will probably be a respite from the high interest rates in the economy and facilitate the much needed investment. This will then allow the development and expansion of market forces to play a positive role in promoting sustainable growth. Whatever the merits and demerits of our political system, years of experimentation have given policymakers a first-hand experience with the pros and cons of a market-based system. The consensus regarding economic reforms that has been developed so far, as well as the infrastructure building initiatives undertaken by the government, will help provide a positive environment to propel the future growth and sophistication of markets in our country. Post-election, we also expect some major structural changes that will increasingly transform the economy to one that is more market-based, investor-friendly, and avoids over-regulation. In this regard, we are already existing dynamic financial institutions have an important role to play. As our businesses begin to operate under more transparency, better legal protection, advanced technologies, global compatibilities, there is reason to believe that our financial markets will grow and continue to grow at rates well above the average. Once we are through with the elections, greater policy certainty is likely to drive the announcement of new ventures and a sustained revival in the investment cycle that would bring in the feel-good factor. In conclusion, I would like to congratulate and thank Mrs. Deena Mehta, Chairperson of our Capital Market Committee, as well as all those who have worked diligently and proactively behind the scenes for organizing this highly interesting and relevant conference so meticulously. This unstinting cooperation has ensured a maximum attendance today, and this ensures the success of this mega event of our chamber. I wish the seminar all success. Thank you all very much.
Thank you, sir, for your valuable insights and for highlighting the theme sustainable development. Mr. Ashish Chauhan is the MD and CEO of BSE Limited, Asia's first stock exchange. He serves on the board of ICCL, CDSL, BSE Institute Limited, BSFI Sector Skill Council, and Marketplace Technologies. He has 22 years of experience in financial markets and technology, and he holds a BTech in Mechanical Engineering from IIT Bombay and a PGDM from IIM Calcutta. I now request Mr. Ashish Chauhan, CEO BSE, to address us.
Shri UK Sinha, Chairman SEBI, Shri S.K. Roy, Chairman LIC, Shri Shailesh Vaidya, President IMC, Shri Prabodh Thakkar, Shri Atul Bhai, Shri Ashokan, Shri Ms. Deena Mehta, friends, ladies and gentlemen, I would like to congratulate all of you to this, congratulate and thank IMC for arranging this conference. This hall used to be the trading floor of Bombay Stock Exchange, and now we have converted into a convention hall. It's an interesting journey of BSE for last 140 years. Today, BSE has first time reached a market capital. In fact, India has reached the first time the market capitalization of 75 lakh crore. BSE has been a catalyst in creating this wealth. There are two types of agencies in the country which basically help create wealth. One is the banking, what we call intermediation part, and then there are institutions like exchanges which are disintermediation. In banking, it's done on principal basis. So you give money to the bank on a principal basis, and bank on lends to the industrialist or anyone who needs money. And if they fail, still the bank has to make it good. In between, there are a lot of NPAs, but you are not supposed to be worried about because the banks will make it good somehow. In the stock markets, the exchange doesn't create money, nor it holds money for you. It only helps the investor invest with the company. It's like a priest. Once you invest in the company, it is between husband and wife, between the investor and the company. And that's why there are no NPAs we have. Everything what you see on the screen is what we call mark to market on the real time. And that's where, when you compare Indian banking system of 80 lakh crore, total wealth, which is represented there, out of which around 28 lakh crore is in government bonds and other things. 52 lakh crore is with actually the rest of the economy. Compared to that, the stock exchanges are around 75 lakh crore now. And whatever we see on BSE is real-time mark-to-market, no NPAs, right? So I just wanted you to be aware that this is a different type of institution, different types of importance. When I came into this hall today, 3 questions people asked me, saying, what is happening to this building? Is this building going to be closed down or broken? Because we have been reading in newspapers and television that this building is being demolished. Let me assure you that this building is not being demolished. There are few floors where there were few partitions that have been demolished. However, as usual in healthy democracy, we need to have exaggeration in media, which is what keeps on happening. But since you are sitting here, I thought you also have a proof firsthand that this building exists. It's not been demolished. Second question which I was asked is that BSE has had a huge glitches, technical glitches, which is there in all newspapers even today morning. Let me assure you that BSE today morning started well, and the trading is going on. By the time I came here, BSE had received around 2 crore orders. BSE has changed its trading system from Monday onwards in equities market, that is 3 days back, and it is now able to handle 5 lakh orders in a second. 5 lakh orders in a second is unheard of in India. When IRCTC, that is the railway booking, when we do, if IRCTC does 5,20,000 bookings in one day, it's a major news in all newspapers. When BSE does 5 lakh orders in 1 second, it is not a news. But the technical glitches is a news. The way we look at it is we give you response time in 200 microseconds. 200 microseconds is not a human scale. In 1 second, there are 10 lakh microseconds. By the time you close your eyes and open, we give you response time 10,000 times faster than that. And that has actually been implemented this week onwards, Monday onwards. India has been now put on the best, on par with the best in the world. And I just wanted you to be aware that BSE is back. BSE is back with a bang. For 20 years, BSE was slow compared to any other exchange in the country. And in this business, the first bird gets the worm. People used to go to other exchanges because BSE was slow. In 94, when NSE came, this floor was still working. Response time was around 30 minutes for an investor, even the fastest investor sitting outside of BSE building. NSE had a response time of around 2 seconds. For last 4 years back, BSE had a response time of around 300 milliseconds. NSE had a response time of 10 milliseconds. A year back, BSE had a response time of 2 milliseconds. 10 milliseconds, and NSE had response time of 2 milliseconds. Every time NSE was ahead. This is the first time that now BSE is 10 times faster than NSE. 10 times. And in next 3 years, it will be 100 times faster. We'll give 20 microsecond response time to every investor, and we don't give any special consideration to any large or small investors. Everyone gets the same information, same time, and same way. We don't give differentiation in terms of treating large people better, and that is why BSE is still the largest retail organization there is in India, with 2.5 crore customers registered with Bombay Stock Exchange. It is important for me to have talked about this because this is the first conference I am speaking after we went live. And last 2 days I was actually trying to repair what was sort of going wrong. Today morning when we started from 9:15 pre-open to open, it has worked out really well. So and thank you very much for all the brokers who have supported us in this endeavor in changing BSE's technology. I hope LIC and many other institutions who have been using our services will get even better services going forward. Third question was, what is happening on your SME platform? Why SME is so important to you? SME is a very important activity for the for India as a whole. India needs to create 1.5 crore new jobs for next 20 years every year. So in next 20 years, we need to create 30 crore new jobs. And those jobs cannot be created by investing in gold, silver, real estate, and so on and so forth. They can be only created by putting money in banks, by putting money in mutual funds, by putting money in stocks directly, because the companies actually create jobs. Gold goes into the vault. It doesn't create jobs. India's first job for next 20 years, for whoever comes as a prime minister, is to create jobs. There is no other major activity that India needs to create. And for creating jobs, SMEs are the best vehicle. Per crore invested, the small and medium-sized companies create many more jobs than large companies. Large companies may set up 50,000 crore rupees plant with 2,000 employees. While as SMEs, even small SMEs are known to employ 2,000, 5,000, 10,000 people. And that is where the SMEs are extremely important to India. SEBI recognized this fact around 4 years back. They came out with the regulations. They told BSE.
So we felt that regulators need to be very much part of our seminar. So we always start with SEBI chairman to set the ball rolling, and thereafter the entire program is set up. To briefly talk about the Capital Market Committee of IMC, I am happy to say that thanks to all the committee members who are very active on the committee, we do lot of programs for two class of people. One is the investors and second is the market participants. For the investors, we had several programs since July, which is the year in which the IMC starts the work. We had a program on risk and returns in small cap and mid cap companies, how to invest in indices, how to invest in volatile markets. I think that was the first program in which Mr. Navneet Munot, who happens to be here, and he really predicted that the index would rise like this. So I am happy to say that we started the year on a very positive note, and today as we stand, we are at the highest index that the Indian capital markets have seen. Then we had investment in distressed assets, how to read ratings, how ratings are done, and which would really give guidance to the investors on how to go about what goes into rating. That was a very good program. We also had a program where we invited all the consulate generals of US, UK, Japan, and asked them what was their expectation, and really eye-opening suggestions came up, like putting a pipeline from Canada to India, because the demand for gas is going to go down in US, so all the surplus gas of Canada could flow all the way to India. And of course Germany talked about not having so many MBAs in India, but having more people who are skilled in various kinds of jobs, like assembling of a car, which is of course the forte of Germany. So they laid lot of emphasis on developing skill sets of Indians. We also had a program to impress upon the CFOs, making of a CFO, which was a program in which how important corporate governance and financial disclosures is for a company to follow, so that the investors who invest in the companies, they are actually able to get a good deal and there is full transparency in that investment. So it was a 2-day seminar. We also had a program on how to use proxy advisory services so that investors can vote wisely. So these were some of the programs which were there relating to investors, for those investors who are already invested in the market, and we gave them various options on investments. We also have an investor club, and I am happy to say that the members' age range from 16 years to 70 years. This is the wide range of members demographic which we have, and we talked about things like how to do financial planning, how to buy insurance, be it life, medical or general, how to read newspaper quotations, how to read balance sheets, and basic functioning of stock markets, mutual fund, ETFs and other things. So these were the programs that we had. We also made several representations to SEBI, sir, and I am happy to say that most of our representations during this year got accepted, because year before last we talked about REITs, which was the real estate fund, and SEBI chairman had said that we have considered and rejected the proposal. Then we talked about it the next year and he said, yes, we are open, please bring your suggestions. And now we are in the following year and REITs has already been implemented. So I think you should give a big hand to SEBI on this major development which has happened in the Indian markets. We gave representation on amendment to the stock option schemes, creeping acquisition limits for shareholders. We gave a representation on the holding de jure control under the SEBI guidelines. Then challenges and difficulties faced in complying with SEBI circular on scheme of arrangement under Companies Act. Then SEBI circular on scheme of arrangement same under Companies Act. Then presentation to SEBI committee on depositories. And last but not the least, we gave suggestions on how to increase the DMAT customer base to 5 crore. There is a lot of possibility in linking of the Aadhaar database, the bank's KYC and the KRA. If these three systems are linked, it is very much possible to very easily increase our depository DMAT holders. Though a lot of simplification has happened in case of KYC, but still there is a lot of people do feel it as a mental block to go about doing the paperwork for the depository services. So I think if any one KYC in banking industry or Aadhaar is there, if we can link it up, then it will be very easy to ramp up the number of DMAT account holders who are there in India. So these are some of the suggestions that we have given to SEBI, and I am happy to say that SEBI has been very, very open in accepting our suggestions. There are a lot of meetings with the market participants in which these suggestions are passed on, and we do manage to get a lot of things through to iron out the operational difficulties which are there in the markets. Talking about today's seminar, I am very happy to say that this seminar is, we have almost 35 speakers who are there in the seminar, and we are really thankful to all the speakers who very readily agreed. In fact, I am happy to say that Mr. Gary Anderson has come all the way from Dubai who is the CEO of DGCX to talk about the commodity markets in India. We are going to cover 5 asset classes which we thought were really very important. So these are the assets which are tracked by the retail as well as the institutional investors. We have equity, we have money markets, we have commodities, real estate, as well as currency markets. Lot of thanks to the currency exchanges which have been set up, lot of retail investors are now getting involved into currency markets, and there is lot of appreciation of the impact of currency markets and money markets on the equity markets. I don't think 5 years ago or 10 years ago when the RBI policy announcement used to happen, there used to be so much talk about, a 25 basis point interest rate here and there, and the index moving up by 200, 300 points. So this is something which is thanks to the sensitivity which has been created by the media as well as by the exchanges which have come about, which is really having so much impact on the equity markets today. So the entire day we are going to spend, there will be 6 panelists in each of the panels, so they will all talk about what they feel is going to be the major trends. Of course, their organizations may not permit them to say that gold will be A price, or the agri commodity could be B price, but at the same time they would talk about the factors which is affecting all these markets and what are the major trends that we are going to see in the markets. So that, ladies and gentlemen, is about today's seminar. We are going to be very strict about the timings, so I request all of you to finish your tea, lunch, etc. all on time. And I would take this program further by a new initiative that Indian Merchants Chamber has taken, and that is to honor long-term investors into this market. And we felt that with algo trading coming in, the vision of the investor has really become very, very short, and people want to just turn in 5 minutes, 10 minutes, 1 day, 2 day, and the whole concept of long-term investments is going away from the market. Warren Buffett has rightly said that it is not the timing that you enter the market, but the amount of time that you spend in the market, that is really what would decide on what is the kind of returns that you will get in the markets. So we take this opportunity to honor LIC of India, which we feel is the biggest investor, and being the biggest, it has really been an organization which has followed a very long-term policy in investing in India. I would like to read out the certificate, which I would request Mr. Shailesh Vaidya, President of IMC, as well as Mr. UK Sinha to hand it over to Mr. SK Roy. Certificate, please. This is a certificate of honor which is given by the Indian Merchants Chamber to life insurance. Life Insurance Corporation has contributed immensely to the development of capital markets in India. We would like to take this opportunity to acknowledge and honor LIC for their pioneering efforts in providing the backbone to the entire financial markets. The long-term vision of LIC's investment team has given depth to the markets. LIC has not only provided security to policyholders but also good returns on their investments. Accepted by Shri S.K. Roy, Chairman, Life Insurance Corporation.
Shri UK Sinha sir, Mr. Shailesh Vaidya, Mr. Chauhan, Mrs. Mehta, other dignitaries on the dais, and ladies and gentlemen, it's my great privilege to receive this felicitation on behalf of LIC of India. As Mrs. Mehta has just now mentioned, that LIC is possibly the longest tenure investor in the market. There are 3 things which I suppose make this happen. The first is that we are the largest life insurance company in the world in terms of customers served. So that gives us the scale of operations, the monies which are our investable surpluses which are invested in the equity markets. So this is a great privilege for LIC that we have this privilege of being the largest life insurance company in the world. The second important thing is that we are trustees of the monies of the policyholders, as just now the certificate read out by Mrs. Mehta mentioned. When we are trustees of policyholders' money, and I can say in addition to this also the other stakeholders' monies, then it gives upon us an additional responsibility of managing those funds with great deal of prudence, and sometimes this prudence borders on conservatism. That is one thing we often hear, that LIC is very conservative. I want to mention that this is because of the burden of expectations that approximately 30 crore individuals in this country and the large corporate world which trusts LIC with their monies. The third thing that I feel, I should mention here is that we are being honored and felicitated for being long-term investors. This is also on account of the nature of work that we do. A life insurance contract is typically a long-term contract, and therefore the investments of the corporation have to match with the tenure of the contract that we have with our policyholders. So these are three broad factors which prompt us to work in the manner we do. It's always our efforts to ensure that we return to our policyholders and stakeholders a good return on what monies they have given us to manage on their behalf. Last 57.5 years have been a very exciting journey. I'm sure the next 58 years and thereafter will be equally challenging and interesting. I thank IMC on behalf of the entire team of LIC of India for this great honor. Thank you very much.
It gives me great pleasure to introduce Shri UK Sinha. I think I am one of the few persons in this hall who has had the distinction of interacting with all the SEBI chairmen after SEBI was formed and even before SEBI was formed. So I have been very fortunate in this regard, and the entire evolution of SEBI which has happened over these years is I think unparalleled in the world. The number of years which SEC took to get its act together, and if we compare it with how fast SEBI really became a force to reckon with, and especially the change that we have seen in the broking community, especially from an extreme no compliance kind of a scenario to a huge compliance kind of scenario. I think it's all thanks to SEBI, and there have been huge benefits because of good regulation which the entire community and the markets have followed. I think the biggest beneficiary is the FII investments which have come to this country is essentially because the good regulation that the market participants have followed over the years. And from a turnover like 600 crore a day during Harshad Mehta's time and 200 crore a day average turnover before in the 80s, we are today at 3 lakh plus crore turnover. I think this huge change which has happened is all thanks to the good regulatory environment which has been promoted especially by SEBI in India. Talking of Mr. UK Sinha, I think he is one of the rare persons who has been on all the chairs and on all sides of the table so far as regulation and market participation is concerned. As a person who was heading the capital markets in Ministry of Finance, then going into UTI, because I remember at the mutual fund seminars how Mr. Sinha would appeal to SEBI to really change their policies in order to have more changes in the mutual fund environment, and then again coming on the other side of table and influencing regulation. And another major change which I have at least seen in SEBI and which all of you would all have also seen, and that is earlier SEBI used to take a stand that this is my intermediary and I will not go beyond the regulations which I have. But the bold stand taken by Mr. Sinha in regulating the fixed deposits and other cheat fund and other companies and what scam happened in Kolkata, I think is a major shift which is there in SEBI in going beyond their mandate and trying to ensure that it is not just the capital market and the intermediaries which are controlled by SEBI, but if anything wrong happens in the entire system in relation to the savings of the investors, SEBI will not hesitate, it will step in and it will take responsibility and it will see to it that that the trust which is there of the investors in the market is restored, be it under SEBI regulation or not under SEBI regulation. So I think we really need to thank Mr. Sinha for giving this bold face to SEBI and moving towards a regulation not of just of security markets but financial markets totally. And I am sure with the new extension of another 3 years, we will see lot of changes which will at least eliminate totally the operational risks. I think we have come a long way in totally eliminating operational risks in investment in security markets, and hopefully moving forward, things like company managements and other things which are of course lot under control, but we would see better scenario in terms of insider trading and price manipulation and other things. So I would now request Mr. Sinha to kindly deliver us the inaugural talk. Thank you very much.
Mr. Shailesh Vaidya, Mr. S.K. Roy, Ashish Kumar Chauhan, Mrs. Deena Mehta, Mr. Prabodh Thakkar, Mr. Atul Mehta, Mr. Ashokan, ladies and gentlemen. IMC has, as its chairperson of the Capital Market Committee, a person who is not only very knowledgeable about the market and has long association, but also a person who has been championing the cause of the growth of the market, and she has been a person who has been meeting everybody who matters, whether it is the government or the regulator or the media, about what changes should be brought about in the market. She brings a huge amount of passion in the task that she has given to herself. So it is very difficult for me in particular to say no when she has been inviting me here, and I acknowledge that this is for the third time together in continuation that I am here. Now my difficulty is that if I am coming here year after year and this is the third year, then what should I be talking to you about? It's very difficult for me because I can't generate a new topic or a new subject or a new issue whenever I come. So many of you will perhaps find that what I am going to say is dull and boring. But what I thought I will be talking here today is about what SEBI has been doing in the last 3 years and what has been guiding SEBI on those lines, what has been our guiding principle. Let me begin with capital raising. We all know that primary market has been rather muted in India in the last 3 or even last 4 years. The statistics are known to you, but if you look at 10-11 onwards, every year the market has been rather muted from a volume of about 58,000 crores in the primary market in 10-11. We have been hovering in the range of 13 to 15,000 crores, and that also includes the rights issue. But more important, and this is something which I would hope that all of you will ponder, that in the last 3 years there have been huge amounts of DRHP filed with SEBI and they have been withdrawn. DRHP filed with SEBI where SEBI has given the approval, but the corporates have decided not to raise the money and they have allowed it to lapse. In last 3 years, that amount is close to around 60,000 crores. So in our country, and it has been going on for last 3 years, if corporates initially started by planning that they need to raise capital, they have given their fees to SEBI, they have incurred other expenses, and ultimately they decide to forego their fees and to allow the approval to lapse. It shows a very important dimension that the appetite for raising capital has dwindled. And while the role and function of SEBI is limited to what we can do in our arena, I think the larger question is what needs to be done so that the environment again comes up. I would like to assure all of you that so far as we are concerned, undeterred by these developments, we have had serious interactions with market players, with corporates, with professionals, and we have brought about a number of changes so that whenever the mood changes, whenever people want to raise money, they find that our system is helpful to them. We have, for example, decided that any retail investor who is applying in an IPO, he will be getting compulsory allotment, which was not there earlier. We have allowed, for example, that in more than 1,000 places, ASBA will be there. So applications which are supported by blocked amounts, that will be there. We have taken measures to enforce e-IPO, electronic IPO. And having said that, I would like to narrate that if there are any further demands, if there are any further suggestions which we can do for the growth of the IPO market, we are more than happy to listen to you. We will be very happy to consider that. So at the end of your deliberations today, at the end of the seminar, like last year, I am sure Mrs. Mehta will be giving us her comments and suggestions, and I would like to assure you that we will be getting into it. Ashish has told you about the work done by BSE in the area of SME platform. I would definitely like to compliment BSE for what they have done in this area, because from next to nowhere, creating companies with market cap of more than $1 billion, it's a huge achievement. Nobody could have imagined when 2 years back this whole idea came up and we came out with our detailed regulations that we can have a separate platform for SMEs. And let us not forget that this is not the first attempt. There have been several attempts. I remember one attempt when I was in the ministry and we had started it in BSE. But there were certain design problems. Maybe we were ahead of the time or something we did which was not correct. But to have a system which is in place where small and medium enterprises, their combined market cap of companies listed in BSE alone has crossed $1 billion is something, a matter of great satisfaction for all of us. And Ashish has told us that there are many other companies lining up. I would also like to say that the other initiative taken by SEBI with regard to an IPO without listing by having an institutional platform, that we have issued our guidelines in October 2013, and I'm happy that in 6 months, 3 companies have already got listed here, listed here on the Bombay Stock Exchange institutional trading platform. And the good thing about this initiative is that this allows, qualified institutional bidders, private equity, venture capitals to find a ready exit opportunity. So I am expecting that once this platform also succeeds, venture capitals and private equity will find it perhaps better to start getting their companies listed here so that they can find a very good price discovery and they will find liquidity. Friends, 2 of the previous speakers, Mrs. Mehta and Ashish, today have mentioned that at some stage of the development of certain products or certain initiatives, SEBI was acting as if it was spoiling the show. But today they are saying that in hindsight, it has come out that it was perhaps the right decision. So friends, our job is not to be spoiling the show. Our job is to ensure that the trust, LIC chairman rightly talked about the trust given by his policy holders to LIC. Our job is to ensure that the trust which people have in the market is strengthened further. I remember when we were talking about compulsory market making, there were huge pushbacks, and the demand was that this whole thing will fail. But today I am happy that the market has acknowledged that it is perhaps the right thing to do. Similarly, what Mrs. Mehta talked about SEBI's creation and the view or the reaction of the broking community and the situation now. So we all have to move forward in this direction. I would like to say that our job is also to ensure that we make the system more friendly to the investors. The ease and convenience which people have by trading in the market should be improved. Rightly, a point has been made about making the KYC more simple. I am happy to tell you that we are in constant dialogue with other regulators, and the end destination is that an investor in India or a person who is opening a bank account or a person who is going for an insurance product should not have to go through several KYC segments across markets. That dialogue is going on, but you must appreciate also that this is a very huge task. And no country has been able to do it successfully. No country. So please bear with us that it will take a little more time. But as a first step, after we started our KYC registration authority, KRAs, so now the next step is that if somebody is an investor in a mutual fund industry and somebody has also got a DP account, then we must be able to provide him a statement of account which will give him the complete picture of his mutual fund investment and also his holding in the securities directly. That is the project on which we are working very seriously. It will be wrong for me to give you any time frame, but hopefully it will happen very soon and definitely not beyond the end of this particular year. We have taken a number of measures for investor protection. It's not a forum to narrate all of that, but I would like to mention that in matters of investor protection, our approach has been to reach out to the investor at multiple places. So in last 2 years, we have opened 16 offices, and our offices have been empowered to deal with investor grievances and problems of the investors. On matters of arbitration, matters of grievance redressal, the arbitration mechanism in the stock exchanges, you will be noticing that in the last 2 years, last 3 years, we have made a lot of improvements and a lot of changes. I would like to talk to you a little bit about our regulations on foreign portfolio investors. In 93-94, when the foreign institutional investor regulations came up in India, this was an experiment and the economy had just opened up. But we felt that now the time has come that there is no need to restrict the non-residents to invest only through a FII account or a sub-account. And I happened to be chairing that committee on behalf of the government in 2010, which recommended that all non-residents should be able to invest in India. And the only requirement which my committee had recommended was that there should be a solid KYC. So I am happy that now SEBI has come out with the detailed guidelines that now FII regulations will migrate into FPI regulation. Forget the nomenclature. The whole idea is that any non-resident can now invest in the Indian market. He need not come. For example, he need not come to SEBI for registration. We have authorized depository participants of a certain standing to start registering them on our behalf. As you know, in equity market, there are no restrictions about how much money you can bring in and when you can take it out or when you can take out your profits. All those things have been done. I'm happy to acknowledge that the Central Board of Direct Taxes and the Ministry of Finance have also notified that the same tax treatment will be given to the FPIs which was available to the FIIs. And last week, Reserve Bank of India has come out with its guidelines aligning the KYC requirements of SEBI for all the FPI regulations. So all the FPI investors will have the same KYC requirement when it comes to a matter of opening a bank account by an FPI on the lines of SEBI's KYC. And the KYC requirement for the foreign portfolio investors have been simplified and it has been made risk-based. I'm sure many of you would be aware that earlier if somebody wanted to be a foreign portfolio investor in India, the KYC was so cumbersome that in certain cases the passport details of all the office bearers of that particular company were required. In certain cases one had to travel to the embassy to get a notarization done. All those things have been done away with. Now we have made it very, very simple, and the details are available for all of you, and it has been rightly acknowledged that the directions of the government and the directions of SEBI are in every manner to promote that investment. In order to generate trust, SEBI has also been focusing on the area of corporate governance. Again, one mention has been made by my earlier speaker. We have made several other improvements, and our corporate governance guidelines will become effective from 1st of October. You are also aware that what changes have been brought about by the Company Act. Without getting into details on how the remuneration will be fixed up or who is an independent director, one point I would like to highlight here is our focus and worry on matters of related party transactions. So if you look at our circular, if you look at our press note, that is one area where we are really trying to focus, that on matters of related party transactions there have to be very clear-cut procedure about approvals, and also we have gone into the system of approval from the minorities as well. In the currency market, and because of the 5 asset classes that have been talked, there has been a mention of the currency market also. I am happy that while the currency futures market are doing well in the country, last year and also in 2012, in consultation with Reserve Bank of India, we had to place certain restrictions because of the volatility in the rupee. I am happy, and I am sure many of you are aware that 3 days back we have come out with our new guidelines whereby we have restored, for example, the margin requirements. So margin requirements have been substantially reduced. We have also now come out that with a requirement, with an approval that the timings of the currency market can also be now enhanced from 5 p.m. to 7:30 p.m. So we are moving in a direction where the Indian currency derivative markets can help the corporates, for example, to hedge on a continuous basis. This is one small step in that direction. A mention has been made about REITs. Our board has taken the decision. However, the actual implementation will depend upon the tax treatment which is given to REITs. So we have represented to the government, and I am reasonably assured that whenever the next finance bill is presented in the parliament, this will perhaps find a mention. We have taken it up very strongly with the government, so that if the tax treatment is clarified, then the REITs can definitely progress. We are also coming out with some new guidelines on matters like crowdfunding, because we wanted to encourage young entrepreneurs, technology entrepreneurs to be able to. Our main effort is, number one, to help younger people, new entrepreneurs, to raise capital very smoothly, and at the other end our aim is to ensure that the investor is treated in a fair way. I will be looking forward to receiving the suggestions of this seminar, and Mrs. Mehta has given us good marks that whatever she had recommended earlier, SEBI has been able to implement a good percentage. Mrs. Mehta, I would like to assure you that this time we will try to improve even better than what we have done in the past. Thank you for inviting me.
Thank you, sir. I request Mr. Shailesh Vaidya to hand over a memento to our chief guest, Mr. U.K. Sinha. I request Mr. Prabodh Thakkar to hand over a memento to Mr. Ashish Kumar Chauhan and Mr. Atul Mehta. I now invite Mr. Atul Mehta, Council Member, ICSI, to present a vote of thanks.
Friends, it gives me immense pleasure to propose the vote of thanks at the first inaugural session of Investment Outlook 2014. And firstly, I express my sincere gratitude to Mr. UK Sinha for chairing the session at the inaugural session. And as Dinaben rightly said, for a good capital market, you need a good regulator. And of course, good regulator means you have so many regulations, either by way of rules or notification and circular. And let me assure you, sir, as an Institute of Company Secretaries of India, all our members are there to implement those the regulations and the act in a total spirit. Again, a special thanks to Mr. S.K. Roy, the Chairman LIC, to be part of this, and compliments for getting those guest of honor from the IMC. My also special thanks to Ashish Bhai Chauhan, CEO BSE, and very happy to note that we are the fastest exchange compared to the other exchange. Again, a thanks to Shailesh Bhai for organizing this wonderful events. Again, thanks to Dinaben for organizing this program, and of course Prabodh Bhai and Ashokan for this program, part of this programs. And also, would like to thanks the staff of Indian Merchant Chamber. A special thanks to Kinjal and her team, and also I would like to thanks the staff of Bombay Stock Exchange. With this, we are breaking for the tea. Thank you. Sorry, we are starting immediately the next session. Sorry, thank you. Oh, there is no tea break. Sorry.
I request the dignitaries on the dais to pose for a group photograph. We will now begin our session on commodity markets. I request Mr. G. Chandrasekhar, moderator of this session, to come on the dais. Mr. Chandrasekhar is the associate editor of the Hindu Business Line, Agriculture. Newspaper is a specialist in food, agribusiness and commodity markets. I would now like to invite our honorable panelists, Mr. Gary Anderson, CEO, DGCX, Ms. Kaveri Deshmukh, Senior Economics, NCDX, Mr. Ashutosh Deshpande, VP, SR Energy, and Mr. Hitesh Avachat, Group Head, Metals and Mining's Care Ratings. I request the audience to please settle down so we can start with the panel discussion. You don't have any label?
No, they have not asked.
I now hand over the floor to Mr. G. Chandrasekhar to moderate the seminar.
The mics are on.
Morning friends, it's such a delight to be here. Wonderful ambience, absolutely vibrant. I have always believed India's economic growth over the next 25 to 30 years is going to be driven by commodities, the commodity sector. Be it agriculture commodities, be it metals, be it energy products, these commodities are going to be an integral part of India's economic growth story. And obviously commodities have now emerged as a major asset class, and there is huge economic interest in the commodities market. This morning we are going to discuss investment outlook as far as commodities are concerned as an asset class. We have some very distinguished speakers who are experts in their own field. Without much ado, now I'm going to straight away invite my friend Gary Anderson, CEO of DGCX, to deliver the keynote speech, which will be followed by some expert presentations. First, it will be on the crude market by Asutosh from SR. It will be followed by Hitesh, who will speak on the base metals. Then comes my friend and former colleague Gargi. She'll speak on gold. And of course, Kaveri from NCDEX will speak on agriculture commodities. I'll try and round up the proceedings of this session at the end of this. Therefore, Gary, the floor is yours, the keynote speech. Thank you.
Thank you. When I had a call with Dina a couple of weeks ago, and we were going through, the content of the panel and what should be in it. And vaguely she said it's about commodities. You can, talk about anything, the structure, the regulatory regime, the prices, your outlook, and all those kind of things. Well, there's so much going on within commodities, as we know. There are many changes going on globally, not just in pure terms of supply and demand, but also in terms of the way the structure of these commodity markets are organized, which we are seeing a transfer from the investment banks to the commodities trades and houses themselves. And although we are seeing in this part of the world a huge investment into commodities, a statistic which perhaps contradicts that is that last year in 2013, over $50 billion were poured out of investment funds in commodities globally. One of those big funds is PIMCO, which is one of the largest bond funds in the world, and they have this commodity fund which had around $19 billion invested within it, and it lost 25%. And again, from an index perspective, commodities have been down this last couple of years. So in terms of the outlook, it's going to be very difficult to analyze. And for me personally, I'm going to give you an overview about how I see things, because as an exchange, I can't give you investment advice. We rely on the volatility and provide that platform for risk mitigation and also the transparency of the price itself. The other thing I will let you know about my history is that I'm not an economist either. So what I'm coming across with this morning is purely my observations of how commodities will look in 2014. But before I continue, I'd like to say thank you to the Indian Merchants Chambers for inviting me here this morning. It's a great pleasure to be a part of this conference and to be here in Mumbai at the BSE on the original trading floor, which is a place I feel very comfortable within.
When I started my career many, many years ago, it was basically London and New York. And I started off trading gas oil and coffee eventually. And so the focus was very much in London in the AM, and again waiting for the presence of the US to come in the afternoon. I really didn't think about Shanghai, Singapore, Tokyo, Hong Kong at all. These were just places that were far away that hopefully at some point in the future I would see. But if we fast forward 30 years, we now see that Asia has become a dominant force within the commodities marketplace. When I was researching for this particular panel, I came across a research note from ANZ, the Australian bank, which basically turned that this was the time for the Asian century. By 2050, Asia would account for more than 50% of the world's GDP. And in 2050, Asia's financial system will dwarf all others and probably will be 4 times that of the US and Europe combined. And these are just absolutely incredible statistics. And this is going to be driven largely by the Asian demand, especially from the biggest economies, India and China. And since the year 2000, commodity prices, as we all know, has been labelled as in this super cycle move, up until most recently. However, the global economic backdrop is changing as we speak. In 2013, the economy, or the outlook for the world economy, finally started to brighten. In the US, there was some signs of growth, and again, I think the latter part of 2013, we have seen that come to the fore, and there is non-farm payrolls appear to be growing, and so the economy there in the US is actually going into positive territory. The euro area is still what seems to be very stagnant and struggling to find any kind of inflation whatsoever. Some analysts even believe that the shift in commodity markets from developed countries to emerging markets is beginning to reverse because of these developments. China's economy, on the other hand, in 2013 slowed. And that has a big impact because I don't think the world has adjusted to the supply and demand, or certainly the demand from China itself. We have yet to adjust for what they can achieve. And as I said, their economy has slowed down in 2013. And even this morning, there were some import-export numbers that came out of China. Their exports were down 11%, and their imports again down 6%. So not a very good situation in China, despite them trying to basically add more money into the system itself. I think there are 4 key themes really for 2014 with regards to commodities, and which are important for this part of the world. Firstly, especially within the GCC, there's the possibility of reduced geopolitical risk following the Iran nuclear talks. The geopolitical situation in the Middle East remains high on the list of issues to keep an eye on in 2014. The outcome of negotiations between Iran and the West over the country's nuclear program will be paramount for a risk factor in Middle East oil. The progress in nuclear talks creates reason for optimism and reason to be bearish on oil prices in 2014. However, the unresolved conflicts that are going on there in the region mean that the situation could easily deteriorate and lead to rising volatility in oil prices. Secondly, there is a risk of glut in commodities, and oil being again one of those, and potentially grains. There are a number of factors that could lead the world economy to an oil glut later this year. As we know, in 2013, the US and shale oil, world oil production has grown on the back of this shale boom and has obviously flooded the market locally. Supplies increased last year despite the Chinese economy slowing, and significant supply disruptions in Libya itself. Iran, Iraq and Libya all had publicly announced plans to significantly increase their output. If other major OPEC countries start worrying about their competitive position, prices could drop further than we basically think. The risk for oil, for me personally, is clearly on the downside. Elsewhere, the agricultural markets are preparing to be inundated by grains, oilseeds, and output is expected to be in record highs in some regions. US corn production could actually register its largest increase in almost 20 years as commercial farmers from across the world benefit from more favourable weather conditions. Although demand from emerging markets remains robust, world demand is likely to be outpaced by the substantial increase in supplies, perhaps tilting the market balance upwards. My third observation is the global economic recovery should be good news for base metals. The US obviously leading that recovery and Europe slightly behind, but it's getting there eventually, which means there should be a pickup in the investment activity. And again, that really should in turn be positive for metals. As Europe is slowly getting back on its feet, as confidence returns, I think the outlook for the prices in commodities in general are going to look favourable. But again, as I said earlier on, with regards to China and its supply and demand factors, which we clearly do not understand or have yet to adjust to, anything is possible. My last theme really is that there are no real grand investment themes out there. You know, we are at the peak of a super cycle, it seems, and there is a massive surge in investor interest across commodities. But again, that kind of contradicts in some respects what the figures are coming out from the banks themselves. Investors are looking to diverse their portfolios very much more so. And again, I still genuinely believe that commodities will be a place where that can happen. In 2011 and 2012, interest was very much focused on precious metals, mainly gold due to its safe haven flows, because of the euro debt crisis and the fiat money, or the printing of money by the US in particular. Over 2013, we have seen this interest waned as well, and there's substantial outflows of money from commodity funds and ETFs in general, and again in the middle of last year. One of the defining factors for commodity prices has been its extreme volatility, and again over a 10-year period it's probably doubled. Over the past 14 years, the average annual volatility of resources have grown 3 times compared to the early 90s, and that came from a McKinsey report published at the end of last year. I think this volatility will continue to be there as we start to adjust to these dynamics from Asia in particular. I'm going to just briefly talk about DGCX, Dubai Gold and Commodity Exchange, and obviously how we are participating in that and how we are looking to take advantage of those changes in the commodity flows throughout the world. So as an exchange, we are trying to develop those products that enable the end users, the producers and everyone in the value chain to mitigate their risk, and also to have some kind of exposure, whether it be long or short, depending upon their views. And over the last few years, the Gulf region trade links with emerging Asian markets has grown incredibly, and at the expense of the US and Europe. India was the GCC's second largest export destination in 2012, followed by Korea and China. The Asian continent accounted for 57% of the GCC's total foreign trade. The Gulf region's exports into China rose by 9% in 2012. It was only 1% back in 1995, while exports to India rose 11% over the same period. Crude oil and gas dominate the GCC exports to developing Asian economies, accounting for nearly 80% of all what's traded. There are other vital commodities for us in the Middle East, and they are very interesting and again add to the trading dimension within Asia itself. Over the past few years, DGCX has listed gold, copper and plastics. Recently, some figures were issued for 2014 with regards to Dubai and the amount of imports and exports of gold in Dubai itself. By all accounts now, the volume of gold through Dubai is over 2,200 tons. And it makes Dubai one of the biggest gold hubs globally. And if those figures are correct, it's 40% of the world's gold now goes through Dubai. If you are a pessimist and just halve that figure and you think it's just 20%, well, actually that's still a very, very significant number. We have, again, substantial trading links, the UAE, with India itself, and again, gold is one of those commodities. The other contract that we listed most recently was plastics. Plastics, again, 50 metric tons of plastics are produced within the GCC. And that now accounts for around 20% of the world's plastics production, of which 50% of that goes exported into China. And so we launched this contract not just for the Middle East, but also for the rest of the world. It wasn't until recently the market participants did not have an opportunity to hedge their plastics risk, but now they do. Also, there's a huge trading copper that goes throughout the UAE in terms of production, and also into Asia as well. India is the UAE's largest export market for copper, and copper is also one of the UAE's chief exports into China. So copper's sensitivity to today's economic environment has made it highly price volatile. So what we've done is provide tools to manage that price volatility. These are just a few examples of how commodity trading links between the Gulf region and emerging Asia are growing. Going forward, I am broadly optimistic that the recovery in the Asian markets, combined with the continued growth in the Middle Eastern markets, will fuel the expansion of our commodities markets. Commodity trading links between our regions will be a key driver of the expansion in the scope and scale of our economic ties. As our market grows, we will see new synergies and complementaries between our commodity sectors. I look forward to a productive and enriching discussion in today's panel session. Thank you very much for your attention. Thank you.
Thank you, Gary, for this very interesting and insightful keynote presentation. You actually reminded me of a commentary I wrote some months ago. Things have changed. There are 5 global uncertainties that every commodity trader ought to know. What are these 5 global uncertainties? One is the uncertainty of global economic growth. Second is the uncertainty of geopolitics. Third is the uncertainty of monetary policy of different countries. Fourth is the uncertainty of currency market dynamics. And fifth is the uncertainty of weather. Now all these 5 uncertainties are going to play out. They have been playing out in the last 3 or 4 months that we know. These are going to affect commodities like crude, base metals, precious metals, and of course agriculture. And we now have experts from each one of these commodities to tell us how the future looks like and where actually to put your money. So I'm going to now invite Ashutosh Deshpande, Vice President, International Supply and Trading, Essar Energy, to speak on crude market outlook for 2014. Thank you. Ashutosh, 7 minutes? Is 7 minutes okay for you? All right, thank you.
Thanks, Gary, for such a wonderful start. You seem to have covered most of the crux of my presentation. So I can quickly run through my presentation. Anyway, dignitaries on the dais and ladies and gentlemen. Crude oil prices were exhibiting an extremely high volatility for a couple of years. And suddenly, in last 4-5 months, they are stuck in a range of around $4 to $5. What caused that volatility in the past and what's going forward for all those factors? As Chandra sir has just covered, there are 5 factors. I have just put maybe a little more detail related to oil market. The key factor is certainly going to be the growth, economic growth in global arena, where the overall economic growth is expected to be around 2.5–3%. It's not going to be even. Since last 4–5 years, emerging market had a wonderful run, and the OECD countries were struggling to catch with them. But looks like OECDs are stabilizing. In fact, US is way ahead on the curve, and there is risks and concerns regarding emerging markets and China. Chinese growth is certainly very important because in last 5 years, whatever oil growth we have seen, 60–70% was contributed by Chinese growth. So any slowdown, any risk to Chinese growth is going to impact oil demand certainly. Having said that, US is certainly helping a lot with its economic and oil demand growth. The second factor is certainly weather. Last December, everybody was thinking that there will be a lot of inventories which will build in supply chain in oil market, and suddenly there was an extremely cold weather in United States and things were completely different. Looking back in Q1, there was no inventory build across the world. In fact, there were counter-seasonal inventory draws which supported the prices in a big way. Going ahead, there are risks for El Nino. El Nino is a phenomena which will cause drought in areas like Australia, floods in China. It will have change in weather patterns. It's already seen Singapore has the driest February in almost 100 years. It certainly will have impact on hurricane in US, and these events will certainly change the dynamics on the oil risk and the oil demand. Regulation is certainly playing its own part. In US, there is something called renewable fuel standards, which makes mandatory for any refinery to blend ethanol or biofuels in the refinery petroleum or refinery gasoline. Now suddenly last year, they have changed the goalpost looking at the demand. The demand was going down consistently for 5 years, so they allowed refinery to blend less ethanol, and suddenly the oil prices started looking softer. Never know, with a strong demand growth, they can come back again. Another key regulation is ECA, which is called Emission Control Area. The US East Coast, Caribbean and North Atlantic seawater. Since from 1st January 2015, nobody can use high sulfur fuel oil on the ships. So when the ships are traveling or in this area, ECA area, they will need to either burn low sulfur fuel oil, or they will shift to gas oil, which is a significantly costlier fuel. Now this is going to impact very heavily on gas oil demand, maybe 200–300,000 barrels per day. The next is nuclear and coal. Japan has been one of the major factors which kept gas and coal prices at a high in last 2–3 years. It was consuming LNG at a very high pace because most of the nuclear reactors were down. But come second half, the first 2 reactors in Japan are expected to become online. Around 2 gigawatt, maybe in July, September, and 20 gigawatt by end of this year or mid-15. That will certainly put lot of pressure on the fuel oil demand. Simply look at economics. Fuel oil is roughly $15 MMBTU. Crude is around there. Gas, LNG is around $15–16 MMBTU, and coal is around $3 MMBTU. That's the economic difference of producing power from coal. So certainly there is going to be a lot of demand for coal. Once nuclear comes back, it will certainly put lot of demand, put lot of pressure on the demand for fuel oil. Refinery growth is certainly going to put lot of I would say influence on the demand growth, because most of the refineries that have been constructed in last 5 years in east of Suez, in India, China, Middle East, are very complex refineries which can process extremely dirty, heavy crude, sour crude to get value out of the refining assets. Same is true with US. They have strong assets and they have got cheap natural prices and cheap crude oil prices. So if you look at refining capacity, US refining capacity is back to 15–16 million barrels per day. The growth is almost phenomenal, 1–1.5 million barrels from last year. Asian refineries are certainly going to run because they are complex and they are situated at a right place where demand has been typically growing. But European refiners will face a lot of problem. That will have impact on the crude slate. Most of the sweet light which so far has been consuming in European refineries needs to find home in other countries, and that will put a lot of pressure on crude oil prices, especially the Brent price, which is supposedly the physical marker for entire oil complex. Touching on Indian demand traditionally has been very good. We are growing around 6-7% per year. Our demand is around 3.2 million barrels per day. But the growth seems to have hampered a lot this year. Our diesel demand has grown virtually at a 0% this year on year, which is an extremely concerning fact. Hope we get growth back on track and we get back into that 5%, 6% growth arena, where we will need a refinery every year of around 350 to 400,000 barrels. This is on the demand side. If you look at the supply side, so demand is growing, there is no question about it. On 91-92 million barrel per day global demand, we are growing at a decent 1.5%, which is 1.2-1.3 million barrel per day. So where is the problem? The problem is the supply is actually growing at a faster pace. If you look at the US has been adding crude oil almost 1 million barrel every year. In 2008-9, US was producing around 7-8 million barrels per day. Today they are producing 11 million barrels. Next year it's going to be 12 million barrels per day. What is the impact of it? If US produces more and doesn't export crude oil, which is banned in US, it certainly will put a lot of additional oil in global supply chains, and that will be from Europe, Middle East, and North Africa. On the biofuels we are doing extremely well for last 3-4 years, but this year they are expected to be at least remain, I would say, 0 or 1% growth. There are two factors. Around biofuels typically contribute 2.5% of global growth, around 2 million barrels per day. But this year, with the El Nino and the impact of El Nino on agri products, we are expecting that the biofuel growth is expected to be a lot lower than what it was in last 5 years. The key factor, OPEC spare capacity, which has been driving oil prices and supporting oil prices. With US pumping more and more oil, it has actually pushed a lot of OPEC spare capacity. Currently, OPEC spare capacity is around 4 to 5 million barrels per day. They have 35 million barrel capacity against a production of 30 million. So any increase in demand can be immediately made by increase in production. So what has supported prices for all these years? If you look last year, there have been outages virtually everywhere, in Middle East, in North America, taking around 3.5 million barrels per day. And then now something is developing on Ukraine and Venezuela. So something has been consistently developing on geopolitical side, which is very difficult to predict, very difficult to price in the current price, but it's happening consistently over last few years. Upstream capital investment was having around an increase of around 10-12% consistently since 2009, which has suddenly come down to 5% in 2013. Just $620 billion additional investment, which will impact maybe oil production somewhere around 16-17. And finally, the floor, obviously, does that mean that oil prices are going to crash? Not really. There will be a floor coming from the finding and development cost, which is roughly around $80 on a Brent and $70-75 on WTI. So that's kind of act will bottom for the oil prices. I think I'll quickly cover in 2 minutes the other factors. These are factors which are specific to oil prices, but they are not alone. Oil prices were getting impacted by a lot of external factors, be it dollar strength, because the instant dollar strengthens, oil prices comes down. Be it the central bank's monetary policies, Federal Reserve has increased its balance sheet for 0.8 to 4 trillion in a span of just 4 years, which it didn't do in 100 years, it did in span of 5 years. It provided a lot of liquidity to the market, which in fact had spilled to commodity markets. So if you look at commodity positions, speculator positions have gone to, which used to be like 200 million, are now 500, 600 million barrels. These all are at a risk. But having said that, if you look at the long-term price, which was a 3-year or a 5-year forward prices, they have never been above $85 or $90. So while if you look at a 20-year outlook, the commodity prices have to go up because the economic growth has to happen. The demand has to get created. Next year, I think is going to be a subdued year for oil. Thank you.
All right. Thank you, Ashutosh. Thank you for these very interesting comments, very interesting observations. I can't agree with you more. Absolutely, my own outlook is that OPEC supplies are expanding rapidly. There is a reduction in geopolitical risk premium simply because of Iran's interim agreement, and there's a huge overhang of speculative length, which obviously has a potential to exit, and therefore prices have the potential to decline. Maybe Brent by up to $10 a barrel. Let's hope it happens. Thank you very much. I'm now going to invite Hitesh Ahuja to speak. He's head of metals and mining from CARE Ratings. He's going to talk to us about the base metals market. I hope he'll cover major base metals: aluminium, copper, zinc, nickel, lead, tin, and give us outlook. Hitesh, can you?
Yeah, Mr. Chandra.
Yeah. About 7 or 8 minutes, is it possible?
Sure,
okay, all right.
Okay, we are in the commodity session like every other commodity guy. Even I started with metals, but before that I actually started with precious metals. And I actually stopped my mom from buying gold, saying that next 2 weeks the gold prices will fall. And if you look at that time, the prices went up for the next 5 trading sessions. So first session for me as far as commodity is concerned is never stop your mom from actually buying gold or silver, because that will actually bounce back on you. So getting back to the base metals, I will just focus on steel, aluminium, zinc and lead. First of all, I will start with steel. Basically, if you look at the title of the presentation, it is overcapacity. Until you reduce, you should manage it. What we are trying to see here is, if you look at all the base metals, may it be copper, may it be steel, may it be aluminium, what we are facing today is a huge glut of overcapacity across sectors, across base metals, and that is what is actually impacting the global prices, the global commodity markets, the global industry. So I just start with the steel outlook. What we have seen is, we are saying that the steel market has improved. There is an improvement in demand. China also, which was expected to slow down, actually the steel production in China in 2013 increased by 6%. That too on a base of around 700 million ton, which is huge by itself. If you look at advanced economies and even the US, what you see is actually an improvement in steel demand. But I would like to take your attention to the chart which I have kept. What is actually showing out is, even despite of an improvement in demand for the last 2 or 3 years, if you look at the steel consumption across countries, it is still not reached the levels of CY07, which means that the global commodities, the market is totally slacked with overcapacity. Undoubtedly, China has been the important factor. You take out any metal, it will be around 40% which is being consumed by China itself and produced by China also. So I have just tried to keep out 2 parameters which are actually showing the strength of the Chinese economy, wherein I have tried to show what is the China's value added in construction sector and what is the investment in fixed assets. If you look at both the charts, you can see that the growth is definitely falling. If you look at the GDP forecast, it is still at 7%, but it is much lower than what it was earlier at about 10 to 11%. What has caused all this is actually an increase in idle capacity of steel globally. If you look at the years CY07 and CY08, the steel capacity was actually, the idle steel capacity was actually at around 500 million ton, wherein we are consuming around 1500 million tons annually, which means that almost 35 to 40% of the capacity was staying idle. Even in our forecast, what CARE Ratings expect is the capacity, the idle capacity in the next 3 to 4 years will still continue to be above around 20 to 25%, which is quite high. That also supports that globally the steel prices are definitely going to see a downside. This also is supported with the declining iron ore and coking coal prices, and also with respect to the sluggish demand from the Chinese industry. Just a focus on the Indian steel industry. Well, India has added around 20-25 million tons in the last 2 to 4 years. As far as the steel capacity is concerned, what one needs to notice is there is equally 20 to 25 million tons of capacity which has been stuck due to various regulatory reasons. And despite that, India has actually shifted from a net importer of a steel to a net exporter of a steel. What I mean to say is, basically if you look at the commodities or the steel capacity, had it been earlier, the capacities like, let's say, the POSCOs or the ArcelorMittals, if they would have settled down, because POSCO has been trying for the last 8 years to come in India, if it would have actually created a much more capacity. And if the other infrastructure activities are not improving, that would have actually spoiled the Indian steel market. So maybe we can say that it is a blessing in disguise for the Indian steel industry that these plants have not come up, because otherwise this was an addition to the idle capacity. Going ahead to the non-ferrous metal, it is more about aluminium. What we are seeing in aluminium is the prices have drastically corrected. They are around $1650 per ton as far as the LME prices are concerned. Globally, we are seeing an oversupply in aluminium for the next 2 to 3 years. We are seeing that the demand is increasing by around 6 to 7%. But if you look at China and other countries, especially the Middle East, which is coming up hugely in aluminium, these countries are actually expanding their capacities in the similar pace as what the demand is growing. So the overall overhang of the supply would be much more than what the demand would be, and that would be impacting the prices. As far as aluminium is concerned, the average cost of production of aluminium globally would be around $1750 to $1850. If you look at China, it is around $1950 per ton. But still, Chinese players are able to sustain the prices at $1650 or $1750. That is mainly because of the stimulus which the Chinese government is giving with respect to the power consumption and the norms, various norms they are giving. Also, there is a kind of a structure which is called as the shadow banking, wherein most of the players, they are actually keeping inventory as a mortgage, and they are getting funds whatever they require. So it is really difficult for this idle capacity to get out of the market unless and until the liquidity position goes down. Same thing is about zinc. Zinc will also remain in the oversupply zone. What we are seeing is, but as far as zinc outlook is concerned, the oversupply of zinc would be declining in the next 2 years. If you look at lead, the inventory levels have drastically gone down. If you look at the global demand, this is the only one of the metals wherein actually you are seeing a deficit state in the next 2 or 3 years. So probably lead prices would get much more support as compared to other base metal prices when you're comparing it with copper or zinc or aluminium. Probably what we may see is lead prices getting support because of the increased demand. As far as the lead demand is concerned, it is also quite insulated because most of the demand comes from the replacement of these batteries, which is actually a stable demand. Just want to focus on what is the speculation which is happening in the non-ferrous metal industry, especially most of these commodities. What I have tried to do is I have just plotted the changes in the dollar index and the movement of different base metal prices. The black line actually indicates the changes in the dollar index. What we are trying to show here is based on the changes in the dollar index, which means that the fluctuation in the dollar against major currencies, the prices are getting impacted, but not to the extent what the actual fluctuation in prices is. It means over and above that is what is the speculative price which is actually driving the overall base metal prices. Also, I have tried to understand in the last decade what has happened to most of these base metal prices. If you look at the volatility in non-ferrous metal prices, the band has been declining. If you look at the band in CY06 or CY07, the band was much higher and the volatility was much more. But the band has started declining. Why is this band declining? It is mainly because of the actual supply which is coming out and which of the confidence that yes, this supply would be hitting the markets. What one needs to look at going ahead would be actually the changes in the monetary policy. There will be a divergence in the monetary policy in the next 2 years. Why I am saying that, maybe if you look at US and the UK, they would be thinking about tightening of the monetary policy, whereas the ECB and the Japanese monetary policy would continue to remain loose. That means that maybe the dollar and pound will be strengthening, and vis-a-vis the Japanese yen and the ECBs. So these diverging trends will actually impact the prices. This diverging trend will actually impact the prices. Our outlook on the prices would be that definitely the prices would be going down. Aluminium prices would be hovering around $1,850 per ton for CY14. Copper can be seen at around $6,500 per ton. Whereas if you look at lead and zinc prices would be hovering around $1,900 per ton. And lead prices would gain support and would be around $2,000 to $2,100 per ton. I thank you for the presentation. Thank you. Yeah.
Thank you, Hitesh, for sharing your thoughts on steel and some of the non-ferrous metals, base metals. I want to give my investment call on base metals. I'm absolutely bullish on nickel. There is a ban imposed by Indonesia on ore exports. Nickel prices have risen since the beginning of this year by 24%. The initial target for nickel prices this year was 15,000. Currently it's trading at 16,000. And I'm absolutely hopeful that by the end of this quarter it will breach 17,000. By the end of the year it could be $20,000 a ton on the LME. Nickel is going to be an outperformer, assuming that Indonesia's ban on ore continues to be in operation. The next outperformer could be zinc. Current prices, yesterday's closing on the LME was $2,000, or close to $2,000. My average price for 2014 is $2,100. 2015 zinc is going to be in deficit. It can go up to $2,400 a ton on the LME. Next is copper. Currently the sentiment is very weak, about $6,600 a ton. But remember, China has taken a decision to invest in grid. There's a planned investment in grid development, which is going to boost copper consumption. For copper has a potential to breach and go up to breach $7,000 a ton barrier. In what time frame it would happen, one can't say at this point of time. Once the Chinese grid investment starts to flow, I'm sure one can turn bullish on copper. But Hitesh, thank you very much for sharing your thoughts. I'm now going to invite Gargi. Gargi Shah is a lawyer by training. She worked as the India head of the most reputed consultancy company called GFMS, London headquartered company, and now she's on her own. She's going to talk to us about gold and silver prices. Investment Outlook 2014. Gargi.
Thank you very much, sir. Hitesh, it's funny that you mentioned that once you start analyzing metals, you are inherently going to suggest to your mom, please don't buy gold or silver for that matter. And in my case, I went a step ahead and I told my father-in-law also not to buy me gold, who's here with me. But in my case, it just got better. I got diamonds. So, well, that's the, it comes with the package. Once you start analyzing gold and you start to see the downside risks in the market, it is very difficult for you to put your money there. But in India, the case is very different. As you said, it's really dangerous to advise anyone to tell them that, gold prices will be falling. It's almost as though there is a dictum in the market that, gold prices can never fall. And if couple of years back, if I was standing at a podium trying to give an outlook that, in the future we are going to see gold prices declining, it was nothing less than waging a war against the country. And you would have people, screaming and shouting that gold prices can never fall. And how they would then give you examples of how your grandfather and grandmother and then your mother, and ever since then the gold prices have been rising. And certainly they did. For the last 12 years of the bull run, from 2000 to 2012, we had a phenomenal rally in the precious metals. We went from somewhere around $200 to its peak in $1,900, which is a 7-fold return on an asset. The reason for that was, as most of us know, what has driven gold prices is predominantly the investment demand. Investment demand not in countries like India, where we traditionally perceived gold as an asset. We buy gold jewelry thinking it's an investment. We buy bullion bars, we buy coins thinking it as an investment. But this investment came from the Western economies, where traditionally they do not consider gold as an investment. They are far ahead in their financial markets in terms of how they conceive investment in hard assets. But events that have occurred over the last decade, whether it be in the nature of financial crisis, economic crisis, sovereign debt crisis, all of which have supported and made a case for investment in gold. Unfortunately, or fortunately, it is the case that trees don't grow to the sky, and just as that, gold prices weren't to rise forever. And if one studied the supply-demand balance, this downside risk in the market was very apparent. The traditional area where gold is consumed, where gold is predominantly used, is in jewelry. Apart from jewelry, industrial use of gold is fractional, and that leaves a huge surplus in the market. After that came in investment demand, which drove the prices higher, very well supported by countries like India and China, both in jewelry as well as in investment. 2013, the scenario that existed for the last 12 years began to wane. All the factors that we saw were supporting gold in terms of all the crises, in terms of all the sentiment weakening towards the financial markets, the economies, trust within the financial institutions that had disappeared. All of this began to disappear, which weakened the case for investment globally. And that's when we saw that prices ended 2013 around $1,200, which was almost a 30% decline from the start of the year. This was a break in the record of the 12 consecutive years of growth that we saw. Coming to this year, what we've seen year to date, gold did start somewhere around $1,200, at the foot of $1,200, and it's been a peculiar year in that sense that what has really helped gold rise to its recent peak in mid-March of about 1380 was really the absence of the Indian market and the hope of the fact that, the restrictions that have been put on gold recently will be withdrawn sooner rather than later. Fortunately, it didn't happen for the country. We have a lot of issues on the current account deficit, and we still are under a very tight control on the import front. That has been one of the reasons why there was that rally, in the expectation that in case if these restrictions were lifted, we would have further demand coming out of India, which was until recently one of the largest consumers of gold. Obviously, the geopolitical tensions and uncertainties out of Ukraine have helped gold have this rally up to 1380 recently, which is about a 13% rally all in all this year. What is interesting is that this rally was actually driven by speculative investors, somewhat ETFs, but what we've seen lacking in the market and what we've seen in the past that has supported a rally is the physical investment. If you look at physical investment across Europe, US, in the other Asian countries, it has actually been very poor. India is certainly out of the picture. Indian demand has been very poor compared to what India used to be until the restrictions were put in place. China has just barely come out of discount. It has been in a discount, which means that the Chinese demand has been so weak that there is a surplus in the market that has created a discount in the market, and it has just moved to a bare premium just after it came out of the tomb sweeping holiday. So the point being that two major factors are absent in the market today. The investment world is looking away from precious metals. At the same time, you have the traditional countries, the two big countries that accounted for almost 50% of the global gold demand, India and China significantly being absent from the market. So what has, and we've already seen that the rally couldn't hold much beyond the 1350 mark. What we will see going forward for the rest of the year will be that as and when these crises wane, we do not expect that the Ukrainian crisis will have a mainstream effect on the precious metals, because to an extent it's disconnected, and therefore it will limit the spread of risk aversion to mainstream Western investors. So there is not much benefit out of the Ukrainian crisis, and even so, if it is prolonged, it is not going to affect mainstream investors. We will not see much of changes in the jewelry markets, because first, let's take India for example. There is too much speculation around when and how the restrictions will be lifted. And the restrictions of such complex nature that even any maneuvering in these restrictions will not be good enough for India to be back on the full-scale consuming pattern like it used to be in the back to support any kind of substantial rally. China, as we've already Gary mentioned, that we'll have to get adjusted to China not being the, the kind of player that it had been in the past. So just as it has demonstrated for the last 1 month, Chinese demand has been pretty much out of the game. So getting adjusted to that as well. Once these factors wane, we should expect prices to go from the current levels back into the 1200s. There is not much on the palette right now to feed the rally. Even if the Ukrainian crisis or any other further geopolitical tensions were to escalate, somehow other countries were to get involved, and there is not a likelihood of it, but if there were a possibility of something like a global war, we still think that any rally that will be followed by that will only be short-lived. It cannot sustain because there are those other ingredients that you need to support the rally, especially support from the physical markets, which is going to be predominantly absent. And therefore, we do not see that in this year, we are going to see a major breakthrough from the existing trading range that has been established for precious metals. On the downside, we can expect the prices to probably hold good at around 1100 levels, simply because we've had still some positives in the market. However, the downside risk remains is that if there were any preponement in the Fed's reversal on the interest rates, which is not expected, but if there was something like that, that remains a downside risk to the market. Coming to silver, silver has always closely followed gold, and up till February it looked as though it was catching up with gold, again benefiting partly from the investment demand led by the Ukrainian crisis, but to a lesser extent compared to gold, simply because silver is not a first preference for safe haven asset. So we saw that silver also gave relatively same returns as to gold up till its peak in this year. We started with around at the foot of $20, and then we went up to about $22. However, it gave up these gains sooner rather than later, and we expect that silver will only get support from industrial demand, and to that extent it will be useful for investors. However, there isn't much by way of demand in silver other than industrial, especially investment demand will be lacking significantly, and therefore we do not expect that prices can hold much further. On the downside, silver can hold good around $17, but on the upside it will cap it at probably around $21 for the rest of the year. Thank you very much.
Thank you, Gargi, for this wonderful presentation, entirely in line with my own thinking. Silver market is in surplus, about 6,000 ton surplus in 2014. The upside risks are extraordinarily limited. If there is a directional change, it is to the lower side. That's one. Gold, as Gargi mentioned, all the price drivers are weakened. All those drivers that drove gold prices up and up and up between 2000 and 2012 for 12 years, they're all considerably weaker today. Economic growth is improving. Liquidity-driven commodity boom is probably coming to an end. Interest rates are set to rise. Equity markets are improving. The risk on environment is what we are facing now. And therefore, I think there's a strong possibility of a sharp correction in gold prices. Yesterday it closed, the PM fix in London was $1,302 an ounce. The next target by the end of this quarter, I guess, should be about $1,250 an ounce and below. And by the end of the year, it should be about $1,200 and below. But what happens to Indian prices is the big question. That will depend on two things. What the new government is going to do about customs duty. There's a 10% duty on gold. Will there be reduction in duty? I believe yes, there will be. And where will the rupee be in the second half of this year? That's again a big question. That is what will decide Indian domestic market prices. Okay, Gargi, thank you very much. I'm now going to invite Kaveri Deshmukh, Senior Economist, NCDEX, to share her thoughts on the agriculture markets and over the next 7 or 8 minutes, and then we'll kind of wind up this session on commodities. Kaveri.
Dignitaries on the dais, ladies and gentlemen, it gives me immense pleasure to be a part of this unique event. I call this unique because given the topic investment outlook and given where we are today, we have actually traversed a long way. My topic being agri-commodities, I'm always reminded of things like we have moved a long way from the so-called Hindu rate of growth, which was actually 2 to 3% and that dominated our overall rate of growth. And then we ushered in the green revolution. At some point of time, we aspired for having a double-digit rate of growth. And now we are at a stage when at the maximum speed possible, we want to resume that double-digit aspiration-driven growth trajectory back on the track. So, in this context, I find this event to be unique because we are not just aspiring for growth. Our aspirations are going beyond, extending to what is called inclusive growth. And in inclusive growth, it is every sector that has to contribute. And it is as important as every sector has a share in the fruits of that growth. And hence the outlook for agri-commodities as well is very important. The World Bank in its commodity market outlook dated January 2014 said, agricultural prices are projected to decline a further 2.5% in 2014 under the assumption that the existing improved crop conditions will continue for rest of the year. Specifically, prices of food and beverages are expected to drop and raw material prices will not change much. The largest decline among food commodities will be in the grain group with maize, rice and wheat down by 13, 9 and 4% respectively. But friends, the situation is much different now. Because in agri-commodities, to a very large extent, weather is the key driver. And as the previous speakers also mentioned, we are all witnessing El Nino blues, the dry weather in the Western and European regions, which is actually impacting the agricultural productivity and yields, not only in those regions, but it has almost started impacting our yield levels as well. As they say that El Nino has impacted the yields, wheat yields in Australia, and we fear that the same may impact our wheat yields in Maharashtra, UP and other states of the country, and that including the yields of sugarcane. So we can imagine where the prices could go in the long run if we look at the demand and supply constraints and the mismatches that would take place. Till a year back, the prices of agri-commodities stood muted, obviously on a rise in the output. However, with the weather woes in the Pacific and the El Nino setting in, there is always a possibility of prices going high as against what the World Bank or FAO or OECD have projected, and as a result there would be scope for speculative trades as well. Commodities like corn, wheat, soybean, sugar, coffee, palm oil prices have surged since the beginning of the year, and those are not because of shortage but because of the anticipated fear that there would be a shortage. Professor Amartya Sen says that famines don't occur because there is an actual unavailability of food to people, but there may be immense causes apart from this, and the same applies to commodities prices at this stage of time. On the domestic front, what we can see that the year did not start with a good beginning. We had a very poor or not so good turnover on the commodities exchanges, and obviously there were reasons like there was the introduction of commodities transaction tax of 0.01%, which the farming community and the trading community, all of us resented. And apart from that, the crisis in one of the spot exchanges in the country. However, the efforts taken by the Ministry of Finance and the FMC are definitely going to provide a firm ground to us, and we could definitely draw a roadmap to overcome these. One of the initiatives I would like to mention from the side of FMC, which has just began, but it can make a difference to our trades, which is evening trading, recently introduced. It is too early to talk on its impact on how our trading volumes have increased, but the trading community is definitely looking forward to an increase over there. The 20th century reforms in the agri sector and in agri marketing sector were mostly led by an intervention by the by the governments and the state governments. But what is expected now to boost the outlook, to boost the productivity, is also to have a proactive role from the sides of all the stakeholders, including the trading community, the farming community, as well as exchanges. There are opinions that even farmers could be a part of price determination exercise, while exchanges could be a part of the procurement drives of the government. And just to mention that NCDX has already engaged with governments like state government and UP and Haryana in such drives, and that has actually helped in driving the market and driving the outlook for commodities market of late. Coming to the outlook in a gist, agri-commodities would definitely depend on the weather woes, as well as Mr. Chandrasekhar pointed out the dollar value, as well as our policies, and not last but not the least, the geopolitical relations that the countries share among themselves. As we know that currently the commodities markets, may it agri-commodities or non-agri, they have been impacted by Russia-Ukraine tensions. And apart from that, volatility in the currency would definitely have an impact on the outlook. Oilseed production is expected to increase faster than cereals. In India, we definitely have a strong hold on castor, almost a monopoly, and the future trading volumes have actually made an impact in better price discovery and determination. Apart from that, cotton is expected to be taken over by man-made fibers. Friends, given the agri outlook as determined by these factors, we should not forget that El Nino is always followed by its sister La Nina, which sets in the exactly opposite conditions. If El Nino sets in dry weather, La Nina brings wet weather in the countries where there is already a lot of rainfall, and that could also impact our outlook in the year to come. As we definitely have experienced it in 2009. El Nino was followed by La Nina. So let's also be prepared for that. And I thank IMC for having given me this opportunity. Thank you, friends.
Thank you, Kaveri, for sharing your thoughts and painting that big picture. But I want to set the record straight. There is a looming threat of El Nino. El Nino is not upon us already. No. You have dry conditions in Brazil, dry conditions in Southeast Asia, parts of Eastern Europe, parts of Australia, but it is not El Nino yet. This is one. And in anticipation of El Nino, a lot of speculative capital has gone into the agriculture commodity markets. Wheat and corn prices are up 10% in the last 8 weeks. Sugar prices up 12%, cotton prices up 10%. But a silver lining to all this is that in the US, the planting intentions are turning out to be positive. Soybean acreage is likely to be up 7%. Cotton acreage likely to be up 11%. Corn could be down marginally by 4% and wheat marginally by 1%. I think these are positives. For I think we need to, the agriculture markets are at the crossroads. What happens over the next 4 weeks is going to be extremely important. And therefore, the suggestion is that don't take a far forward position. Wait for the picture, the weather conditions to crystallize very clearly, and be careful in your trading calls. But what looks bullish to me as of now is sugar. What looks bearish to me as of now is edible oil, vegetable oil, particularly palm oil, beginning sometime May, second half of May. And what looks to me bullish currently is cotton, which can actually correct. There will be correction in the second half of the year, some of the major agriculture commodities. I think with this, we need to wind up. We are already overshot our time. I want to thank all our speakers, particularly Gary Anderson from Dubai, who delivered a wonderful keynote speech. Gargi Shah on gold, Kaveri on agriculture commodities, Asutosh from SR on the crude market, and of course Hitesh on the base metals and industrial metals market. Thank you very much for
to be taken over by man-made fibers. Friends, given the agri outlook as determined by these factors, we should not forget that El Nino is always followed by its sister La Nina, which sets in the exactly opposite conditions. If El Nino sets in dry weather, La Nina brings wet weather in the countries where there is already a lot of rainfall.
I request all the panelists to pose for a photograph. Ladies and gentlemen, we shall now break for tea. The tea break will be for 15 minutes, for 5 minutes, post which we shall start the real estate session. The guests are requested to take their tea and sit back on their seats.
No, thank you. Speak to you soon.
time for Bombay?
Yeah, what's up? Yeah, please.
Thank you.
Yes.
हेलो हाँ हाँ तो अभी वो हाँ करो आई डोंट नो वेदर ए हितेश
We request the guests to please settle down. We'll be starting with the next panel. The guests are requested to please take their tea and sit on their place. The guests. I'll call the speaker. The guests are please requested to settle down. We start our session on real estate. To moderate this session, the guests are please requested to sit down. Yeah, it's not a problem. Hey, Gaurav, how are you doing? Pretty good. Sure. See you in the market. The guests are please requested to sit down. We'll start with the panel. It is a sincere request to all the guests to please settle down. We start our session on real estate. To moderate this session, we have Mr. Mihir Bhatt, Bureau Chief, Zee Business. Mihir Bhatt is the head of Zee Business Mumbai with an experience of 10 years in journalism. He is a prime-time anchor for the channel and leads the market opening show. He has been a leading stock market anchor and represents Zee Business to the stalwarts of India. Over to you, Mihir.
Good morning, everyone. I request all of you to take your seats and please put your mobile phones on silent mode. We have some very good dignitaries here. So in next 1 hour, we are going to take overview of what is going to happen in real estate. And one question which keeps coming to all of our minds, कि आखिरकार हम घर कब खरीद पाएंगे? So I hope we get the answer. And उसके लिए लोन मिलेगा कि नहीं वो भी पता चल जाएगा with Mr. Mistry here. So I hope all of you will cooperate. Please take your seats. We'll start in 2 minutes. Alright, so we'll start the discussion now, and a very warm welcome on behalf of IMC and Zee Business on this special seminar. I'll start with Mr. Mistry, who is here. Sir, morning to you, and thanks for joining us. First of all, a very basic question, sir. What is your outlook as far as the economic scenario is concerned, the real estate scenario is concerned, and the general sentiment of India's story is concerned? Where are we at this point?
I think we are very close to the elections, and a lot of what happens over the next couple of years will depend on how the elections pan out. Markets are expecting a strong, stable government at the center, and if that were to happen, my sense is that the investment cycle, which has been slow now for the last 2 or 3 years, that will start picking up. And if the investment cycle starts picking up and people start investing into creation of new capacities, new factories, new plant and machinery, then that would create jobs. As jobs get created, consumption will increase. As consumption increases and demand increases for goods and services, more people will want to produce more. More people will start newer and newer manufacturing units, which means the demand for real estate, commercial real estate, which over the last 3 years has been weak, that demand can pick up and pick up very sharply. As far as the residential market is concerned, my sense is and has always been that irrespective of what happens, the residential demand for real estate in India will always remain strong for a number of reasons. And I think the fundamental reason is that there is a huge need, a massive need for housing in India. Urbanization is taking place in India. As urbanization takes place, more and more need takes place for providing housing to people. And more importantly, if you look at the demographics of India, 60% of India's population is below 30 years of age. And unlike the West, in India, people do not go and buy a house when they're in their 20s. So the average age of a customer when he applies to us for a loan and he's a first-time home buyer, his average age would be between 35 and 38. And with 60% of India's population today being below 30 years of age, all these people will in the next 1, 3, 5, 7, 10 years need housing and therefore housing loans. So my sense is that irrespective of what happens, as long as people don't start losing jobs, the demand for residential housing will always remain strong. Commercial will be more a function of how the economy pans out.
Also now, since you mentioned economy, ये जो एक perception है market में that the economy will pick up if we have a strong government in place and probably a regime change. That's what people are hoping for. That's what people are looking at. Do you believe in that theory?
Oh, absolutely. I said that in the beginning. I said that once the elections are over, if people perceive a strong, stable government at the center, the investment cycle will pick up, and that will be the turning point that India needs. I meet a lot of international investors all the time, and I keep telling them that whilst the GDP numbers may have slowed down and IIP numbers have slowed down, and we've had some problems on current account deficit in the past and so on and so forth, the fundamentals of India have not changed. We are still a very young country. We are still a very, very under-penetrated market. So whatever product you look at, penetration levels in India are extremely low. And therefore, the growth opportunity in India will remain very strong. All that we need to see is a change in sentiment which will bring in or which will kickstart the investment cycle, where people start creating new facilities, start new factories, new businesses. That is all that we need. And if that happens, the economy will keep revolving around itself, primarily because we are a young country.
Also, sir, now, if I was to touch upon the manifesto which was released by BJP, And I'm not looking for a political answer from you, but it does mention about developing 100 new cities, and that will directly impact the real estate sector across the country. What is your view on that?
My view is that urbanization in India, in any case, by any estimate, is going to increase. And there are any number of reports which will show that urbanization in India will increase. More towns and cities will get developed, and that essentially will create huge demand for real estate and for housing in India. If we were to look at our business, for example, our retail business, and if we were to look at the growth in the top 5 cities in India, our largest growth would come from Delhi NCR, second would come from Mumbai, third would come from Chennai, fourth would be Bangalore, fifth would be Pune. But it's not business which would originate in the hearts of the city. So when we look at Mumbai, for example, all of us tend to look at Mumbai up to, let's say, Borivali. But really, the demand that is taking place in Mumbai today is in the outskirts of big cities. So these outskirts of big cities, or tier 2, tier 3, tier 4 towns and cities in and around Pune, where there is so much of growth that is taking place, that is where more and more growth will happen as some of these, as you say, 100 more cities get created.
We also have Mr. Mantri with us. Sir, मेरा सवाल ये आपके लिए है. You know, what is the urgent need for real estate sector at this point? Because काफ़ी हमने इसके बारे में सुना है 2008 से slow down है. In fact, and I cover stock market, so I keep hearing that real estate is a big worry, it's a big threat, and not only listed companies but otherwise also. So, सबसे urgent need इस समय sector की क्या है, which needs to be addressed by the new government?
Okay, I think we have a huge demand. A big list is there, but to summarize in short, I'll just try to mention 4 or 5 of them. The first and foremost, the real estate being one of the second largest employer, we have not been given a status of industry or the infra. I think that's a demand which was there with the previous government, and we'll continue to demand the same with the new government, whichever is going to be formed on 16th of the May. So the industry status or the infra status is the biggest requirement, but that will open up a huge channel for funding to be made available in this sector, because as you know, the real estate sector, the funding to this sector is being controlled. The land, we don't get any funding. For the construction also, we have to run around the banks, because one single bank doesn't take. We have to make a consortium, and a lot of time goes in this process. So funding to the developer is another challenge which is available, but it is very minimum one, what I can say, compared to the requirement. So that is required. The third point, the biggest problem which our industry is facing is the whole system of the approvals. As you know, I think generally a building plan, by the time you get approval from the local municipal corporation, then you get an environment clearance, usually take anything between 18 to 36 months. So I think it is a big question mark for all of us. And if you have read a statement issued by Deepak Parekh, if you make online the whole approval process, the real estate prices can come down by 10 to 20%. So if you avoid the desk procedure of the files moving from one desk to another one, and it moves to like 60 desks, if you give online clearances within 60 days, which is a time frame stipulated in the law, I think the whole price factor, at least to my best of knowledge, it can come down 10%. So the approval is the biggest challenge for all the developers. That's one. One more point I would like to mention, the infrastructure. Now, always real estate players are blamed that the prices are too high. That's always criticism is made. Now, you have to understand, unless until you create land, that means you give the higher FAR. Currently, the FAR in Island City is 1.33 and suburban is 1, which at least need 10. If you see any international cities, the FAR are around between 10 to 30. So I am hoping that FAR standard is completely rewritten. So that's the need of the hour. And second way, to add the land bank by making the connectivity, creating the infra. For example, say Mumbai to Panvel or Mumbai to Khopoli. If you reach in 30-40 minutes, I think whole of the Khopoli can develop. The one bridge what we are talking is under tender for last 10 years. The airport we know last 10-15 years we are listening the story. So infra is a key issue. We are not able to create a proper connectivity by the road as well as the metro or train. Unless until you create the connectivity, more land parcels cannot be made available. So I think the whole close by area to Mumbai, or up to Khopoli, 60 square kilometer, 80 square kilometer needed to be added to create more affordable housing stock also and keep the realty prices under check. So these are few important agenda which we look forward from the new government.
We have Mr. Gupta also with us, who is from Omkar. But इनका जो व्यू है सुनील वो शायद थोड़ा अलग है, एंड मैं फिर आपको मौका भी दूंगा टू काउंटर हिम. बट आई वाज डिस्कसिंग विद हिम, सेशन शुरू हुआ उससे पहले, एंड हिज व्यू इज दैट रियल एस्टेट प्राइसेस तो और आगे बढ़ने वाले हैं यहाँ से, इमटेरियल ऑफ ऑनलाइन क्लियरेंस हो, ऑफलाइन हो, एंड नई गवर्नमेंट आने के बाद. सो वुड यू वांट टू ऐड टू दैट?
Yeah, what I was discussing with you was respect to the Bombay market. Now, if you look at Bombay and Delhi, you know, the two biggest cities in the country. Look at Delhi. Delhi is expanding from, taking Sunil's point further, you know, Delhi is expanding from all four corners. They have Gurgaon, Noida, Faridabad, the city is round. And if you take the example of Bombay, you know, unfortunately we have water on three sides. So the only way which Bombay can expand is towards the north. Or you create infrastructure which Sunil was talking about, you know, towards Khopoli, or towards, you know, the Nhava Sheva Sivri ceiling which we've been talking about, which can bring in further land. Honestly speaking, you know, we don't see that happening over a long period of time. So because of those land constraints, you know, and there is
going to happen in real estate. And one question which keeps coming to all of our minds, कि आखिरकार हम घर कब खरीद पाएंगे? So I hope we get the answer. And उसके लिए लोन मिलेगा कि नहीं वो भी पता चल जाएगा with Mr. Mistry here. So I hope all of you will cooperate. Please take your seats. We'll start in 2 minutes. Alright, so we'll start the discussion now, and a very warm welcome on behalf of IMCNZ Business on this special seminar. I'll start with Mr. Mistry, who is here. Sir, morning to you, and thanks for joining us. First of all, a very basic question, sir. What is your outlook as far as the economic scenario is concerned, the real estate scenario is concerned, and the general sentiment of India's story is concerned? Where are we at this point?
I think we are very close to the elections, and a lot of what happens over the next couple of years will depend on how the elections pan out. Markets are expecting a strong, stable government at the center, and if that were to happen, my sense is that the investment cycle, which has been slow now for the last 2 or 3 years, that will start picking up. And if the investment cycle starts picking up and people start investing into creation of new capacities, new factories, new plant and machinery, then that would create jobs. As jobs get created, consumption will increase. As consumption increases and demand increases for goods and services, more people will want to produce more. More people will start newer and newer manufacturing units, which means the demand for real estate, commercial real estate, which over the last 3 years has been weak, that demand can pick up and pick up very sharply. As far as the residential market is concerned, my sense is, and has always been, that irrespective of what happens, the residential demand for real estate in India will always remain strong for a number of reasons. And I think the fundamental reason is that there is a huge need, a massive need for housing in India. Urbanization is taking place in India. As urbanization takes place, more and more need takes place for providing housing to people. And more importantly, if you look at the demographics of India, 60% of India's population is below 30 years of age. And unlike the West, in India, people do not go and buy a house when they're in their 20s. So the average age of a customer when he applies to us for a loan and he's a first time 7-10 years need housing and therefore housing loans. So my sense is that irrespective of what happens, as long as people don't start losing jobs, the demand for
that the economy will pick up if we have a strong government in place and probably a regime change. That's what people are hoping for. That's what people are looking.
Investment cycle will pick up, and that will be the turning point that India needs. I meet a lot of international investors all the time, and I keep telling them that whilst the GDP have not changed, we are still a very young country. We are still a very, very under-penetrated market. So whatever product you look at, penetration levels in India are extremely low, and therefore the growth opportunity in India will remain very strong. All that we need to see is a change in sentiment which will bring in, or which will kickstart the investment cycle, where people start creating a country.
Also, sir, now, if I was to touch upon the manifesto which was released by BJP, and I'm not looking for a political answer from you, but it does mention about developing 100 new cities, and that will directly impact the real estate sector across the country. What is your view on that?
My view is that urbanization in India, in any case, by any estimate, is going to increase. And there are any number of reports which will show that urbanization in India will increase. More towns and cities will get developed, and that essentially will create huge demand for real estate and for housing in India. If we were to look at our business, for example, our retail business, and if we were to look at the growth in the top 5 cities in India, our largest growth would come from Delhi NCR, second would come from Mumbai, third would come from Chennai, fourth would be Bangalore, fifth would be Pune. But it's not business which would originate in the hearts of the city. So when we look at Mumbai, for example, all of us tend to look at Mumbai up to, let's say, Borivali. But really, the demand that is taking place in Mumbai today is in the outskirts. So these outskirts of big cities, or tier 2, tier 3, tier 4 towns and cities in and around Pune, where there is so much of growth that is taking place, that is where more and more growth will happen as some of these, as you say, 100 more cities get created.
We also have Mr. Mantri with us. Sir, मेरा सवाल ये आपके लिए है. You know, what is the urgent need for real estate sector at this point? Because काफ़ी हमने इसके बारे में सुना है 2008 से slow down है. In fact, and I cover stock market, so I keep hearing that real estate is a big worry, it's a big threat, and not only listed companies but otherwise also. So, सबसे urgent need इस समय sector की क्या है, which needs to be addressed by the new government?
Okay. I think we have a huge demand. A big list is there, but to summarize in short, I'll just try to mention 4 or 5 of them. The first and foremost, the real estate being one of the second largest employer, we have not been given a status of industry or the infra. I think that's a demand which was there with the previous government, and we'll continue to demand the same with the new government, whichever is going to be formed on 16th of the May. So the industry status or the infra status is the biggest requirement, but that will open up a huge channel for funding to be made available in this sector, because as you know, the real estate sector, the funding to this sector is being controlled. The land, we don't get any funding. For the construction also, we have to run around the banks, because one single bank doesn't take. We have to make a consortium, and a lot of time goes in this process. So funding to the developer is another challenge which is available, but it is very minimum one, what I can say, compared to the requirement. So that is required. The third point, the biggest problem which our industry is facing is the whole system of the approvals. As you know, I think generally a building plan, by the time you get approval from the local municipal corporation, then you get an environment clearance, usually take anything between 18 to 36 months. So I think it is a big question mark for all of us. And if you have read a statement issued by Deepak Parekh, if you make online the whole approval process, the real estate prices can come down by 10 to 20%. So if you avoid the desk procedure of the files moving from one desk to another one, and it moves to like 60 desks, if you give online clearances within 60 days, which is a time frame stipulated in the law, I think the whole price factor, at least to my best of knowledge, it can come down 10%. So the approval is the biggest challenge for all the developers. That's one. One more point I would like to mention, the infrastructure. Now, always real estate players are blamed that the prices are too high. That's always criticism is made. Now, you have to understand, unless until you create land, that means you give the higher FAR. Currently, the FAR in island city is 1.33 and suburban is 1, which at least need 10. If you see any international cities, the FAR are around between 10 to 30. So I am hoping that FAR standard is completely rewritten. So that's the need of the hour. And second way to add the land bank by making the connectivity, creating the infra. For example, say Mumbai to Panvel or Mumbai to Khopoli. If you reach in 30-40 minutes, I think whole of the Khopoli can develop. The one bridge what we are talking is under tender for last 10. We know last 10-15 years we are listening the story. So infra is a key issue. We are not able to create a proper connectivity by the road as well as the metro or train. unless until you create the connectivity, more land parcels cannot be made available. So I think the whole close by area to Mumbai or up to Khopoli, 60 square kilometer, 80 square kilometer needed to be added to create more affordable housing stock also and keep the realty prices under check. So these are few important agenda which we look forward from the new government.
We have Mr. Gupta also with us, who is from Omkar. But इनका जो व्यू है सुनील वो शायद थोड़ा अलग है, एंड मैं फिर आपको मौका भी दूंगा टू काउंटर हिम. बट आई वाज डिस्कसिंग विथ हिम, सेशन शुरू हुआ उससे पहले, एंड हिज व्यू इज दैट रियल एस्टेट प्राइसेस तो और आगे बढ़ने वाले हैं यहाँ से, इमटेरियल ऑफ ऑनलाइन क्लियरेंस हो, ऑफलाइन हो, एंड नई गवर्नमेंट आने के बाद. सो वुड यू वांट टू ऐड टू दैट?
Yeah, what I was discussing with you was respect to the Bombay market. Now, if you look at Noida, Faridabad, the city is round. And if you take the example of Bombay, unfortunately, we have water on three sides. So, the Nhava Sheva Sivri sea link, which we've been talking about, which can bring in further land. Honestly speaking, we don't see that happening over a long period of time. So, because of those land constraints, and there is less supply in Bombay. If you look at it, Bombay historically over the past couple of years, a lot of regulations have changed in Bombay. We've had the new development control regulations coming into place. Now, what has been the impact of these development control regulations has been, is that, earlier the developers used to build, typically if you look at it, larger houses. The FSI component, the free of FSI component which was there in the industry, that has been reduced with the advent of the new DCR. Plus, there has been a premium which has been added for the fungible FSI. The construction cost has drastically gone up over the past couple of years. And fourthly, we've started building more and more of high-rises. If you take all these factors into account, over the past couple of years, I don't think the real estate prices have increased to the tune they're supposed to increase. With the advent of the new government coming in, and we're looking at a positive scenario, if the new government coming in, I think prices will definitely go up, because developers today, because of the economic scenario, not able to increase prices as much as possible. Plus, I think what will change also is the product mix. We look at historically in Bombay, we had larger units. We had even a 2 BHK for that matter was 14, maybe 950 to 1100 square feet. You will see a 3 BHK in the range of 1500 to 1700 square feet. So I think the overall ticket size in Bombay will reduce. What's important for Bombay is the affordability. So the overall ticket size will reduce, but the price per square feet will definitely go up in the long run.
Right, लेकिन ये जो एक आपने मुद्दा उठाया, and in fact this is a general, सुनील मैं आपसे भी कमेंट चाहूँगा इस पे, and then Mr. Mistry can elaborate. ये एक परसेप्शन है, और ये तो शायद वो थोड़ा बहुत नेगोशिएट हो जाए, बट प्राइजेस नेवर कम डाउन. तो ये जो आप बता रहे हैं कि ऑनलाइन हो जाएगा अप्रूवल, तो इससे प्राइजेस विल ड्रॉप ऑलमोस्ट बाय 20%. डू यू थिंक ये सच में होने वाला है?
देखिए, रियल एस्टेट में सबसे बड़ी परेशानी है कि सप्लाई. जो अभी प्रेजेंट सिनेरियो है, फाइल क्लियरेंस की आप गति देखेंगे तो ऑन एन एवरेज कोई भी फाइल क्लियर होने में करीबन 2 या 3 साल लग जाते हैं. आप जब तक कोई भी चीज में सप्लाई नहीं बढ़ाएंगे, एक्स्ट्राऑर्डिनरी सप्लाई नहीं क्रिएट करेंगे और एडिशनल लैंड बैंक आप कनेक्ट नहीं करेंगे, तब तक ये प्राइसेस बढ़ती रहेगी. आपको एक कंपैरिजन के लिए मैं हैदराबाद का एग्जांपल देता हूं. मुंबई के सामने हम हैदराबाद को कंपेयर करेंगे. लुक एट हैदराबाद. यू हैव ह्यूज FAR, करीबन 5-6 अनलिमिटेड FSI कॉन्सेप्ट है. पूरी सिटी करीबन 60-80 स्क्वायर किलोमीटर प्रॉपर इंफ्रा से कनेक्टेड है, और उस वजह से हैदराबाद की प्राइसेस थोड़ी बहुत कंट्रोल में है. इतनी ज्यादा मुंबई जैसे इन्फ्लेट नहीं हुई है कंपैरेटिवली. हम मुंबई की बात करें तो लैंड हमारे पास कम अवेलेबल है, कनेक्टिविटी इंफ्रास्ट्रक्चर जितना स्पीड से हम चाहते हैं वो हो नहीं रहा है. इस वजह से बहुत लिमिटेड लैंड पे बहुत ज्यादा प्रेशर है, और उस वजह से प्राइसेस बहुत फर्म और स्ट्रांग है. कोई भी फाइल क्लियरेंस की जो समय हम लगा देते हैं, तो उस वजह से सप्लाई मार्केट में जितनी स्पीड से आनी चाहिए उतनी आ नहीं पाई.
So you are saying that is creating artificial bubble.
It is one way. मतलब गवर्नमेंट एक प्रकार से जो भी फाइलों की गति है, जो भी चल रहे हैं रिजल्ट्स, उसके हिसाब से एक प्रकार से गवर्नमेंट एक प्रकार से इसको कंट्रोल कर रही है, ये भी मैं मानूंगा. क्योंकि अगर कोई भी CM डिसाइड कर ले कि 60 डेज में रियल एस्टेट की परमिशन दी जाएगी, तो मुझे नहीं लगता कोई डिसीजन है. डिसीजन तो उन्हें लेना ही है, 18 महीने के बाद लेना है, 36 महीने के बाद लेना है. तो क्यों नहीं 60 डेज जो स्टैट्यूटरी लॉ में टाइम फ्रेम दिया है 60 डेज में करो. और क्यों हमें गवर्नमेंट के ऑफिस बार बार जाना पड़ता है फाइलें क्लियर करवाने के लिए? आप क्यों नहीं ऑनलाइन, जैसे आप कोई भी चीज अप्लाई करो तो आपको ऑनलाइन क्लियरेंस मिलता है, तो रियल एस्टेट में देने में क्या दिक्कत है? मुझे नहीं लगता कोई प्रॉब्लम है उसमें देने में, क्योंकि सारी चीजें ट्रांसपेरेंटली अगर इसे प्रोसेस अडॉप्ट करे तो निश्चित रूप से प्राइजेस होगी। ऑफ कोर्स आपको इंफ्रा बनाना पड़ेगा, अधिक लैंड लानी पड़ेगी, एफएसआई के रिलैक्सेशन देने पड़ेंगे, सीआरजेड नॉर्म्स, ये काफी मतलब मुझे लगता है दुनिया लाफ करती है इंडिया के सीआरजेड रूल्स रेगुलेशन से। दुबई अगर आप जाते हैं तो दुबई ने 3 आइलैंड समुद्र के बीच में बनाए हैं, और हम इंडिया में बात कर रहे हैं कि समुद्र से 500 मीटर छोड़ के हम बनाए। अगर एग्जिस्टिंग रोड है, एग्जिस्टिंग रीडेवलपमेंट ऑफ द बिल्डिंग है, उसे भी सीआरजेड लगा देते हैं। तो मुझे नहीं लग रहा है, ये बहुत ही जोक है, बिगेस्ट जोक ऑफ द डे है ये। और ऐसे रूल्स गवर्नमेंट लाती है जो काफी अपने आप हास्यास्पद है। तो जब तक ये रूल्स रेगुलेशन हम सिंपल नहीं करेंगे, मुझे नहीं लगता है कि सप्लाई बढ़ेगा और उससे प्राइजेस होगी नहीं। तो आपको सिंपल फॉर्मूला हैदराबाद जैसे आपको फॉलो करना पड़ेगा, और अगर वो फॉलो करते हैं तो मुझे लगता है कि रियलिस्टिक प्राइजेस काफी रीजनेबल वे से रह सकती है। और अगर प्राइजेस रीजनेबल है, अफोर्डेबल है, तो वॉल्यूम्स काफी बड़े पैमाने पे डेवलपर्स के बढ़ेंगे। मतलब हमें ये नहीं चाहिए कि बहुत ज्यादा प्राइजेस बढ़ रही है, अल्टीमेटली इट बिकम्स अनअफोर्डेबल एंड ऑफ द डे। दिस इज माय व्यू।
राइट, लेकिन एक काम करते हैं, पोल सीजन चल रहा है, सो जिन लोगों को ये लगता है कि अगर ऑनलाइन क्लियरेंस हो जाएगा तो बिल्डर्स प्राइस कम करेंगे, प्लीज रेज योर हैंड्स। जिनको लगता है बिल्डर्स प्राइस कम करेंगे। Okay, Mr. Gupta is saying there are quite a few of them. Anyways, Mr. Mistry, in fact, Deepak Parekh Sahab, he has been speaking about this for past 5-6 years that the prices need to come down. एक तो ये, and दूसरा, what is your personal view on this widening gap between affordable housing, जिसकी बार बार बात होती है, which is almost a wishful thinking, and second is what is available in the market, the product which is available, especially Bombay में अगर आप देखें.
See, let's first come to the second part of your question, which is affordable housing. Affordable housing as a concept, it is very difficult to have in Bombay, simply because Bombay land is not available. As I think Sunil said very correctly, there are so many constraints on availability of land in Mumbai, issues on clearance, title clearance, issues on getting approvals. All that delay adds to the cost. Now, if you talk, so therefore getting affordable housing in Mumbai realistically is a very, very, very difficult task. Outside of Mumbai, it is possible to get affordable housing where land is available. Basically, land prices, if you can reduce, affordable housing is there. If you look at tier 3, tier 4 cities in India today, there is affordable housing. There is housing that you can get in the range of 10 lakhs to 20 lakhs, 10 lakhs to 25 lakhs, even 5 lakhs, 10 lakh housing you can get. But certainly not in the big metropolitan cities. Now coming to prices and why prices are high, my sense is prices are high for 2 reasons. The first reason is, like any commodity, the price of that commodity is a function of demand and supply. So demand in India is for residential properties insatiable. So whatever you do, demand will be there. It might be little weak in some quarter, as I said earlier. It might be stronger in another quarter, but fundamentally demand will always remain strong because of the young population, the need for housing, urbanization, and so many other reasons. So only way you can bring prices lower is to increase supply, which is, I think, the point which Sunil made. Now, to increase supply, you need to do 2 things. One is make land available at a lower price. There are various ways you can improve supply. So, reducing supply of land or reducing the price for land is one option. Second is making lending for land a formal system so that the banking system can give loans for buying land. Today, the banking system is prohibited for giving loans for buying land, and therefore developers have to buy land from private equity investments where the return that they have to pay is huge. And if further you compound that with delayed approval of projects where you already paid for the land, then obviously the property price keeps going higher and higher. The construction cost goes higher and higher. And therefore, if the construction cost goes higher, the selling price also is going to go higher.
We have Shahzad also with us. Sir, your view basically on the funding scenario at this point, because, like Mr. Mantri also mentioned that part of the problem is also the funding for the real estate development in the country, and second is obviously the approvals related to each project. And the timeline is obviously very important for any person who's funding a particular project. So what is your view, and are you seeing any signs of stress at this point in this industry?
The real estate sector in India will ultimately reflect the underlying economy. And if you are seeing a slowdown in very many sectors, you're going to see that in real estate too. Ultimately, this is a big ticket item. It's impacted to a great extent by interest rates and very importantly by confidence. So jab interest rates are at the levels they are maybe, and confidence is at, maybe people are a little cautious. Obviously, you would have some amount of, let us say, slower offtake in real estate than you might have had in the past. So that's the first point which I would make. So clearly, just like it is in autos, and I will use automobiles as an example, where you've seen a slowdown because it's similar big ticket item, etc. With interest rates impacting it, you've seen a similar situation here. That said, firstly, it varies. In real estate, there is no particular, I think it's not one consolidated whole. Just like in a stock market, what you would say, where say there are different stocks, different sectors, they have their different cycles. So here, every micro market is different. Bangalore is doing relatively better than some other markets. Mumbai has its own problems. Gurgaon has its own problems. So each market varies. But one of the, or a couple of things which we've seen really stand out in the last some time is the following. See, those who can deliver, i.e. those who can actually put up a structure, and those who can sell, are still doing in this difficult environment fairly well for themselves. So clearly when you look at what's happening around you, things like branding, things like, your ability to sell is becoming far more FMCG-like. So those who can deliver on those fronts, they are still managing in a very, very difficult situation. But the earlier model, which was buy and hold land, etc., that's coming under a lot of question. Stress is there. Selectively, of course, you can't generalize, say, everybody is under stress. Yes, to greater or lesser extents, like, even the largest corporates in India are under stress. So to greater or lesser extents, yahan par bhi stress hai. The way I would put it in summary is that, we are obviously waiting for a lot which would happen, let's say, post the elections. And hopefully, and I use the word here very carefully, hopefully, what we saw in 2009, if anyone recollects what happened in 2009 post the elections, one is, of course, the election results were declared on a Saturday morning. We generally knew what happened on the election results. Monday morning, of course, everyone knows out here in the stock market what happened. You have an upper circuit in the stock market. But you also saw literally from Sunday, Sauda started happening again. And real estate market post-Lehman had really slowed down. So it's a lot of function is of confidence. Now I'm speaking more specifically of Mumbai, wherein, it's more related to financial markets, more related to the service industry. So I would imagine that hopefully we should see things improving, let's say, in the not too distant future, and see how
it goes. With the same government coming in or a different one?
Sorry? I didn't get you?
With the same government coming in or a different one?
Well, anyway, everyone's been reading the opinion polls. Let's go with that. Because, obviously I have no further insight on this. I just say that, let's put it, opinion polls, let's say that they know more than I do.
Okay, so you're going by them. You can always blame it on polls. All right. Joe, I would like to bring you in. Now, this whole perception, and आप जितने भी foreign reports पढ़ेंगे, or the foreign brokerage reports or whatsoever, one general view is that there is a lot of expectation build up from the new government, which will be probably a different government in all likelihood. But forget all that. As far as real estate sector is concerned in India, at this point, from foreign investment perspective, what is your view if you compare India to maybe a comparable market in the emerging market basket somewhere else?
Okay, if you look at investment in real estate from a foreign institutional perspective, it's actually slowed down tremendously. It had touched close to between $8 to $9 billion in 2007. It's just touching about $1 billion right now for 2013. There's multiple reasons for it. One is to do with sentiment. So I won't go to that. Sentiments can change the perception and the confidence that investors would have to build. Second is historically, for investments made during 2005, 2006, 2007, investors have not had a great experience, and the experience kind of relates to some of the factors that Mr. Mantri, Mr. Mistry and Gaurav spoke to. Because there is a lot of uncertainty, there's a lot of regulations in this market, there's a lot of unpredictability, right? I would, since we are sitting in the Bombay Stock Exchange, I would kind of compare it to the kind of uncertainty people felt when, the stock market opened up for foreign institutional investors in 1991, 92, and in the first wave, when foreign investors came in, you know, one of my first projects as an MBA student was to look at how to reduce objections. You know, because there was a whole lot of shares that went out and got objections under registration. That doesn't exist today. That doesn't exist today. I mean, and I remember as a student reading through a book that had close to 105 rules on how shares can come under objection. I don't think that book will probably be in the BSc museum right now. So if you look at from a long-term perspective, I see these hurdles kind of moving away. I see the markets demanding one point, but true demand can only come with those changes. And if you look at each sector, if you look at the commercial sector, like has been mentioned before, there is an oversupply, especially in markets like huge undersupply in 2007, 2008. Taking that into account, a lot of construction went into hospitality. Today we are sitting in an oversupply in most major markets. That would again change once economic activity increases. If you look at residential, that's a very interesting sector. Huge demand, and in some markets we still, government takes steps to address land, unlocking land, clearing up regulations. That will continue to have a problem with price. And the last is retail. I think retail is one sector that you know, people are kind of ignoring right now. But I see a lot of activity. But with multi-brand retail opening up, while there's still some confusion on, you know, the clarity on whether they will be allowed in certain states or not, I see a lot of markets. So those would be good assets to look at if you're looking at it from an investment perspective, especially people who hold it.
Right. Mr. Mistry, in fact, आपका view इस पे क्या है? Because there has been a lot of debate, and to some extent there was disappointment also about the stand that BJP has taken as far as power, or they don't.
As I explained to you in the beginning, and this is, whilst I agree with what everything Shehzad said, I don't entirely agree with one thing, which is on interest rates. So the mention, and we try to correlate interest rates and demand for housing loans, and therefore logically demand for housing, we have not seen that correlation. For example, if you take that on a much, much larger base, and this was at a time when interest rates were high. So I don't think interest rates per se makes that much difference in a person's decision to buy a house, particularly the middle income category. Because for them a house is the most important possession. If the family likes the house, if they like the house, if the house is affordable, if the people will still buy the house, and the job is stable, people will still buy the house irrespective whether rates are high or low. And people generally prefer to take floating rate loans, so even if rates are high at the time you take the loan, you will get the benefit of falling rates whenever rates come down. So that's as far as housing is concerned. As far as the real estate sector is concerned, I think whilst the residential market will continue, in my view, to keep growing, the commercial market is very, very closely linked to the state of the economy. So if the economic growth picks up, if the investment cycle, basically it's investment, people start creating new facilities, if that happens, demand for commercial real estate will pick up. Commercial real estate prices have come down, and come down a lot in the last 5 years. That can pick up sharply if we have a stable government at the center.
Mr. Gupta, this question is for you. ये जो oversupply की बात की, जो ने भी बात कही है, your view on that, and second, you know, the lower end of the spectrum or the lower margin segment जिसे कहते हैं, typically the affordable housing or the redevelopment market where you are present, and you have in fact also attracted PE funding in some of your projects. What is the ground reality here at this point?
I'll first answer the oversupply section which you talked about. If you look at Bombay, you know, there's a lot of media reports specifically that's, you know, there's a lot of oversupply. I think oversupply is there in a typical product. You know, if you talk about luxury housing as such, which I told you, historically in Bombay, you know, houses which were built were generally big in sizes, you know, 1500 or 2 BHK or 2000, or probably, you know, we didn't even have those ranges. We had more of a 3 and 4 BHKs which were historically built. So if you look at it, you know, I think there is a bit of competition when it comes to luxury products, because what has happened is typically maximum of the luxury products have been built in central Bombay. Now if you look at central Bombay, typically you have the lower Parel belt and you have the Worli belt. So I think it's more at the lower Parel belt, you know, where historically being closer to South Bombay, you know, developers thought, you know, that historically lower Parel was a commercial area. But with the slowdown in commercials, people started building, larger units out there, thinking close to South Bombay, closer proximity. So, even that can sell since commercial had slowed down. But if you look at it, if you take a prime area like Worli, or any prime area like a Nepean Road on an Altamont, if you build the right luxury product out there, I don't think there's an oversupply out there. You are seeing transactions taking place. So I think it's a mix of the product. So it's a problem of the product mix typically. Because you build the wrong product at the wrong location, that's the reason for an oversupply in those particular areas. Going ahead, like I mentioned, ticket sizes in Bombay will drastically reduce. You will see 1 and 2 BHKs coming in, typically 1 BHK in the range of 700, 650 square feet, or 2 BHK coming in with a 952 and 1100 square feet. So I think with these reduced unit sizes, your affordability levels will drastically come down. Today you get nothing in Bombay. If you talk about municipal limits, less than 170, 180, you don't get anything. I think with this you'll start getting new products in the range of 80 lakhs, maybe 1 crore 25 lakhs, 1 crore 40 lakhs, or 2 BHK. So I think with that, supply, the demand supply mismatch, there's a huge mismatch. For an affordable ticket size in Bombay, there is huge demand. Like maybe Mr. Mistry said, residential is not a problem typically. And when it comes to the redevelopment sector, I think redevelopment is a mode of acquisition of land in Bombay, because that's the only way where you can get supply in Bombay. If you look at Bombay, typically, whatever mill lands are there, I think they'll be absorbed with the kind of land valuations which exist today. Over the next maybe 3 to 5 years, the remaining land parcels will also be absorbed. So I think the only way Bombay can get supply, is by the entire city breaking down and being rebuilt over the next 15 to 20 years. So I think we talk about financing in redevelopment space. I think redevelopment space, I think there's a lack of, professional developers available in this space. So I think if you are able to do good work, you have a good track record, I think there's no shortage of finance available for this particular sector.
Right. Mr. Mistry, in fact, a view from you, and then Mr. Mantri can add to that. ये जो luxury projects की बात हो रही है, now, you open any newspaper, or you travel on any artery road, be it Eastern Express Highway or Western Express Highway, most of the hoardings that you come across, immaterial of whether project is in Worli or Wadala or 60, 70, 80 kilometers from Bombay, even places like Palghar and all. The typical USP of the project would be, super luxury living. And I mean, is there a disconnect somewhere? Because frankly, a normal middle class working person, who is my viewer or the business viewer,
I guess what the developers are building reflects, and all the stuff that goes with it, better quality construction and so on and so forth. But that is not the only market. The bigger market is for middle income, salaried employees wanting to buy a house for their own use. Take our own case. Our average loan amount on a pan-India basis is of 35 lakhs, all India. Now if you were to look at Mumbai in particular, our average loan amount in Mumbai might be between 35 and 40 lakhs. So you're looking at a property which is costing around 60, 65, 70 lakhs. Now obviously these are not properties south of Borivali. These are all properties in the distant outskirts of the city, which is where the markets are strong. So you are looking at a few projects here in central Bombay or in metropolitan Mumbai, south of the airport, south of Andheri, and blowing that up. But reality, the growth is not there. The growth is all coming in the outskirts.
Mr. Mantri, your turn now. Maybe you can throw a better perspective from a developer perspective. This for in Wadala or maybe in Virar, but it is being labeled as luxury product, and a lot of the things that you see, swimming pool, clubhouse, and things like that. But a question that you get from viewer, what is your reply on that?
I think when we market the project, any developer market the project, I think what he is going to provide within the campus or within the actually, second point also you mentioned that whether the clubhouse or swimming pool or those amenities is a real luxury or it's a common one. I believe we are trying to provide a pool as well as clubhouse in that. So I think those days or those concepts have gone. Now the developer's job is to create these things and hand over to the society. As you know, the law is clear. Within 4 months, we need to form the society and hand over to them, who can maintain the campus very well. Of course, the people have to pay the price for that, because nothing will come free. And as far as you have mentioned that there may not be road, there may not be water, there may not be a proper connectivity, or there may not be to bring the infra up to their project. Even you'll be surprised if you need an electric connection and we may need to bring 10 kilometers away. That is at our cost and expenses. So I think eventually we expect government to improve on the infra factor. Ultimately they collect a huge revenue. You must have seen the figure spent in creating the infra, and if the infra is done, I think it will be a good life, people who are going to buy those kind of the properties.
Right. Shahzad, you want to counter what Mr. Mistry just mentioned in his previous answer, in fact the last one, that bringing down interest rates may not really help improving the demand, and it's a much broader subject rather than linking it directly only to
I said that any item which is big, which is impacted by various factors, including confidence, including, a loan. No, I have no contention on that factor, right? It's obviously not one factor alone which drives, demand, and any investment, even stock market investment, is primarily a function of confidence to a great extent. Not primarily a function, to a great extent it's driven by that. That interest rate is just one of them. So, no issue on that.
So what we'll do is we have last 10 minutes. So I'll start taking closing remarks, and then Mr. Mistry can maybe wind up the session. Mr. Joe, if you can give your closing remarks, and what is your outlook as far as next 1 year or 2 years are concerned?
Of course, it's a given that things would only improve from a sentiment perspective if there is a stable government in a few areas, which will improve confidence even further and increase commercial activity. And they are in the areas of having clear policies with relation to retail, and in the area of residence. I think bringing regulation into real estate, giving industry status that Mr. Mantri spoke about, all would have very but today's regulations do not allow for foreign investors to pick that up. So introducing the regulation for REITs, which is pending right now, would also
rightly mentioned, a stable government is very, very important. I think with a stable government coming in, and even Mr. Mistry added, it will make a huge impact across, I think, which has been sanctioned by the President. So I think that bill coming in, will give a lot of confidence and a lot of protection also, I think, to the consumers. However, as real estate developers, we would have liked, if some accountability would have been there for the, that's what we can expect.
Mr. Mantri, आप इस पे add करना चाहेंगे? This one is improving transparency, second is regulatory bill, and third from the system that itself can release a lot of stress in the system and reduce the prices also to that extent.
No, 100 Cs are out of the regulatory bill. So I think one way government want to bring more and more regulation on a private sector or the developers community, who gives the permission, for example roads, water, drainage, sewage, electricity, or any connectivity, I think they have to be brought under the regulatory regime. And unless until one point you asked, what is our wish list? I think whichever the new government come in power, I think they should target themselves for 10%. Everyone work in that single direction, so that it will help to create the jobs, employment will be there, FDIs will come, and it will give lot of issues which is confident percent, and that is possible. This is doable. Something impractical thing I'm not talking. It is possible. Only they need to improve. They need to themselves behave in a proper fashion.
You're listening. No, you. Shahzad, so क्या आपकी war chest is ready for once the new government comes in, maybe to lend more, to fund more to all the projects?
See, as financiers, and that's financiers and investors, which is what we are in that sense, most times are reasonably good times for us. Stress to, if we've ridden out the stress, it's okay for us. One cannot but be bullish for a long term over the country. See, I mean, we've obviously not had a very pleasant last few years, but longer term, I mean, it's difficult not to be optimistic or not to be bullish about this country. So certainly one is optimistic. We look forward to a lot more investing, funding opportunities, and as any market grows and develops, and more participation. So I'm sure everything would sort itself out, and when we hopefully meet, assuming I'm invited here, at least we.
I think both of you can have off-cam meeting once we are done.
Sure.
Yes, Mr. Mistry, closing remarks from you, because no one can gauge the pulse of this sector better than you, and also like Mr.
I agree entirely. I see no reason to believe, and I honestly mean it, that if we have a stable government at the center, that we cannot get to a 10% GDP growth in, say, 5 years or 6 years' time. We obviously cannot get this time, bring in GDP numbers. So I have no doubt in my mind that with a strong, stable government at the center, I see no reason why we can't get close to a 10% growth in 5 to 6 years' time. But coming to just getting a pickup in the investment cycle, and a strong government will bring in that confidence. I had a couple of points which I thought I would make. One is that if we really want to look at the long-term view and make housing more affordable to more and more people, two things we need to do. One is we have to make some reforms around land. We have to make land available at a lower price. And the second is around what both Sunil and Gaurav talked about, which is on the process of granting approvals for projects. Time to get the approval, and the long time is really a long time. Then it adds to project cost, and ultimately the developer is not going to bear that cost himself. He's going to pass it on to the consumer. Land. And just two statistics which I thought would be interesting. It says here that it is estimated that the 10 largest cities in India produce 50. Statistics here is that if you look at the top 100 cities in India, they collectively produce 43% of the GDP with 16% of the population, but only utilize build their infrastructure, create more cities. That is really what will bring prices down in the long term.
All right, sir, thank you. So with this, time I think lunch will be served now. So thank you, gentlemen. Thank you, all of you. Thanks for joining.
A big thank you to all our speakers. Mr. Mihir Bhatt, Chief Z Business. The audience is please requested to sit down. Mr. K.K. Mistry, Vice Chairman and CEO HDFC. Mr. Sunil Mantri, Chairman Mantri Realty. Mr. Gaurav Gupta, Director Omkar Realtors, Colliers International. And Mr. Shahzad Madin, Head PMS and Alternative Assets, Reliance Capital. I now request our panelists to pose for a photograph. The next session will resume at 1:30. If we say that, it will come early. The next session would resume at 2 o'clock. The guests are requested to take their seats.
Specifically, when rupee depreciates, importers will come rushing to the market to cover its import payables. Exporters would try to watch on the fence, waiting for not booking its contract or deferring its payment. So when receivables which are supposed to come in do not come in, and payables which are supposed to go after a lag go today, it creates a pressure on the market. It creates on the existing pool of resources in the market. It was actually happening that. And hence, booking and cancellation of the forward contract was adding to this pressure. What we did, we restricted the market to the actual contracts, and we said all forward contracts would be on delivery basis. And we also put certain restrictions on booking of forward contracts on the basis of past performance. Yes, I understand the corporates might have been hot because there are exporters who have obviously past performance and may not have been able to estimate this next year's requirement. So for them, some amount of past performance is desirable. So to facilitate them, and not to hurt the business, we allowed certain extent of past performance, but we said whatever contracts are booked on past performance basis, they must be delivered. And all contracts must be delivered. That was basically, you might say that it's kind of a draconian step or a very harsh step, but that was at that point of time, possibly, it cools down or the temper of the market, or it tried to cool down the augmented volatility that was existing in the market. Similarly, we took some steps on the EFC front. Since people were parking resources in the EFC account and still going to the market and buying dollars and making remittances for their import requirement, those front, we said EFC account is like a current account. It must be used for your own use. It cannot be kept or treated like a capital account and a deposit and still you access the market. Because accessing market, keeping a pool of resources aside was actually putting pressure on the market. So there also we took certain steps and we rationalized the operations in EFC account. But in 2013, the most actions were actually in the area of gold. There have been representations, there have been issues. We are trying to sort out the issues. But broadly what we have done, this is a joint effort by the government and by the Reserve Bank. Government has increased certain duties on gold, on import of gold. Government has placed certain restriction on import of gold. In addition, what we have done, we have linked the imports of gold to the exports of gold. Certain amounts of gold can be imported if X amount can be exported. So the what you call so-called 20-80 principle, that out of any 100 tons of gold, 20 tons must be exported and 80 tons must be available for the domestic jewelers and domestic market. This quantitative restriction basically reduced actually the actual import of gold. Possibly this quantitative restriction might have hurt some domestic jewelers, because what was happening earlier, jewelers used to import gold on consignment basis. They used to procure golds from the banks on consignment basis. We put a restriction saying that no gold can be imported on consignment basis, and all gold payments or all payments for gold by the gold jewelers must be paid upfront. These are certain restrictions which have actually worked, but I would not say that these are that they can work on long term, because no administrative measure is actually a long term measure. After certain time, you find ways out to beat the administrative measures. So similarly, although we imposed restrictions on booking and cancellation of forward contract, we found that no more market is abiding by their very principle. No, there is no transaction, all right, but market still creates volatility because this restriction itself creates some kind of illiquidity in the market. So not all administrative measures are long-term measures. Hence, these administrative measures must be supplemented by other measures. So during this period, we tweaked the capital account management framework, specifically in the realm of foreign direct investment, in the realm of portfolio investment, and in the realm of external commercial borrowing. In the foreign direct investment, the government, if you remember, the government relaxed the norms for multi-brand retail, for single retail, for power exchanges, for defense sector, for insurance sector. Certain sectors were still put on approval route, certain sectors were on the automatic route, but certain sectoral caps were relaxed. In addition to relaxing certain sectoral caps, in the debt segment, specifically in the portfolio segment, we found that there is quite good interest in the portfolio investors, foreign portfolio investors, for investing in the debt segment of the market. And also from our interactions with many central banks, many long-term investors, we found that there is a sizable long-term interest in Indian securities or in Indian debt. Hence, what we did, we allowed $30 billion as a limit for the government securities. Out of the $30 billion, at least $10 billion has been earmarked for the long-term investors. Who are the long-term investors? Pension funds, sovereign wealth fund, provident funds, gratuity funds, central banks, sovereign wealth fund, all these entities which are long-term investors in a country and who have a durable interest in India. We have facilitated them by creating a larger pool of resources for these kind of fund managers. Further, in the very recent monetary policy, we have announced that we will taper off the treasury bills and government securities of less than maturity of 1 year duration, and any investor keen to invest in India can invest in the dated securities of maturity of 1 year and above. This has been actually done to create a long-term durable interest in India and to develop an interest in the long-term securities market in India. Similarly, earlier also, sometimes in April, we brought down the limits of foreign investors in CPs and confined it to $2 billion. Now, this is basically about the foreign investors and about the foreign direct investment. There is another way. The corporates generally augment their resources. That is by way of a loan from the foreign bankers or from foreign financial institutions, what you call external commercial borrowing. Today, we have generally the philosophy of the government and the Reserve Bank is that the foreign flows through equities is most preferable, and next in hierarchy, portfolio flows in through equity, because what happens in equity, whether it is FDI or portfolio, the foreign investors take part in the company's interest, take part in the growth of prospect of the companies. If the company does well, which is reflected in the market price of the share, the portfolio investor gains, stands to benefit. If the company doesn't do well, the portfolio investor loses. So the portfolio investor partakes both in the benefits and in the losses of the company, and it grows with the company. Whereas in case of debt segment, there is an assured return, and this assured return becomes very pronounced when interest rate differentials are very, very large between two economies. And yes, give me 2 more minutes. Yeah. So in its essence is that what we wanted to say, that we wanted external commercial borrowings, we wanted external commercial loans, but we wanted that these loans should be long-term loans, so that the immediate payment pressure on the Indian foreign exchange market is not felt, and so that it doesn't create stress in the external debt profile of the country. Today, if you understand the numbers, India's investment profile is very negative, where our reserves are around $300 billion, our IIP is negative $360 billion. So that means our assets and liabilities are not in sync, and there is a pressure point which might aggravate. So keeping in view, from the standpoint of financial stability or macroeconomic stability, we allow external commercial borrowing to supplement the domestic corporate resources, but at the same time we want that these external commercial borrowings must be of long duration or long term. Some more measures we have taken to augment the resources and also the reserve. Specifically 2 points they stand out. One, the FCNRB resources which were mobilized to the extent of $26 billion through banks by receiving or at 3.5%, it involves some sacrifice. When the swap was done, or FCNRB swap was done at 3.5%, the swap premium possibly in the market were 7%. So that means there was a sacrifice which involved up to 3.5%. But because of this sacrifice, we could mobilize $26 billion worth of foreign currencies, which has bolstered partly our reserve. Similarly, also we facilitated banks to borrow from abroad to tide over the crisis and make foreign resources available to the domestic corporates, and that also mobilized something like $8 billion. And these two policies, or these two things taken together, the FCNRB swap and the OFCB swap, or overseas foreign currency borrowing, which were swapped again with RBI at 100%, 100 basis point below the market rate. These two attempts or two initiatives garnered at least $34 billion. And these initiatives provided not only cushion to us, it provided comfort to the market. Things have started moving better and looking better, and possibly these steps which have been taken in the last few months, despite gyrations in the Eurozones, despite turbulence in some markets, despite Turkey, Brazil, Indonesia still suffering, India has outperformed because of these administrative steps and because of certain monetary policy steps that we have taken to tackle the volatility or undue volatility or large volatility in our foreign market. We have come back to certain stability. Thank you very much.
Thank you, sir. It's a candid summary of all the actions that have been taken by RBI. Possibly one of the worst crises in the economic history of India that we saw in possibly August 2013. Actually, the resolve with which the government and the RBI pulled the country back from the brink of disaster, actually, it deserves applause. From being bracketed as a fragile five, now we are one of the fabulous five. That is where we are. Now, actually, possibly this candid summary of CAR, actually, it sets a backdrop for our panel discussion. First, we will have the views of the panelists, and then we will simultaneously have the questions also. Now, first, I am very happy to introduce Mr. N.S. Venkatesh, CGM and Head of Treasury, IDBI Bank Limited. He has vast experience in banking, possibly everybody knows him, and without wasting much of his time, we will get into hearing his views, on the currency, possibly the direction that the currency could take. I think it's a tough question, but of course. And then possibly, what could be his advice for the real money hedgers? Because speculators and traders, naturally, they escape all the episodes of volatility, whereas the real money guys, they get stuck at the bottom of the cycle or at the peak of the cycle. So what is his advice for the real money hedgers?
Good evening. At the outset, let me thank IMC for giving me a chance to be on this panel. Thanks Ms. Dina Mehta and Asit Mehta. Sitting in this distinguished panel with Mr. Kar, Tyagarajan, David, Venkateshan and Sandeep, it really gives me an immense pleasure to be here. I do agree with what Mr. Tyagarajan, he is favourably called as Tyagu in the market. And what he has said about the crisis, I think it is something which is which has hit the markets, which has hit the nation completely. The previous thing which we could have seen was could be the balance of payment crisis. That was one of those crises. But in both occasions, the Reserve Bank had really worked hard to stabilize the ship and then maybe steer it in the right course. I would personally know about Mr. Kar in the sense that the sleepless nights that these people have really worked during the currency period. We have moved from bricks to mints to bits, like what he said about the fragile five to the fabulous five. We are one of the fabulous countries. That the way in which the currency crisis had evolved based on the current account deficit and the fiscal deficit, they could manage it well. The proactive actions taken by the Reserve Bank brought a lot of sense and stability into the market. And then we are now in a situation where you are seeing money flowing into the country in leaps and bounds, which could be a problem of plenty, maybe going into the May 16th. the way that we had seen this during the currency unfolding and the steps that has been taken by the central bank as well as with the government doing the import compression of gold, and the central bank coming out with the FCNRB swap scheme as well as the interbank scheme really brought a lot of valuable resources to this country, which gave confidence in the sense that this currency crisis could be weathered. That is where the outside investors, the outside speculators could understand that as there is an armory which has been built up which could stand them in the hour of need. The cost to that armory, that could be debated, but that personally I would feel that it has come at a very, very reasonable cost when you are looking at it and weighing it against the public good of this country. As a banker, I would say that we also felt into that or felt that tremors so badly, in the sense that as a banking system we really found that most of the corporates, especially the SME, the mid-segment corporates who didn't have those sort of high-profile treasury management at their disposal, they were suffering in the sense that essentially the unhedged exposures were coming home to roost. The buyer's credits, which is the very cheapest sort of credit which used to be available by the corporates, the mid-corporates, they had not hedged it because they thought that, okay, it is an easy money, cheap money coming in. So they were trying to take the interest rate differential, forgetting that there is an exchange risk which could come and hit them, and the exchange risk really came and hit them. But from there, we are seeing from 68 to 60 today, that means somewhere around 13% appreciation of the currency that has happened. When you look at our peers, the emerging market economy, the other countries are still suffering. So to that much extent, I would say that India as an economy is able to weather the storm, and we are actually looking forward to actually taking more and more proactive steps. Some of the steps, in any case, one is essentially the for the small segment from $1.5 lakh to $2 lakh. That has been a liberalization which has come to $1.5 lakh. So those sort of things have happened. The currency futures exchange, which used to be very vibrant, there also the margins have been now relaxed based on the recommendations of RBI by SEBI. So to that much extent, we should see more activity there. The FIIs coming in to hedge, maybe even the recent announcement of their one-year coupon to be hedged, that will also bring in much more activity into the currency market. But I would only say that if the FIIs have to completely come into the currency futures market and hedge, then it cannot be a one-way in the sense that only one person coming and buying. So on the opposite side, maybe the bankers who are the counterbalancing for that, they should be allowed to be there. So to that much extent, maybe we should see as things progresses, we should see more and more relaxations which could happen from the central bank side, because they have been very proactive in relaxing the conditions based on how the macroeconomic factors are panning out. My advice is this unhedged exposure is definitely a major worry for not only for the banks, I would say, it is also a major worry for the corporates themselves. Two of the largest corporates are sitting here. The largest corporate treasury in this country is here with Thiago sitting here. They have the necessary risk management capabilities, the TCS or the Reliance. They will be able to definitely manage. But it is actually the mid-segment, the small segment, they do not have the wherewithal. They get into an issue of, again, maybe falling into the trap and again having an unhedged exposure with them, which could come and hit them. So I would only say that maybe as a sort of friendly advice to the SMEs and the mid segments, they should look at hedging, because they are there to actually make money from the product that they buy and sell, or manufacture and sell. They are not there to make money from the exchange rate sort of thing. The expertise is not there. The entrepreneurial skill which is there with them is for actually understanding the markets to which they are going to sell, and also understanding the markets from where they are going to source their raw materials, so they are able to actually make a profit margin on that. So they should lock in onto that profit margin at the time itself and not open themselves to fluctuations in the exchange market, which actually moves without, I would say, any rhyme or reason, because you will not know why it is moving. Today it could be 60, tomorrow it could be 62, you do not know, or it could be 58. Because it depends on the flows that come into the market. And the flows can come into the market depending upon different parties' needs. So I would always say as a friendly advice that they should hedge and they should actually lock in onto their profit. Just like you should look at it as if it's a return on investments that you are trying to do. When you invest, you will look for an investment return. So if that return is more than your cost of capital, then you definitely take that IRR and say that as this is the right time to invest. So the same way you should look at the cost of hedging, and if the cost of hedging is reasonably okay, then you should definitely hedge. If you don't hedge, then you will have sleepless nights, and you could actually see your entire net worth getting wiped off. And then it becomes a credit issue for the bank. And then that is where RBI is coming out and saying, you please ensure that the corporates to whom you have lent, if they have an unhedged exposure, you please ensure that they are hedging it, or otherwise you please charge them more for that risk premium that you are taking. So I would that's a friendly sort of advice that I would say. The markets in which we tap, like whether it is Exim or myself or even the corporate sitting here, Reliance and TCS, the markets we tap different markets. Whether it is the dollar, USD, or the Singapore dollar, or the, let us say, the Aussie dollar or the CHF, we keep on doing that. But as banks, as financial institutions, as well as the large corporates, we definitely hedge it. It is not as if we do not hedge it. If, let us say, I see an opportunity of actually raising money in CNH, the dim sum market, which is going to cost me lesser than the dollar bond which I would issue, I would definitely take it in the CNH. But I may not have an use for the CNH, but I would definitely convert that into the dollar in which I will be lending. So as a bank, as an institution where we are all trying to hedge, you as a corporate should also look at it and then try and hedge. Otherwise, your volatility in your income stream could be very high. In 1 year, your other income could be very high, so that, okay, you show huge profits and pay the tax. And the next year, you will actually find that, okay, your losses from the exchange rate depreciation will come and hit you very badly. So I would always say that we need to look at it from that angle. The country has really weathered the storm due to the real proactive steps taken by RBI as well as the central government. And we are now looking at a situation where there is a great rotation which is happening, in the sense that the money that is coming into India is actually coming from various other markets, whether it is, let us say, the China, where China is slowing down. So they are now looking at, the investors want to put money and get, like what Mr. Carr was saying, that interstate arbitrage, in the sense that there's a carry trade which is happening. So I think that is where, if the currency is stable, you will see more carry trades happening. And if you look at it now, it is more or less, currency is very, very stable over the last 1.5 months. So if the volatility is reduced, then to that much extent, the carry trades will keep on coming into this market, and you will actually see more flows coming into this market. And if flows come in, our market, if you look at it, our market is what? An average daily turnover of somewhere around 50, 55, 60 billion dollars. And if flows of somewhere around $1 to $2 billion comes in the morning or in the evening, it really distorts the market. So I would always say that please be careful as corporates, please hedge your exposures and take a view based on that hedge. Thank you.
Thanks so much, Mr. Venkatesh. Actually, there is only a thin line that separates hedging from speculation, actually. What happens, actually, in exuberant times, we all speculate. In depressing times, we all hedge. It should be other way around. But normally it doesn't happen. So even the exuberant times right now running, actually Mr. Venkatesh has given a very sound advice. I think some of you who want to hear that, possibly I think you take home some real advice. Now I will bring on Mr. David, who is the Chief Operating Officer of the Exim Bank, with vast experience. And my question to you, Mr. David, how much of this currency depreciation has helped contain the trade deficit, A, and the current account compression that we have seen now, whether it is going to last its course over the year 2014-15.
Mr. Tyagarajan, Mr. Kar, Mr. Venkatesh, Mr. Venkateshan, Mr. Basu, Ms. Mehta, Mr. Friends, Mr. Tyagarajan may be near to retirement or not, I don't know, but he is a very tough chairman. He has given us the subject and he has said 5 minutes each. But he has very kindly narrowed the subject from currency fluctuations to a very specific question, so I should be able to answer it in the 4.5 minutes that I have left. Now, the answer, I think, is that yes, there is definitely a correlation which has been established between the growth in exports and the depreciation of the rupee. If you see the monthly numbers of the exports and the trade deficit which have happened during the current year, and you lag those figures by about a couple of months, you can find that the movement in exports almost exactly reflects the movement in the exchange rate. So the short answer is yes, the depreciation of the rupee has helped the compression of the trade deficit. The second part of the question is tougher. How is this going to act in the future? Now for this we need to really look at the composition of India's exports and India's imports, and there are some very harsh lessons awaiting us over there. Take exports first of all. Exports in the last 2 completed years, I'm not talking of March 14, but year ended March 12 and March 13, exports were about $306 billion and $300 billion. In the current year, perhaps 300 to 310. So on the face of it, you'd see a very flat line on exports. That is, I think, a bit unfair. Our exporters have done an excellent job in a situation where global markets have been contracting and the demand for their products has been less. But that is the top line. Drill down into the figures, and I'll give you 3 commodities: agriculture and allied products, petroleum products, gems and jewelry. These 3, if you look at the last year's numbers, of the total exports of about $300 billion, these 3 figures accounted for almost 145. So almost half your exports are of these 3 areas. And why am I listing these 3? Because basically they are commodities. Your pricing power on agricultural products, your pricing power on petroleum products, Mr. Tyagarajan, I hope I'm not making a faux pas over here, and your pricing power on gems and jewelry are always going to be limited. The same for textiles, which is another big component of our basket. So here a short change in the exchange rate will mean an immediate rise in competitiveness on exports. But correspondingly, an appreciation, or I would put it in a different way, the depreciation not keeping pace with the inflation differential will immediately harm the competitiveness of Indian exporters because of the fact that these are commodity markets and the level of value addition, at least in the area of agriculture and gems and jewelry, is substantially less. Look on the other side of the equation, that is the import numbers. If you see the area of manufactured goods, and obviously manufactured goods is a key matter for India's economic growth, India consistently runs a deficit on manufactured goods, and that is linked also with the slowdown in manufacturing, with manufacturing accounting for a very small portion of our GDP. Take capital goods alone, or in the total manufactured sector, and we run a heavy deficit. If I look at capital goods, I'm taking HS codes 84 and 85, and I just look at capital goods, our trade deficit last year was $45 billion US. In other words, 1/6 of the total exports, almost 1/5 of the total trade deficit, and 50% of the current account deficit was caused by capital good imports. Why is this important? Because again the terms of trade matter. If we are going to have a surplus on manufactured trade, on manufactured items, then the terms of trade are in our favor and an exchange rate movement is not going to harm us. But conversely, if we do not have a surplus on manufactured exports or value-added items, and our surplus really comes from commodity items, then a exchange rate movement is always going to hurt the exporter. And this is a point which I think in the Indian economy needs to be established, that the very composition of our export basket and import basket needs to be adjusted to take into account price competitiveness and thereafter the impact on the trade deficit. That was the quick answer to Mr. Tyagarajan's question, but I'd like to dwell a little further on something which Mr. Venkatesh also mentioned. And this is the area of how do you address the impact of the trade, of the exchange rate movements. I've tried to demonstrate why the exchange rate movement can be good and sometimes can be bad. But what does an Indian exporter do about it? Now, what hurts here is not the movement but the volatility, and here the Reserve Bank in fact has made it a point to clearly announce to the market that it is not targeting a specific level for the rupee, but rather looking at minimizing volatility. Because ultimately it is volatility which hurts the exporter, it is volatility which leads to his overseas customer demanding changes in negotiated price contracts by pointing to a volatile exchange rate. And going as Mr. Venkatesh said, I can only re-emphasize the point that he made. We are sitting here in what used to be the BSE's trading ring or the trading rotunda some time back. So I think it's very apt for what I'm going to say. You cannot beat the market. You can beat it for a few days, a few months, a few times, but you cannot beat the market long term. Please leave that to the professionals. Leave it to the people who have the capabilities to address hedging, the capabilities to take risk, the balance sheet to sustain that risk. The average exporter, if you're in the business of textiles, please make your money from the margin on textiles. If you're exporting auto components, please make your money on the margin from auto components. Please hedge your receivables and of course on the import side your payables as soon as possible. As Mr. Venkateshan said, you will not lose sleep. More importantly, you will protect the long-term sustainable interest of your business. I think the history books of economics in India are filled with cases of companies which have engaged in derivatives, which have engaged in exotic transactions with the effect or with the intention of securing a short-term advantage, or sometimes because of pure panic. As I would say again, there is no free lunch. A derivative which appears to have no charge for it on the face of it, there is a price, and the bill will come due. It may not come due today, it may not come due tomorrow, it may come 1 year down the line, but that bill will come and you will have to pay the bill. So please, I would reinforce what Mr. Venkatesh said. Do not rely on exchange rate volatility to make your money. By all means, build up your long-term competence, build up your composition of your export basket and your import basket so that you're less subject to the vagaries of the exchange rate, but always, always hedge. I hope I've answered your question, sir. And I've completed within my 4.5 minutes, so thank you very much.
Of course, we would love to hear you as much as we can, actually. Unfortunately, but of course, possibly the best explanation that I have ever had on the elasticity of the trade deficit with that of rupee, actually, exchange rate, actually. Possibly at some point in time, actually, there is an exchange rate elasticity with exports and vis-a-vis imports, and possibly that we have seen in the last few months. Possibly going forward, when the growth picks up, what happens to the imports? That's a moot question. Now I bring on Mr. T. Venkateshan of TCS Treasury, possibly of course, the largest capitalization with significant software revenues. And I would like to ask him about what is the kind of hedging strategies that they adopt for being so successful, so consistently, and and what is the outlook on the service exports, basically the second half of invisibles that we are discussing. What is the outlook for services exports, say in 2014-15?
Thanks, Thiago. And hello, everybody. And probably Thiago has asked me to talk about the hedging strategies, what we adopt. That is to insist on the point what other two members have been telling. As a corporates or SME, MSMEs, what you need to do. Basically, before going to what we can do or what we are doing, I'm prohibited from what I can do to be divulged, but what you people can do that I can say, what exactly. If you look at the hedging strategy, it is not same across all the verticals, all the industries, or within the same industry across all the corporates itself. It differs from company to company depending upon the philosophy, management philosophy of the company itself. Okay, how they want to do it. If they have a treasury, they want to have a treasury as a profit center or as a cost center. From that, actually, the hedging strategy comes down. In case of a cost center, then probably what Mr. David and Mr. Venkatesh have been saying, please hedge everything as long as your cost plus your planned profit is protected. Hedge everything. This is how we are doing. And if you look at the profit center, yes, normally when they have considered as a profit center, they have a proper risk management policy in place and risk parameters being placed, which is kept monitored every moment, and they stick on to that one. Normally looking at these things, like looking at profit center or whatever it is, okay, other people should not get enthused or enticed to get into such trades. Because when somebody is doing that one, they have all sorts of infrastructure in place and then do it. Probably the information what we get from bankers, there will be a lag of few seconds. But as a MSME, you might not be getting that one. You might be getting after a few minutes, or it can go even after hours also. By the time you just try to cover, you may not be getting the level itself. Okay. So this is one thing which I want to make it clear. And whatever strategy you following as far as hedging is concerned, whether it is a static hedging or a rolling hedging or your systematic or layered hedging or dynamic hedging, please do it follow in consistency. Just for sake of market moving from 65 to 69 in just say in the span of 3 days, don't keep changing it. Please be consistent with your strategy. That is going in a long term is going to help you a lot. Okay. Then coming back to the importers, the strategies for importers is something different from strategies for exporters. Even if you look at what is you are looking to hedge, or looking to hedge your forecast cash flows or your current cash flows, that you have to look at. When you are looking at hedging your crystallized cash flows, when talking about your payables or your receivables, be clear about what is need to protect. You have been given a mandate to protect your costs and ensure that is to protect that the level is protected and hedge. Then you can be very happy about that one. But if you are hedging for your forecast cash flows, probably for your revenue or expenses, which you may not be knowing now, but in future as a whole you'll be knowing later. In such a case, take a very considered call about hedging. Now looking at the current scenarios, what I can tell you is, in case of crystallized exposures, just depending upon your credit period, have a view on that period and hedge immediately. You can hedge either through a forward contracts. That is the best thing. At least you have you enjoy the forward points in case of an exporters, or in case of an importers, it becomes a cost for you. Okay. But if you have a better view and you want to be with the mark points in case of an exporters, or in case of an importers, it becomes a cost for you. Okay. But if you have a better view and you want to be with the market, then probably you can go for options. Either you can take a vanilla option if you feel that, okay, I don't have any view, but I know that this is what I want to protect. That better go for vanilla options. And if you look for any reduction in the cost, then probably you can get into risk reversals, buying a call, like whatever thinking, buying a put and selling a call, wherever you just participate along the market for certain extent and then give away the profit. This is, I can tell you, for the hedging your revenues. Okay. But when it comes to question of imports, looking at the current markets, I feel try to hedge whenever you find a dip, plus try to hedge for next couple of months, because the market is simply very, very volatile. There are a lot of euphoria going in, and people, especially with the background of Mr. Modi taking over as a Prime Minister, not only in India, even from overseas also, we keep looking at a lot of funds getting into India in equities and bonds. Okay. This be clear. Then coming back to the service sector, probably I can talk about the service sector, it's IT. See, FY 13-14 had been a very good, I won't say very good year, okay, but it had been almost the NASSCOM target has been met in FY 13-14. And if you look at FY 14-15, the NASSCOM has enhanced the growth rate to almost between 13 to 15%. And I'm sure with what we discussed with the different IT sector people, we find this is very much easily reachable. And if you look, what is that factors which is giving this sort of confidence to the IT sector is that if you look at almost the discretionary spending limit has been very, very much sustaining. And the second one is a lot of amounts, almost, if I remember, some 300 billion or something is getting into coming for renewal, legacy contracts getting renewal for this year. That's one thing. The third one is, along with US, Europe is also getting strengthened. Okay, we see a lot of opportunities in the Europe area, including UK. So these three factors is very much supporting the IT sector, especially in this year. And If you look at the other sectors, there are a lot of, I can talk about more than what we required for other sectors. I can see what are the barriers which is impeding this growth in these sectors is basically, if you look at, there is a if I enter service sector as a whole, there's no separate ministry. If you look at, they have been separately for, you have energy and telecommunication. But if you look at the retail, there's no separate. It comes under Commerce Ministry. And there have been a lot of multiple controls, either from state government or from the central government. These are the barriers which the service sector has been facing. The second and the next one, I can talk about the skill enhancement, skill availability. That's, we find it very, very difficult, especially in IT sector. In fact, many people, IT Hankos have said that if you look at only 13 to 14% of the people or engineers are employable in IT sector. Because if you look at, they have to spend additional time and cost in retraining them to get into their level. So this is one thing which the government has to look at it. And the third one is talking about the FDI. There have been lots of restrictions. FDI getting into service sector, of course, very, very, very controversial topic, which we will not be able to say in a minute or two. Okay. This is one thing.
Thanks, Venkatesh, for that lucid explanation. Now, actually, after having seen the trade account and then, of course, the invisibles, now we come to the bottom of the balance of payments, that is about capital flows. Now I would bring Mr. Sandeep Basu, who is an independent practitioner with a vast experience in global multinational banks, to tell us something about what he feels about the capital flows in 2014-15. Whether we are going to see some sort of a deluge of capital flows, or we are going to see some sort of a muted flow, just like, let's say, 12-13 or 13-14. Over to Basu.
Thanks, Tyagoo. Respected fellow panelists and dear friends. You know, the most beautiful part about speaking last is that just about everything that you wanted to say has already been covered. So please bear with me. So I think the short answer to Tyagoo's question is yes, the flows are going to be very strong in my humble opinion. But before just getting into that, if we can just take you through the factors which typically determine our flows. So the key macroeconomic indicators, starting with the current account deficit, the fiscal deficit on a consolidated basis, the inflation both on a CPI basis and WPI basis, as well as the GDP, all are showing signs of improvement. The biggest one being the current account deficit. So that's a good one. Next, is risk aversion on the rise? Now, risk aversion is a global phenomenon. What is risk aversion for India may not be risk aversion for Turkey or Indonesia. One indicator of risk aversion is yen depreciating. Now, those of you who've been following dollar yen, you've seen it go up from the mid 70s to the early hundreds over the last 2-3 years, and it's taken a pause there. And Japan is trying to come out of the 15-year deflation spiral that they're in, and they're now targeting inflation in a big way. Not targeting, they're trying to induce inflation in a big way. So we feel that risk aversion is not on the rise. Increasingly, the investors will take risks, and that's again good for the flows. People look at whether you have a proactive central bank, and I would say yes, not because Mr. Carr is sitting here, but yes, definitely we have one of the most respected and central banks across the world. Employment outlook on sectors, by and large positive. I was looking at a report from one of the large foreign banks on sectors across manufacturing, finance, mining and construction, retail, wholesale, etc. Services, which contribute more than 60% to our GDP. Everywhere the Q2 outlook is better than Q1. The overall sentiment, I mean PMI in both manufacturing and services indicate that the economy is bottomed out. The caveat is that if you look at the statements that are coming out from RBI, they are saying that the final indicators are not yet in place whether growth is on the upswing. Exchange rate volatility, 2013-14 was just to repeat the points made earlier, we've seen a 25% depreciation which we haven't seen for many years. between the high and the low. And between the year opening and the year end, we had seen a 9.5% plus depreciation. Compared to that, now most banks and the larger corporate houses, the gentlemen sitting here, most people are talking about 60 to 62 for the next few months. So that's again a huge help. Reserves to import ratio. Now, our reserves, from September have, especially the foreign currency assets, have gone up by about $3 billion every month. So it's probably touched not the reserves, but the FCA foreign currency assets have touched about 270 billion from 246 odd billion dollars. Now, in terms of import coverage, we had, I think, in July, August, 5 to 6 months of import coverage left. The import bill was also higher at that point of time. Today, I think we are back to some 11 or 12 months, which is again a huge plus. Interest rate differential, US between 2.5–3%, India 10-year G6 between 8.5–9.3%. And if the currency is going to stay stable, RBI has increased the debt limits for FIIs, both on G6 and corporate bonds and infrastructure bonds. So that should also be a plus. So overall, pluses everywhere. The only caveats, I would say on the other side are that if you look at the infrastructure sector and the power sector, they have not been doing well at all. The other not so good thing is that a lot of large respected corporate houses which you would not have thought of as potential CDR cases have now gone in for CDRs. They were excellent names 5 years ago. That's not a good thing for our economy. Many large groups are getting into real estate at the expense of their core businesses, which you could call it opportunistic, or you could say that the core sector is not doing so well. So to sum up, I think last year the flows were, I think FDI were around $20 odd billion, portfolio was about 26. The overall capital flows about $85 odd billion, the year that has just ended. And most banks are a little skeptical and they're talking about a lower number. But even if the number could be a little lower, but the balance of payment position I think will improve significantly. And just to sum up, I think we have a negligible current account deficit, we have a currency which is fairly competitive, and we have no sort of intractable sort of bubbles in the economy. Our NPAs are still about 1% of the GDP. So I'm very bullish, and thank you very much. Thanks.
Actually, thanks to you. Thanks, Sandeep. Actually, those are very reassuring words, so to say. Before we throw in for audience questions, I will like to ask Mr. Carr one small question actually. What was the feel in the war room in 2013 in RBI?
No, every day is a day. I would not say that, okay, we are basically unduly pessimistic or unduly euphoric. That actually is not a correct assessment. We are also human beings. The pressure, when it comes on you, you get worried. So we were no different. And then it is not exactly 2013, starting from 2007-8 till date. I have been, although I was in the market, in this department for last nearly 2 years, prior to that also I was in the government securities market department, the internal debt management department, where I had the responsibility of making the government debt management successful. With the rising fiscal deficit, rising commitment on the government, obviously the demand on borrowing, very sky high. So making this government borrowing program successful was actually even equally stiff challenge. So for last 5–6 years we have been seeing actually very tough time. But since every day there is some or other pressure, after some time you feel, okay, this is one of the day, you must find out some ways to handle it. So you can't just, what you can't gloss over, obviously you must take a call. So you take a call. It was a difficult time, but there's some learnings also. So we have some learning, some lessons we learned. One is actually, one lesson is the many problems which are cropping up are basically because of the behavior of our market participants. Like both Mr. Venkatesh and Mr. Sandeep explained, the behavior of the corporates in hedging their exposure. Obviously, we debate it very often, and we have debated very often, and I think almost all my colleagues who are with me and who participate in our financial market committee meetings and deliberations, everybody feels that it is the corporate's business to focus on their business profits and to focus on what they are best at. If they are running a business enterprise, they know how to run the business enterprise, they must do so and they must concentrate there. They should not trade on a currency which is not their domain. And thinking that there is a free lunch, of course there is no free lunch. Most of the times we interact with the corporates or in various forums, we find when we ask a question, why did you borrow? It is available, the loan is available cheap. Now, the basic question, whether a loan is available cheap for you. Nothing is cheap. You say that I take a dollar loan at LIBOR plus 180 or LIBOR plus let's say 350, and if you take a hedge for a 1 year hedge, it costs you something like 6.5 to 7%. So your cost of fund itself is 11%. By not hedging, what are you thinking? That you are thinking that we are kings of good times. That rupee remains at 54 or remains at 55, it doesn't change to 47 or 67. Many people who have come to grief, they have come to grief because they betted on the rupee, they did not hedge. And all of my colleagues, they believe that the corporates, we are not saying that you hedge yourself fully, nobody hedges fully, or we cannot make it. There has been a debate also that why Reserve Bank doesn't make hedging mandatory while allowing participants, players to expose themselves to foreign exchange transactions. Why hedging cannot be made mandatory? This is basically a debate which has been very often made, and no conclusion is arrived at, to be very honest. But most of the participants feel that corporates must have a hedging policy, whether you hedge 30%, whether you hedge 40%, based on your policy or understanding to take risk or your appetite to take risk, you must hedge. These are few things basically which are basically debated upon. But at the end of the day, we need to take certain decisions. We need to hand out some circulars. And when we hand out some circulars, we know that it is going to benefit some section, it's going to hurt some section. But we go by the, we go by the philosophy that this is the public service that we are serving. It is very difficult to look at who is getting hurt and who is getting benefited. Thank you.
Thank you, Mr. Carr. Actually, we have some time for the questions, audience questions. Few questions. Please make it as brief as possible so that everybody gets a chance. Gentlemen, the front row.
With the 7 or 8 factors which Mr. Sandeep Basu mentioned about being bullish, I guess everyone is in consensus, even the markets. That's why we are having all-time highs. Nonetheless, there's this underbelly, a vulnerable underbelly, caused because of the NPAs, which appear to be 1% of the GDP, but they are actually quite critical and significant because the March quarter just ended. And while I was talking, I'm an investor. I invest in distressed assets as well as in multiple asset markets. I found out that from all my sources in the banking sector that a huge list of NPAs has come out, and that's much bigger than any other quarter earlier. And this market is not easily clearing, especially in the metro areas or the urban areas like Bombay, because of a whole list of reasons that the valuers were not making the valuations accurate, and when the auctions happen, they're not good enough. So these markets are not easily clearing. Do you see any of those causing bottlenecks? Because if you look at the composition of the NPAs in Indian sector, this is not from the domestic side. This is mostly the corporates. This is mostly the SMEs leveraging on their own net worth from their old family-owned assets, which were being auctioned off because they faced losses. And they could be currency losses or they could be some other loss. So could you please elaborate on that, the composition of the NPAs as well as how it would affect the economy and in turn the currency?
Okay.
Sorry, so, although it's directed at me, I think my banking colleagues here are probably in a better place to answer this question simply because they're seeing the flows better, I mean, you'd like to answer it? Question is on
NPAs, basically external sector leveraging. How the NPAs are.
No, some of the NPAs definitely has come out because of the losses which has come out of the exchange related sort of thing. We cannot ascribe fully to the exchange sort of thing, but still definitely I can always say that in respect of, let us say, the small and medium enterprises let us say, in certain segments of the country where they have not hedged themselves properly, the fluctuations in the exchange rate has really resulted in payment problems for them, whether it is on their receivables or whether it is on their payables, both sides. So that has definitely put pressure on their cash flows, which in turn has resulted in they defaulting on the loan repayments to the banks. So to that much extent, I do agree that there is merit in putting the hedging. That is what we are trying to say. That is essentially you are taking a financial risk. Unnecessarily you are taking a financial risk. So why don't you mitigate that financial risk by actually going and hedging that? So that is where we are coming from when, as both Mr. David and myself, we are trying to say from the institutional angle that it is better to hedge so that at least you don't end up into having any cash flow problems which could result in defaults. And if you default, then you become an NPA, and then necessarily the recovery proceedings will start against that particular borrower. And he will also not get money from the organized channels. Then you will have to depend on money from unorganized channels, which comes at a higher cost. So that is why it is always better to avoid that financial risk or mitigate that. Maybe you cannot completely avoid that financial risk, but at least mitigate that financial risk.
Few more questions, but only request is the question should be shorter than the answer.
Yes. Good evening, everyone.
Yes, Bijur.
My few friends are there on the dais. So what I heard from them is, even Mr. Carr was telling that it looks to me like that the SMEs and corporates, they are responsible for volatility in the currency. It is not. See, what I observed since 2007-8, when the more restrictions and when more controls on the market, more controls on the rupees, this volatility started more. Okay. So I believe strongly there, the economic justice can be best won by freemen through free enterprise. Free the market, then nothing happens. Okay. What has happened from the 68 to 83, we have seen an eminent governor. He has seen the international market and he has started freeing the market. The market stability has come. Nothing much changed. Okay. So give more freedom to the market.
Sir, would you like to take this question?
This is a question or a suggestion? If it is a suggestion, I take note of it. If it is a question, it is self-explanatory.
But two more questions.
Yeah.
The question should be shorter than
Yeah,
the
yeah.
answer.
Yeah.
This time actually answer was shorter than the question.
Okay, my name is C.C. Shah. My only question is, what is the degree of confidence in the CAD numbers that are announced by the government or the ministry? Because there are some reports which have mentioned that these are manipulated numbers.
David?
It's a very short
In some quarters it is.
No, see, your CAD is comprised of two things, your trade deficit and your services deficit. It's well known you have a deficit on merchandise trade and a surplus on services. So to that extent, your current account deficit is absolutely valid. I think your reference is that there has been certain amount of artificial compression. There has been a curb, an artificial curb in the demand for gold, which is a temporary suppression and will perhaps raise its head once that is lifted. That is a valid point. But I don't think the CAD is subject to doubt in terms of the composition of the figures.
Yes, please.
Sir,
Hello. Sir, in this discussion, you are telling about how corporates can hedge their profits. But as an investor, if I have a position in gold and US equities, how can I hedge my investment returns?
Sandeep?
And what is the cost of it?
So you can hedge your gold investment. If it is in dollars, you can hedge the dollar risk through the futures market.
Okay.
And what was the other question? What was the other part of the question?
If I am I also investing in US equities, then how
Okay, so US equities, the currency risk again through the futures market, and the equity risk itself. I mean, there's something called contracts for difference in the offshore markets. CFD. You can Google on it, and you can figure out. You can under the $50,000 window, you can send out money and hedge that also.
Okay.
The resident Indian $50,000 window.
But technically, I don't have any idea on that, how to hedge that. So who can help me in?
So maybe we can just have a chat. Okay. Just have a chat.
I think he can contact you offline actually.
Sir, I have a question. Okay, my question is if India integrates into... Okay, this question is twofold. One on the trade deficit and the current deficit, and also the impact on currency. If India integrates into ASEAN, and there's a lot of free trade that keeps happening, just as we have Indo-Thailand free trade agreement, and if there's a ASEAN-India free trade, what do you think? One, if this happens from a banking perspective, impact on trade deficits, current deficits, as well as currency, especially INR.
See, I think the short answer would be a regional trade agreement, like you mentioned with ASEAN. It only results in trade diversion. There is no material impact on the underlying trade, but the sources of trade and the destination of trade may differ. Ultimately, the question is how competitive is the Indian exporter, or how competitive is the overseas importer you're looking at. The location of the importer or export destination, whether it is ASEAN or something else, is irrelevant. You're only looking at trade diversion. Fundamentally, it is the composition of your exports and your price competitiveness which makes the ultimate difference.
Sir, if permitted.
I think last question we will take actually. We are running out of time.
Sir, to the member of the dais, would you like to take a call on the currency? Do we see a considerable view that we touch 69 again before we stabilize?
No, basically, see, let's not predict. As simple as this. Because we don't know what kind of level right now it is trading at. When you cannot predict the next minute, there is no meaning in predicting the next year actually. The only thing is, the panel as such actually possibly has laid out the broad path. Possibly we have talked about what are the negative points, what are the positive points. We have just discussed at length about the BOP. So possibly by now you should realize actually what is the kind of BOP picture that could emerge in 2014-15. That would give you broad indication of where the currency is heading. See, basically, speculative bubble where actually possibly the greed displaces common sense. Speculative bust where fear displaces common sense. The bust and bubble, they will actually follow. Actually, right now we are living in a bubble which can bust also, and that bust can be followed by a bubble also. So naturally, at the end of it, the only knowledge will keep you in good stead, both in the bubble as well as the bust. So thank you very much, and I thank all the panelists for a wonderful discussion that we have had. Thank you very much.
I now request Mr. Asit C. Mehta, Chairman of Asit C. Mehta Investment Intermediaries Limited, to hand over mementos to our moderator and panelists.
That's okay. That's okay, sir. We'll exchange it.
I request the panelists to pose for a photograph. So that was the end of the session on currencies. Before we move on to the debt market session, we would like to thank all our sponsors, the principal sponsor, BSE Limited, our silver sponsor, Reliance Capital and SBI Mutual Fund, our booklet sponsor, SMC Global, the co-organizers, ICSI, NJ India Invest, BSE Brokers Forum, Sher Khan, Network FP, AIWMI, Skies and Rays Equities, and Asitsi Mehta Intermediaries. We are now distributing feedback forms to all our guests. We please request you to fill in these forms and drop them at the counter when you're leaving. What changed? Yeah, I know. Navneet is there. I know. But I don't know. She said wait for 5 minutes. Yeah, once it goes.
Property prices will go up. That is what they say. Let's put it this way. Property will not go down. Clear all of it.
अच्छा उसके गले में टंगा हुआ अच्छा 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 ओके ओके
We request all the guests to please take their places. We're starting with the session on the debt markets.
No,
No, of course I said it.
No, you didn't say.
No, I said it.
I heard it. Even me heard it.
I said ambition. Kirtan, no, I know, I said it. I said ambition.
ठीक है इसके बाद एक बार वापस बोलना ठीक है you keep this with me.
I'll say all of them again.
नहीं not now ये सेशन खत्म होना उसके बाद वापस
I would now invite on the dais the moderator for this session, Mr. Navneet Manot, CIO, SBI Mutual Fund. Our panelists, Mr. KK Vora, PCGM, Internal Debt Management Department, RBI, Mr. Jayesh Mehta, Managing Director, Bank of America, Mr. Abhijit Gulanikar, CIO, SBI Life Insurance, and we will be soon joined by Mr. Ajay Marwa, EVP and Head Trading and Treasury, HDFC Bank.
Thank you. Good afternoon. Good afternoon, friends. If you look at the sequence of the panel discussions today, so we had commodities, then real estate, currency, now fixed income, and then equity. I just hope that Mrs. Deena Mehta didn't decide the sequence in terms of relative attractiveness of each of the asset class. Going by that, I'm sure that probably the next discussion is going to be far more attractive. But in the previous discussion, I think Mr. Tyagarajan was asking the gentleman from RBI, how was the scene like when it was the July and August period in RBI? And I'm sure one of my friends is yet to come, Ajay, and Jayesh is here. I'm sure they can say that anybody who said, may you live in an interesting time, for people who have been handling treasury or have been in the bond and the currency market, nothing could have been more true last year. I mean, it was really interesting to say the least, where the 10-year bond yield, when we started the year, was around 7% and we reached a high of 9.5% within few weeks. Currency moved from 54 to 69 and now back to where we are around 60 levels. It's been a tremendously, I would say, volatile year, but of course last couple of months we can all probably have a sigh of relief, and hopefully the good times have just started. Also at the end of RBI, we had a huge debate in terms of the whole monetary policy framework. What should be the right anchor for the monetary policy, whether it should be core inflation or WPI or the CPI. Then again we have a couple of CPI numbers in terms of the transmission of the monetary policy, in terms of the short-term liquidity. So the guaranteed access to banks in terms of the overnight money which was available has been reduced considerably. FIs have been restricted from access to treasury bills. To take you all in terms of what has been the thought process at the end of RBI, also as we all know, next couple of years there are large repayments of government bonds and there is huge amount of gross borrowing program that the RBI will have to maneuver. To take us through in terms of what is the thought process at RBI, we are fortunate, we are privileged to have Mr. KK Vora. He is heading the Internal Debt Management Department in RBI for the last 4 years. He looks after the resource mobilization of GOI as well as the state governments involving planning, strategy and operations of auctions of dated securities, SDL, treasury bills, etc. Is also responsible for supervision and regulation of primary dealers in India and has had a distinct long career of 32 years within the Reserve Bank of India. So sir, if I can invite you to give your presentation.
Very good afternoon to my co-panelists on debt market, members of the Indian Merchants Chamber, colleagues from the banking and financial sectors, ladies and gentlemen. I can easily understand why the Chamber has preferred to have an interactive session on debt market. The economy, which had been clocking an envious rate of growth of 9% in the mid-2000s, has been slowing down in recent years. The investment rate which reached a high of 38% in 2007-8 has been moderating, and the savings rate which was at 36.8% in 2007-8 has also been coming down. Government and industry need funds to keep the economy chugging, especially in the backdrop of ever increasing expectations of the nation. Credit and debt are equally important as equity, and it is imperative that we may discuss the state of the market and what it offers to the investors. I would like to make a brief presentation on debt market covering the government bonds, which I am handling directly, and partially the corporate bonds. While I'll be discussing the details of the operations of the debt management, I will not be in a position to comment upon certain policy issues as per the communication policy. Now let us discuss few issues through PowerPoint presentation. My presentation is the structure of presentation. Can somebody help me? Just to move these slides. Okay. The structure of my talk will be government debt, why debt market is in the news as compared to equity, forex or so, role of Reserve Bank of India in debt market, overview, investment outlook, recent measures and road ahead. In the corporate debt market, I will be discussing structure of the corporate debt market, recent measures in the corporate debt market and the road ahead. Why debt is in the news? There are certain global factors which make us our interest in the debt market. One of the major is the quantitative easing in US and talk of tapering. There are also global developments in Europe and some other economies like Japan, when quantitative easing through which they are buying the debt to pump in money for the growth. There are global growth issues. After the crisis in 2008, many countries, their central banks, they pumped in money so that it can bring these yields down and which can facilitate the corporates to borrow from the market at cheaper rates. There are domestic factors why debt is in the news. Fiscal deficit. As you know, whenever we talk of our economy, fiscal deficit is at the forefront. When we talk that last year, fiscal deficit has been brought down from 4.8 to 4.6%, and in 14-15, this fiscal year, it will be 4.1. So whatever fiscal deficit figures come, they also correspondingly indicate what will be the market borrowing, because more than 90% of the fiscal deficit is met through the market borrowing. If the market borrowing is very high level, it can have many other implications which I will discuss later on in the financial markets. Statutory liquidity ratio, this is another important factor, domestic factor in India, is more specific to our country, that there is a mandatory requirement for the banks to invest a certain percentage of their net demand and time liabilities in the government securities. Currently it is 23%. So one thinking is that this perhaps is sustaining the government borrowing. If there is some tinkering in this ratio, whether the government borrowing will be in the same way what we have been doing now. Infrastructure financing. Now going to the other side, why debt is in news. In the current 5-year plan, we have a very large infrastructure plan requirement for $1 trillion. And one of the things we talk is how to raise that funding, because banks alone will not be able to fund. Perhaps we require raising the funds through bonds, and for that corporate bond market has to be very robust, and for that there are many clues which can be given by the government security market. Then debt is in news because it is conducive for channelizing the savings to the investments. As I mentioned earlier, our investment from 38% and saving from 36%, they have come down, and one of the important factors is how we channelize these savings. One is if it is a bank dominated economy like in our country, you give deposit to the banks, banks give loans, that is one. And when we talk of disintermediation, the economy can also raise resources through the bonds. What is the role of Reserve Bank of India in the debt market? Under the Reserve Bank of India Act, debt management function is undertaken for Government of India, which is obligation of Reserve Bank, and for the states, which is by agreement. And what is the objective of debt management in Reserve Bank? Lower cost over medium to long run, minimize rollover risk, and develop a deep and liquid market. And very important, last bullet, the role of Reserve Bank in debt market is also to give a risk-free yield curve, because this becomes the benchmark for the other sectors, and it also acts as a trailblazer. Many economies, the government securities markets functions as trailblazer. For example, in Philippines, when government securities market they issue inflation index bonds, private corporate sector also issues. When in the government securities market they issue non-resident bonds, private sector also. Retail bond, same thing is followed. Another thing is, which I will be covering in the later, is credit enhancement. When banks give some credit enhancement to the corporates, it also facilitates the development of the debt market. What are the features of the government security market, or why people invest in government securities? Maximum safety, it's a risk-free. As you know, the sovereign can impose any tax to repay its obligation, so it is risk-free. But of course, recent years in Europe, it has indicated perhaps it is not fully risk-free, but it is that is a fundamental principle of government security. Attractive returns from a long-term perspective, liquidity, eligible as collateral, transparent price dissemination, reliable market infrastructure like depository, NDS home, wide maturity spectrum from 91 days to 30 years. In fact, some in the private sector have raised up to 50 years also. Mahindra's had issued a 50 years bond also. Range of instruments in the government securities, there are fixed. We have three kinds of instruments: dated security issued by the Government of India, state development loans, and treasury bills. Development in the recent years, our fiscal policy has been expansionary till about 1 or 2 years back, which resulted in large market borrowings. Fiscal consolidation has commenced. Like last year, our deficit was 4.6 as against 4.8, and next year also. And we have a plan that by 2016-17, our gross fiscal deficit will be 3%. That means government borrowing will go down. But when I talk of expansionary fiscal policy, in 2007-8, our fiscal deficit was around 2.5%. And next year, 8-9 or so, it went around 6%. And thereafter, it has remained high. And that is one of the reasons that when for economic stimulus, government had to borrow so high, it had many repercussions. And now we are on the path of the fiscal consolidation. And if you see the borrowings, government borrowings, the absolute figures, the gross amount in 2007-8 was 1,56,000. And in 13-14, it was 5,64,000, around 4 times more. Then another development in the, or feature in the recent years is the elongated weighted average maturity of the government security, which has remained around 10 years. This reduces the rollover risk. There are two features of the Indian government security market which have helped it in facing the crisis. One is the elongated average maturity, and second is the domestic investor base. A low external debt, low currency risk, low non-resident holding, robust and stable domestic institution investor base, low sudden stop risks, low floating rate debt, emphasis on transparency and investor relations. Transparency means we have half-yearly calendar, weekly press releases. Investor relations, we refer to our monthly meetings with the primary dealers, bi-monthly meeting with FIMDA, like that. Movement of the weighted average yield and maturity of outstanding securities. As I mentioned, the weighted average tenure has remained around 10 years. Latest it is 10.01, and weighted average cost of the outstanding debt is around 7.99. It has remained between 7.8 and 8. And India is the second largest tenure. India is having the second largest tenure after UK in its securities. Composition of the government public debt, it's mainly internal, only about 7% is external. And ownership pattern of the dated securities. I am taking that Government of India's debt, and as on December 2013, commercial banks are having 36%, primary dealers including banks and non-banks around 9%, and one very important owner is insurance companies. Reserve Bank of India is also holding around 16%. What 3 years back, 2-3 years back, it was around 12%. So there is an increase in Government of India's holding by Reserve Bank of India. Provident Fund 7%. Among the future challenges, when we see, perhaps it should be more diversified, and like regional rural banks, urban cooperative bank, trusts, and mutual funds, perhaps they can also be motivated to invest more in the government securities. What are the recent measures in the government securities market? One is availability of hedging tools. 10-year cash settled interest rate future on single benchmark bond were launched in January this year after market consultations. Then inflation index bonds were introduced in June 2013, and retail inflation index bonds were also launched in December last year. Reissuances of the existing securities in the state loans was also undertaken, not in a very big way, but many states like Karnataka, Gujarat, Himachal Pradesh, they had seen, so that liquidity is improved. Infrastructure, introduction of the web-based access to NDS home, that is around 6 to 7% now is through web-based retail segment. Approval to introduce electronic trading platform with CCP facility in interest rate swaps. Allowing trading of strips on NDS home, which has been operationalized. We encourage the participant to make use of that. On the policy side, there has been gradual upward revision of the investment limits of FIIs from March 2011, when it was 10 billion. In June 2013, it was 30 billion. We have been fine-tuning this limit. For example, we have increased the long-term limit from 5 billion to 10 billion. That means like central banks, pension funds, etc. And in the recent policy, we have said that FIIs should be able to invest only in 1 year and above papers. Reduction in HTM portfolio to promote trading. This was one of the recommendations of Gandhi Working Group on improving liquidity, and we had made a beginning from 25%. There was some roadmap to bring it to 23%, but after the crisis in July and August, we had restored or stopped it at 24.5%. When more securities are marked to market, then it improves the liquidity. Conduct of buyback and switches in government securities, first time we had undertaken this year, January, February. It was the objective is for the consolidation, and there are some other recommendations of the Gandhi Working Group which we have implemented. One of them is the reduction in time window, and on the day of auction, more time is available for the secondary market trading. Road ahead, seeing whatever has happened. Enhancing liquidity across maturity spectrum. One of our agenda is the market making scheme for the primary dealers. All the primary dealers will be involved in that. And re-repoing and re-hypothecation of security, that's another agenda. And third thing which has been announced in the policy is the inflation index bonds with the new product design, retail inflation index bonds. Then widening the investor base, we are attempting for seamless movement of securities from SGL to DMAT form and vice versa. Then rationalization of investment guidelines by mutual funds, insurance companies, provident funds and trusts. Some are advantageous for the government securities, some are advantageous for the debt market, but there is some churning, some more active operations of those investors which are very large investors. Those are insurance companies and provident funds. And encouraging the active participation of in interest rate future for hedging purpose. So we have been encouraging banks, mutual funds, etc. And introduction of interest rate future on other tenors also is being considered. In fact, one positive thing on interest rate future is that every day we are seeing some trades, but we have to take it further. All of you, we urge whatever ways we can. Then other measures, I was mentioning the state development loans. Out of total outstanding of the government security, I said three components are there. One is Government of India, which we call it dated securities. Second is state development loan. So out of 50 lakhs, about 10 lakhs, 20% are state development loan. They are almost redundant or dead. There are very less activities there. Although they found 20% of the ownership, but in the liquidity side, they contribute just about 2%, 3% of the liquidity. So 3-4 things have been done in the recent time. Why I am mentioning this is, perhaps this is one segment which may come up in a big way. One is the road shows by some states. Other is the near uniform size of issuances and quarterly quantum. Earlier, sometimes the range was very wide. In one particular auction, we had 20,000, 22,000. Other auction, we had 3,000. We are trying that there should be uniform. Then variation in the tenures. Most of the state development loans are in 10-year security, but we have made attempt for 5-year, 4-year, 6 years also, and reissuances also, so that they become more liquid. Now I come to the corporate bond market, another 5 minutes and then I will finish. Corporate bond market in India has certain peculiar features and there is a lot of talk of developing it. One of the major features is its private placed dominated and high rated bonds. We do not have much low rated bonds. Finance companies are the major issuers and majority of the issuances are in the short term. Of course, the total issuances have increased, but most of them are private placement. Secondary market is particularly is very poor and daily trading volumes are very low and there are hardly any reissuances. Recent measures in the corporate debt. For the development of the corporate debt, there is a corporate bond and securitization advisory committee. I am a member. It is being convened by SEBI. And so a lot of things are happening on that front. Some of them I will mention. One important announcement is about the partial credit enhancement by the banks for the corporate bonds. Then IIFCL can also provide partial credit guarantee for infrastructure projects. Depository to create centralized database, which can also help the knowledge about the credit migration history, etc. Then rationalization and increase in the FII investment limit to 51 billion, reduction in withholding tax from 20% to 5%. I think in one of these reduction of withholding tax, one of my colleagues, panelist, Mr. Mehta, he had given us a lot of input, but he is not happy with this 5% also. Fine. Introduction of the trading platform for private placed corporate bonds. SEBI has taken some measures, but practically how they are taken forward, all of us have to take care. Last year in January 2013, they have launched this trading platform. Then banks and PDs are permitted to be members of stock exchanges for proprietary trading. Then relaxation of investment norms for insurance company and provident funds. In the private sector, L&T has issued last year inflation index debenture and Mahindras have issued 50-year bond. In the road ahead for the corporate bonds, dissemination of real-time trade information for transparency, electronic trading platform, these are the requirements and some attempts are being made in this regard. Consolidation or reissuances, introduction of corporate bond index products, publication of liquidity parameters. Cost of issuances has to reduce to encourage more public issuances. Some measures have been initiated. Securitization market, even globally, it has started developing. Perhaps in India, we also have to consider. And tax exemption for special purpose vehicle, rationalization of stamp duty, strengthening the investor protection, which includes bankruptcy and restructuring regulation. The last bullet, which is under active consideration of COBOSAC, which I mentioned earlier, municipal bonds are also being actively considered to be launched, and non-financial cooperatives like Amul or so, whether they can also raise borrowings. Before I conclude my address, I would like to talk of the general investor outlook, and some of the things are relating to debt, some are not related to debt, but they are relating to overall investment outlook in 2014 or year beyond that. One of the things which is likely to happen is a standardization of the documents, because when we talk of loans or in the recently announced monetary policy, we also talked of trade receivables and credit exchanges. There we have talked that invoices should be standardized. Why standardization of documents? It is required for securitization. or if the loans have to be transferred from the books of the banks, particularly when there are stressed assets, there is a lot of talk that they should be transferred either to asset reconstruction companies, or there can be takeout finance, or there can be factoring. For all these purposes, the standardization will be important. Increased due diligence, again it is important if you have to transfer, because why transferring the assets from the bank's books we are talking is that there is a rebalancing of the portfolios of banks is not done much frequently or as and when it is required. So there is a lot of talk that the bank's portfolio must be rebalanced as and when required. They should not stick with those loans or other assets which they had once acquired. Then for the future asset reconstruction companies, as I mentioned, warehousing receipts, takeout finance, all these can be, if they are to be traded in the secondary market, then debt market will flourish. Increased transparency is another important factor in the system which we have to develop, and central repository of information for large credits, that is one thing which has already been announced, data warehouse. Then in the future, perhaps there may be lesser demand from the government security market relatively. For example, in 14-15, the net borrowing of the Government of India's debt will be 4,57,000, which is slightly shade lower than 4,69,000 in 13-14. And when we are talking about the consolidation of the fiscal path, 3% by 2016-17, then perhaps government securities market demand will be little lower. That means private corporate demand can, the same institution or same investor can also have more appetite to go for private corporate debt market. Another development in the market is that treasury management will have to be more by the corporates than by the banks. For example, banks were earlier allowed that on a particular day, CRR, cash reserve ratio, they could maintain up to 70%. Now it is 95%, which means now treasury management for the corporates, which banks were doing, corporates have to do. That is one thing. Second development is this liquidity adjustment facility. Recently it has been reduced from 0.5% to 0.25%, and it was unlimited about a year back, then it was brought to 1%, then 0.5%. What I mean to say is there is a thinking that treasury management of the commercial bank should not be done by Reserve Bank. The commercial bank should do, and commercial banks in turn have to see that the corporates, their clients, they should do. With that, I will conclude my address, and thank you very much.
Thank you, sir, for giving us a good overview about the government bond and the corporate bond market and the measures that RBI is planning to deepen the market. Now we have a couple of other stalwarts in the market. Jayesh Mehta is a veteran for 25 years and DSP Merrill Lynch, and now a treasurer of the Bank of America. My friend Ajay Marva, who's the head of trading at SDFC Bank, one of the largest treasurers in India, and Abhijit is CIO at SBI Life Insurance. First, let me turn to Ajay because I know he needs to leave in a couple of minutes. The 10-year bond yield is at 9%, and for investors, do you think it's a good time to buy?
Thanks so much, Navneet, and warm welcome to all my co-panelists and all of you here. Thank you for having us here. So, yes, that's an important question, and if you really look at the way the markets are behaving over the last couple of days, it seems like a good time to buy. I think there are 3 or 4 real risk factors out there, and I think I'll just spend a limited amount of time highlighting those for your benefit. And you know, once you have cognizance of that, each one of us, quite frankly, has to take an independent call whether you indeed believe that we're headed for lower rates. I think the first key concern stems from the fact that we are, after a long time, in an era where our central bank has chosen to target core CPI and chosen to ensure that in a sustained long-term fashion, this country sees positive real interest rates. To see positive real interest rates, we have to ensure that inflation, and particularly core CPI, which has now been recognized as a measure of sustainable inflation, is below the rates of return that your investments, particularly fixed income investments, generate. Now, the glide path, as the Urjit Patel Committee report calls it, takes core CPI or intends to take core CPI in the direction of 6% over the course of the next 2 years, whereas it intends to continue to maintain core CPI just below 8% over the course of the next 12 months. Now, whereas the first target seems to be at this point in time achievable, and indeed, as the last 2 or 3 anecdotal numbers would prove it, it has been achieved. The second target, which is the 6% target, is a stiff one. This country has seen negative real interest rates for a long time. Sustained monetary policy action to ensure that core CPI comes down, not only not goes up, but comes down, would lead us to believe that interest rates cannot significantly perhaps head downwards, when RBI perhaps cannot take the foot off the pedal to ensure that that target is achieved. I think that's your first concern. Your second concern, of course, is what's happening to the West. And in the US, and just about turning in the EU, is the interest rate cycle. The US interest rate cycle has indeed turned. We have indications from there that growth is now improving, and it looks as if the Fed over a period of time will be less accommodative than it has been. If that indeed does continue, then global capital flows will, of course, start getting attracted towards the growth in the West, and that could be at the cost of the flows that we see coming into India. That is something that we've all got to watch out for, perhaps more on the equity side than on the debt side. On the debt side, in any case, the kind of flows that we have seen so far over the course of the last 3 months have been very short-term kind of arbitrage flows, and have gone into things like 6 months and 1 year treasury bills rather than the longer dated 10-year and 15-year government bonds. And for that to change, again, the overall investment outlook in India, for India, has to change. So I think those are the 2 key risk factors to watch out for. There's plenty of other macroeconomic factors, but I'd leave it to my friends on the panel to allude to them. Thanks.
We are seeing a lot of enthusiasm in the equity market, where the markets are expecting a certain outcome in the elections, where the results are going to be out on 16th of May. Of course, there has been a lot of improvement in the macro situation, and that can be responsible for the investors' response. But coming to you, Jayesh, what is the impact that you see from the election on the bond market? Because there seems to be a big divergence of views, the positive view that the equity investors have compared to the bearish view that the bond investors have. Do you think that the sentiments can change in the bond market as well post-elections?
I think there would be some sentiment momentum post-election on the bond market, but very nominal, short-lived. I think the biggest factor for bond market at this juncture is typically April, May, June, July is the large supply. The first half of the year is where the government borrows maximum, and in a normal year also the yield tends to go a little bit higher. In this situation, like as Ajay pointed out, we are targeting CPI, and the market does believe, this is what the market choose to believe. There's no explicit statement on that, but there won't be enough OMOs which would also support the government bond borrowing program. It's like, you know, in Mr. Vohra's chart, you had 16% holding of RBI in Government of India securities. So it's like, you know, you have issuance in a year, just giving an example, 100 rupees issuance, and 25 is being bought by, say, SBI, 25 by rest of the banks, 25 by insurance companies, and 25 by RBI. Now, one of the buyer goes off, it will have an impact. So I think there is a lot of technical situation which is actually keeping the bond yields higher. And again, we don't know at this level whether it's a great entry from a medium-term point of view. Yes, but in the next 1 or 2 month point of view, when we have such a huge supply, we might see still a little bit higher yield. So it's a question of when RBI really starts supporting the borrowing program, which as of right now market feels does not look like, because they're targeting the inflation. So that's what the market believes. But just to, you know, I just want to a little bit digress to add to Mr. Vohra's point on this 5% withholding tax. yes, I think we are all happy about it. Only reason we are not been seeing the flows. And Navneet, I would still little bit digress. I would like to say a story, right? So 5% withholding tax is something which we started following up with regulator. Finally, in February 2012 budget, it was announced that it will be moved to 5% withholding tax. After that, there were 3 notifications which came in. None of them were operating, possible to work out. It was, operatively disaster circulars. The final circular which would really impact and the thing where it actually made 5% withholding tax actually happened was fantastic timing we chose with. It was May 2013 along with Bernanke statement. So imagine world in their their own portfolio which was really stuck right now because of the Bernanke sudden tapering statement and all that. Do you think any investor would actually look to invest into a new country at that point of time? To add to Ajay's point, is like FIIs have been buying short-term debt and arbitrage money. Very true, because the real long-term money guys have not even empaneled. They're not even set up. Maybe hardly $4 or $5 billion out of the total investments of FII at all point of time is the real money guys. The rest are all arbitrage guys, and that's where I want to put a story across, which I've been trying to tell to a lot of regulators, and maybe you guys also deal with FII and you might be facing the same situation now. I think we are in debt market like where we are in equities market in '96. And I think we just need to cross one last hilt on the debt market for the FIs. And the problem today is, yes, we regulate, we do step by step. We don't do overall everything. So we did withholding tax May 2013. After that, we changed the FI regulation guidelines. Even right now, people are struggling. What is the actual guidelines? How do you register? Like today, I can assure you, like maybe 1 or 2 people in this whole room would know what is the process for a FI to register in Indian debt market if he wants to invest. Like somebody can say, yeah, it's there on SEBI website and all that. It doesn't work that way. We are all intermediaries. We are all marketing guys to them, right? If we don't know, imagine a guy sitting in US or in some other country. How would they know? And for him, he has enough options. So my favorite story is always like, you want to travel to Australia and Turkey. You call up your travel agent, like I want visa. He will say, Australia, give me A, B, C, D, and 4 days you will get your visa, blah, 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 done. And some other country, he may say like, you give me this, you give me this, I will try, maybe in 1-2 months I'll come back. It doesn't work. Where will you go? So that's the situation. I think that last step which we are missing out right now is the ease of getting FI registered. And honestly, like I can assure you, out of this panel sitting here, maybe 1%, I don't know what is the way they can do it. So I've been marketing very aggressively to all these FIs. I really don't know right now. Now I was told I tried to figure it out. Now we are moving to FPI, and because the FPI, the registration will be done by custodian. None of the custodians are going to be ready to give you what they want before 15th of May. So how do you register new FII? So that's where the big challenge is. But once they are done, it's a question of time, right? We do things slowly, it takes time, but once they are done, I think the bond market is going to a real big instrument. I think we all have been talking about equity markets, but I think you look at equity market, it really changed the whole scenario when the FII came in. And I think today the FII presence in debt market is not there. I can literally say it's not there. The real money guys are not there. The kind of FII equities you have, that kind of players are not there in the debt market. Debt market FIIs today are just a little bit arbitrage guys who are just trading short term. So when the real money comes, that's when the real fun starts. So I think the thing here is Outlook 2014, and like I would say maybe in next 1 or 2 months we do expect yields to go up another 20 basis point, and that's when we will have a good run. And in fact maybe Munot and team can actually get investors to start looking at debt, and it would be a good investment.
Thank you. So we'll welcome those FIIs, but for the investors who are sitting here, it was a mixed year last year. So those of you who put money in long-term bond funds, or whether it was ULIP, because the interest rates went up, it was a tough time because you had the mark-to-market losses. On the another side, as the interest rates are high, I mean in the accrual products, the funds like fixed maturity plan are offering higher returns. Looking at the current scenario in terms of the demand-supply dynamics in government bond or the corporate spreads, where do you see the big opportunity next 1 or 2 years for the investors?
going by, volatility that Navneet said in his opening remarks, I think I had written to our sales team always about what is happening in equity markets, why it's a good time to invest, etc., etc. But for the first time in July or August, we had to explain to our distributors and to our sales guys, saying that why bond market NAVs are showing negative, and the understanding was bond market can never go negative. How can equities we understand. We had to live with that. At the moment, I would feel that, corporate bond spreads are, to my mind, artificially low. So if you ask me, people who are looking for a slightly longer horizon, maybe, more than a year, I would say, not shorter than a year, I would bet on a, 20-25 year kind of GSEC and SDLs. I think SDLs are offering, yields very close or same as corporate bond yields. To my mind, there's a huge value in buying SDLs. They're 10-year, which is a good maturity. So for an investing perspective, if interest rates go down, you will get more duration play. So you will get more duration than corporate bonds. You will also get more spreads equivalent to corporate bonds. So to my mind, SDLs is something which I don't know for a retail investor how to invest, let me be honest. But I mean, we can have an SDL fund in a mutual fund. I mean, that could be one of the ways they can indirectly participate. But to my mind, a longer term GSEC, more than 10 year, 20, 25, 30 year GSEC. So actually 30 year GSEC is slightly artificially low, but 20, 25 year GSEC plus the other thing which retail investors could do, and at the moment which the products don't exist in the market and will take a little bit of time to do, is, you've seen retail investors take risk with absolute Ponzi schemes, Sharda types. I mean, I'm not talking about, but absolutely Ponzi schemes. I would prefer if a mutual fund or an insurance company has limitations, mutual funds have less restrictions, launch a single A fund with, investment in 20, 25, 30 corporates. I think you will get more than risk adjusted return over a couple of years. We're just completely missing out that market. It will be good for investors because a professional manager would understand the risk better than an individual investor who chip-cowed a not so good company for higher commission being received by the distributor. And the issuer will also benefit because he will achieve a borrowing rate to a certain extent lower than what he gets in the bank market.
In last 5 years, we have seen not only a significant decline in the savings rate, and one of the reasons could be that we had a period of high inflation and real rates were not very attractive. That could also be a reason that why people have more, I would say, fascination towards buying gold and the real estate, and the proportion of savings going into financial assets has gone down significantly in the last 5 years, whether it's equity or bonds or deposits, insurance, all put together. Now, I think one of the great instruments that RBI has introduced is the inflation index bond for the institutional as well as the retail investors. But for a variety of reasons, it's not taken off. The inflation index bond based on wholesale price index that got issued at 1.44% real yield is now trading at 4%, but very few buyers. Is there a thought process in terms of how that can be made more attractive and how more amount of liquidity can be brought in and that instrument can be really attractive for the investors?
Definitely, we have a plan that inflation index bonds will be reissued, perhaps much more in the volumes than last year, because that was a beginning. Current experience, let me take first the retail inflation index bonds. Perhaps the timing was when the other instrument, tax savings instruments in the Q4, they also clubbed with that. And seeing our effort, like we had given advertisement also through the banks, and for some tax purpose also we had been in touch with the government. But retail inflation index bond as well as institutional index bonds. Institutional index bond also we are going to launch, and institutional index bond, although they were a reasonably good success, but the quantity was small, about 1,000 per month. So we had standardized, like every last Tuesday of the month they will be issued. There are 3-4 reasons why inflation index bonds are important. One is in India, our most of the borrowing is in the fixed income, around 98%. So floating rate or inflation index bond was not much. Second is, as you have rightly mentioned, to attract savers to financial instrument. This is very important. perhaps in the way forward we will ease the process by which the investors can invest in this, and but we have very big plans for that, and we are in the process of preparing the fresh product design, and so we are going to come in the market shortly with that, and that should be a good response. In the fag end of March, the contribution to the retail inflation index bond has started picking up. So we hope it will get good response, and as I mentioned, some of the mutual fund, I think DUSH mutual fund, ICICI mutual fund, they also launched some liability side product based on inflation index bonds. So it is getting good response, and in any case for very long term bonds also inflation index bond suit, and globally whether it's advanced economies or emerging markets, a good proportion 10 to 20% is in inflation index bond, and inflation remains a concern in India, and we hope that it will pick up in a big way in 1450.
And a related question, Ajay, that as I mentioned that financial savings have gone down. Do you think that next couple of years RBI may have to keep real rates positive to ensure that the consumption is restrained and savings are promoted? The bank deposit growth has come off from used to be 25% and now 15%. Do you think that that could be a vision at the RBI, that we keep real rates positive for some time?
Quite frankly, I think that's pretty much the outline in the Urjit Patel committee report, and that seems to be the basis for at least the last 2 or 3 sets of policies that we've seen, and it appears to now gain momentum and continuum. So, and one hopes that there is consistency in this, and we see this action from the central bank going forward. Quite frankly, like I mentioned earlier, this is the first attempt I have seen in 20 years where the central bank of this country has taken a concerted effort to ensure that we have positive real rates. Positive real rates are extremely important over a period of time. I think enough has been said and done about inflation in India, and but we still haven't really seen concrete results. So I think, Navneet, you're quite right. It is imminent that the Reserve Bank, I'm not sure whether they will hike rates or keep rates high, but they will definitely keep the vigil on inflation at a high until they see tangible results in bringing down inflation, and therefore tangible results in terms of positive real rates. I think the other important thing to note is that if you really look at investment patterns and shifting investment patterns in India, the other troublesome thing that we've seen is channelization of these investments into unproductive assets. I mean, if you really look at real estate and gold, which are really the two real asset classes where a lot of savings have gone in, you've really seen loss of productivity, right? None of these assets do anything concrete for the country other than each individual owning 3 apartments or stacking up more and more gold. What we really need is investment. We need investment, we need productive investment, we need the output of that investment to get reinvested, and quite frankly that cycle to begin, continue and foster. That is what will take us out of this so-called emerging market status into an emerged economy status, and that's really what we've all been waiting for.
Can I ask panelists, there are striking similarities between where US was late 70s, early 80s, where Paul Volcker came, you had a high inflation, and then he kept increasing rates and broke the back of the inflation and inflationary expectations. And they had Ronald Reagan, who took, I would say, reforms which are very similar to the reform-friendly government that everybody is expecting in a couple of weeks' time. And then what followed was a period of 20 years which is called NICE, non-inflationary continued expansion. Can in India we expect that period if we get a Rajan like a Paul Volcker and probably a leader who can show the leadership like Ronald Reagan and the policies that he pursued? And in India we have non-inflationary continued expansion for 20 years. Very brief, and then we open up for questions.
No, I think that's a very good, hopeful thinking. I have slightly different take on that. See, when we look at real interest rate, and if we are really looking at 6% to be achieved in 2 years on the CPI, does not necessarily mean that interest rate, bond interest rate has to be higher. Even if it's all about inflation expectation. If the inflation expectation for next 10 years is, I'm saying hypothetically 5%, then even at 7% or 8%, it is still giving you real interest rate return as of today. So you don't have to really look at today's inflation and today's bond yield. You actually have to look at it over a period of 10 years. And that's what the bond yield would actually factor in. So I think that, having said that, I would say one of the things people, when we talk about, yes, people moved out of financial asset to non-financial asset. We also have to look at the thematic, right? You all have been investors. You all have been there in the bond market from 2000 to 2004 through mutual funds, because that was giving you the best return. 2004 to 2008, it was all equities and all equities. I still remember in 2007 peak, there was a guy who started a classes in Andheri how to invest in stock exchange for all the housewives. So that was the thematic. Then the next thematic was, oh, you bought a real estate in 2005, it's given you 5 times return. Even you yourself bought a bigger flat in 2008-9, right? And the same thing happened with gold, right? We all talk about gold mutual fund. You look at the AUM of gold mutual fund. It actually started going up only after 22,000 when the gold crossed. The gold mutual funds were actually launched at 8,000 when the gold was actually 8,000-9,000. But the AUM started going up post 25. So it's a lot thematic. I would not attribute the entire thing to the real interest rate or a negative interest rate. Yes, thematically, theoretically, it's very nice to have a bond yield higher than that. But you look at the lopside of it, because if you consistently have the higher bond yield, what happens next is your deposit rate and your lending rate goes higher, and then the whole growth story. And so rate alone, I am not sure can do that. But yes, as you said, the new government, what people are expecting, if they can do the right thing. Because if you look at this time, food inflation, I think in mid-90s, all of you would have seen, of course, Asit Bhai and Dina would have seen that you had, when there was shortage, you didn't get stuff. Like milk and sugar was the shortage, you didn't get stuff. This time, onion at 80 rupees, it was available at every place. The smallest village, it was available. So there's something else which is driving this inflation, and that's what needs to get corrected, rather than just focusing on. Even Urjit Patel report talks about that. So I think I would say it's all things together. So it's not only one baby to fight with.
Thank you. I think the message we are getting is that it's been a tough time in the bond market last 1 year. One gentleman uttered a single word, taper, and then rest is history. We had a massive volatility in currency in the bond market. But hopefully from here on, if I get the message from all the panelists here, if you have a longer term horizon, if you have some risk appetite and patience, and there's a lot of interesting opportunities that are emerging in the bond market as well.
In fact, Abhijit give you a very good suggestion. You should launch a 24-hour bond. Next 2 months, great time.
Sure. And I hope that at least people sitting in this room will be my investors. Thank you so much.
May I now request Mr. Ashokan, Co-Chairman, Capital Markets Committee, IMC, to hand over mementos to our moderator and panelists. Mr. Navneet Manot. Mr. K.K. Vora. Mr. Jayesh Mehta. Mr. Ajay Marwa. Mr. Abhijit Gulankar. May I now request the panelists to pose for a photograph? Gentlemen, we shall now break for tea. The tea break would be for 15 minutes, after which we will go on to a session on equity markets.
Yeah.
I request all the guests to please settle down. We shall now start with the final session on equity markets. All the guests are requested to please take their seats. We are now starting with the equity market panel. I now invite on the dais the moderator for this session, Mr. Shashi Krishnan, the Chief Investment Officer at Birla Sun Life Insurance Company. I would also like to invite up equity market panelists, Mr. Jyoti Vardhan Jayapuria, MD Head India Research, DSP Merrill Lynch, Mr. Prashant Jain, Executive Director and CIO, HDFC Mutual Fund, Mr. Andrew Holland, CEO, Ambit Investment Advisors, Mr. Subhash Chandra Agarwal, Chairman and MD, SMC Global Securities, Mr. Nilesh Shah, MD and CEO, Axis Capital Limited, Mr. Nipun Mehta, Founder and CEO, Blue Ocean Capital Advisors. I now hand over the floor to Mr. Shashi Krishnan.
Yeah, it's okay. Good evening, and thank you all for coming in, and thanks to the panelists for sparing sort of valuable time. I mean, especially in times when the markets are where they are. And I think we were here last year, I think in the same place at the same time. And I think I started the session last year, with a quote from Warren Buffett. And the quote read, "Stop trying to predict the direction of the stock market." Unfortunately, we all seem to be here trying to predict the direction of the stock market. I mean, the quote further goes on to say, stop trying to predict, how the economy will do or what the outcome of any election will be. I think, unfortunately, we seem to be breaking every tenet of what Warren Buffett said. But I think there's politics in the air, and therefore, I mean, it's but natural that I will start with a little bit of politics. And today we have completed, I think, 3 phases of the election, and Subhash has come having voted in the Delhi election, so I think we must doff our hats to him. And on 31st May, possibly we'll have a new government. So I just wanted to begin with a quick round from all the panelists in terms of what they think the impact of the election outcome will be on equity markets. And once we get that behind us, I think we needn't discuss elections too much during the course of the discussion. So a quick round of questions, possibly starting with Subhash, in terms of is politics important for this market? And without sort of venturing as to who wins how many seats, for equity markets, what do you think would be an acceptable outcome? And what do you think would be an unacceptable outcome? And if the outcome is positive, because we're all eternal optimists in the equity markets, I mean, what do you think, what do you think will change in equity markets? And maybe if I can start with you, Subhash, because you're the first guy to have voted in this panel. I think there's a little green button at the bottom which you'll have to press, just like you pressed in the electoral.
Yeah, thank you, Sasi Krishnan, and thanks to the organizer for inviting me, and I wish you all the best for them. So, Sasi has asked me what if outcome comes of the general elections, if positive and negative both. So, for a stable market, political stability is very important. And since we are mid of elections, election has already been started, and outcome will come on 16th May. So, I am taking, if BJP or any other government gives as opinion poll is there, people are laughing when I say BJP. As per opinion poll, NDA government is going to score around 240 something. I think if that opinion poll is correct, then stable government, I can assume that stable government is in the center. Then they can do various things which the earlier government could not do it, because in their manifesto, and Narendra Modi is the PM candidate, and we have seen development in Gujarat, and he is very industry friendly. So parliament election is very important for stable market, and I am quite positive if stable government is there, then markets would be much better. He can do many things which a normal government cannot do if it is not a stable government. Secondly, if let us say if a stable government is not there and some coalition government or something is there, definitely it will be little bit negative in the for the market. But certain policies are in such a way that all government are agreeing on certain agenda, and that agenda cannot be changed very fast, and still the market will not down. I can think not beyond it. Let us say 10%. I give the volatility from here. So if market is today is 22,800 around, so I don't see any downside less than 21,000. Generally, if you see elections which 1991 when PV Narasimha government came, before 3 months and after 3 months, market have increased. Even before 3 months also. In the same way, in 2009 also, the government market has increased before and after. And I think 1991, 96.
So Subhash, I think what you're trying to tell us is that there are only two outcomes, very good and good. Right, there can be no other outcome. Which I think is a lot of what I think equity markets seem to be telling us, because they don't believe that any other outcome can be factored in, right?
Yeah, I'm saying extremely good. If
so very good or
yes,
extremely good and good.
And little bit 10% downward I am seeing.
Right.
If
Nilesh,
market
would you
has
like to
political
sort of give us a quick view?
So Sensex, in some sense, is public sentiment. So Sensex divided by 100 is what market is pricing in terms of number of seats by BJP. And more importantly, post-election that will hold very true. So in case BJP gets 180, who knows, we'll see index at 18,000. If they get 270, we'll say 27,000. On a more serious note, elections have never had any long-lasting impact on the markets. Though in May 2004 as well as May 2009, we got one-day holiday because of election results. But this time it's unlikely to be true. Even if there is a correction because election results are against markets' expectation, we still believe that the firmness in the equity markets will continue because our macros are now falling in place. So the bull run will continue. It might get punctured a little bit because of the election results, but it will not change the direction. Things will continue to move on.
Thanks, Nilesh. Andrew, would you like to hazard a guess? No, not on the Sensex divided by 100, but in terms of whether politics is important or not important, and worldwide, do you think it actually makes any difference? Because I haven't seen too many markets reacting the way, for example, the Bombay Stock Exchange Index or the NSE Index has reacted to, possible election outcomes.
Yeah, so I mean, it happens each of the elections, and if you remember when Congress won last time around, I think we're all saying the dream team was back. There's no left party. The markets are only going to go up. The economy is going to continue to do well, and look where we are today. So I don't think the markets moving ahead or going down before the elections really matters to me that much. What I'm really after is where the macro and where the earnings are going for corporate India. So we're on record saying that 2014 after the elections we're in a bull market, similar to 2003 and 2006 type of period, led by GDP growth and then the earnings growth. So I'm not really concerned who gets in, because that momentum will continue for India.
Thanks, Andrew. Jyoti?
Okay, so I guess politics matters in the sense that last two times we've seen nearly 20% move on the day of the election results. But if we look at longer term, I think the impact on politics on the market is overblown. So if you look at the last two elections, which everyone saw that 20% move on the counting day, both of the moves were in some sense wrong. Because if we look at 2004, the market fell nearly 20%, and then we got the best return ever for the next 5 years in the market. If you look at 2009, market celebrated with a 20% up move, but after that, everyone regretted the next few years was a bit of struggle. So to that extent, the first reaction of the market need not necessarily be correct. Second is we've done an analysis of like the last 10 governments and looked at what was the stock market return in each of the 10 governments and what was the GDP performance in each of the 10 governments. Actually, there's no correlation between the nature of the government and the subsequent stock market return you got or, the GDP growth you got. So the second best performance in any government has come in a third front government actually from 1989 to 91, which, one would think, okay, third front government won't do well. So it matters to the short term, but in the longer term, I think we probably overblow the importance of politics. What is important, of course, is what sort of reforms get done by the government. So you could have like a unstable government doing a lot of reforms, you could have a very stable government doing no reforms. So I think that's probably more critical.
No, I largely agree with whatever Jyoti said, and I just want to make one or two.
If I may interrupt you, you would actually said that 1 year hence nobody will remember what happened in the elections. I heard you. I said you had said that 1 year hence nobody will remember what happened in these elections, and I think Jyoti seems to be echoing a very similar kind of thing. So. I think the view on this side of the panel seems to be that elections aren't as important as many of us think they are.
Yes, I second that, and in my observation what I have seen is that whenever you invest below 15 PE multiples in the Indian markets over next 3-5 years, the returns have been extremely good. And whenever you have invested at high PE multiples, and logically so, the long-term returns have been quite poor. I think India is a secular growth economy, and we take the tough decisions, we make the difficult changes only when we hit a crisis kind of a situation. And last few years we have passed through a difficult situation, so we have made many good, many important changes which will have good impact on the economy. So, and markets are trading below 15 PE multiples, earnings are being upgraded. So I am optimistic on the markets, and I mean, as was said earlier, that shorter term markets are quite volatile and uncertain. And I think I would leave it at that, but longer term, below 15 multiples, we are quite positive on the markets.
Yeah, Nipun?
Yeah, when you look at politics, probably yes, for sure. In the short term, they create a kind of investor confidence or business confidence that can be there, and which is reflected in the market movement. But really, if you see post-elections or probably in a couple of quarters, 2 or 3 quarters after the elections, it's the kind of reforms that a government brings in. Even if there are no reforms from what we've seen maybe in the last 4 or 5 years, Indian business is really very flexible. So it tends to adjust itself depending on the kind of circumstances that are there. So if you look at the last 5 years, last 6 years, since 2008, in 2009 or so, you saw a lot of businesses taking benefit of the lower interest rates. So there was sort of a lot of rollover of loans, which was at lower rates, a lot of loan swapping that happened. Post that, when interest rates started rising, they adjusted or they tried to grow, or they showed better profitability through operational efficiencies. Then you saw a lot of cost cutting happening. So Indian businesses tend to, and which is the reason why, despite the ups and downs that you've seen in the global markets or global economy, really in India, in several sectors, you've seen growth constantly happening over the last 4 or 5 years. There would be some sectors which would have fallen by the side, but several sectors probably which have adjusted themselves. So probably politics does play a role in the shorter term, but over time, business does adjust itself to growth.
But, thanks, Nipun. So I think the consensus in this panel seems to be that politics does matter for the short term, but in the longer term, I think we need to get back to basics. And if I may quickly come back to you, Nilesh, I saw a comment of yours a few days back where you say the retail investor will fund the next phase of the market. And every time the retail investor has funded a phase of the market, he's lost money. I mean, all of us in the mutual fund knows this. So I'm wondering, because if I read your comment carefully, you said that people will move out of physical assets and move into financial assets, and the next move would be to move out of bonds and move into equity. And by then you could have a rally that's well out and over, and the retail investor will be sort of left holding a lemon like he was in 2008 possibly. So what would your views be on that?
So we run a portal where we are having our last 3 years highest ever volume. More than 6,000 people are trading every day, and in a month about 50,000 people are trading. So participation wise, I think retail is there in the market. Unfortunately, 70 to 75% of trades are on the sell side, and the 10 to 15% or about 25% which are delivery, they don't last beyond 10-15 days. So participation of retail is already in the market, but it's more on the sell side. Second, we did an analysis of retail Indians' balance sheet. So excluding the real estate investment and excluding Indian promoters from the definition of retail individuals, on an average about 6% of their financial savings is allocated to equities, either owning direct equity or via equity mutual funds. Now this is one of the lowest in several decades, and probably in the last 10 years or last 5 years, gold and real estate delivered great return. So this allocation kept on coming down. But going forward, the real estate and gold both may not be able to deliver that greater return. So this 6% can keep on increasing. The government has also taken steps whereby this 6% allocation to equities can increase. So our whole call is that there is a tectonic shift happening for retail investors of moving savings from physical assets to financial assets, and equity being an under-invested class will benefit a lot. The third thing which we are seeing is that today, like in Axis Bank, we have 3,000 employees working in one building. Now, when PGC FPO came, you just needed 2 lakh rupee on your savings account. You could have put in an application and you would have earned about 18,000 rupees straight, because you could have sold PGC shares in the futures market. So we put up a special counter in our bank asking people that if you have 2 lakh rupee, here is the way to earn 18,000 rupees in 15 days. Total we got 27 applications, which was quite a disastrous experience. And when my people were standing selling that concept, they got 23 applications. When I stood there, I got only 4. So I'm a miserable salesperson. Now in the PSU ETF, again there was an opportunity to make money. And we didn't know where the prices will go, but if you had hold on for 1 year, you would have easily got 12% return. This time when we standing there, started selling that, we received far better response. A lot of investors came in, and fortunately for them, it has delivered fantastic return. So my feeling is that this PGC and PSU ETF experience will bring more money into the equity markets, and if we can replicate that with 1 or 2 more issuances, then hopefully this floodgates will open.
Sure. So what I hear you saying is that a month back you got 24 guys to put money into equity. A month later you got 240 guys to put money into equity, and maybe as we go ahead that will sort of multiply. It will be a force multiplier. So Subhash Mahajan, quickly come to you, because I think in the morning the SEBI chairman did mention that the IPO market hasn't just taken off and nothing seems to be happening. And I think Nilesh seems to be actually suggesting that the IPO and the FPO market is really not happening. And at SMC, I think at one point of time, you were a very, very big distributor of IPOs. Do you think that is something that will come back as equity sentiment improves? And will we be unfortunate enough to, have a lot of, let us say, second-rate IPOs that will start hitting the markets now that, markets are where they are and there is euphoria, which could be dangerous for retail investors?
Yeah, we are sitting in BSE, and BSE when it started Sensex in 1980 it was 100. As on today it is 22,800. So giving a return of 228 times in 33 years. So equity is the only asset class which can beat the inflation and can give the real return in longer term. So whether it is you are investing in IPO or in secondary market, the only thing is you should keep in mind that fundamental of the company should be good, and it's in long term it should be a good investment. So ultimately equity, if equity, all asset classes are derived from equity. So if equity is in long term, equity will give the best return, that I am sure. But it take longer period. You should not have a shorter view. And the reforms which needed in IPO market, SEBI time to time taking action, and that will be done. I am quite hopeful and positive about IPO. Again, it will show full strength, and even secondary market will show full strength. Last 5-6 years we do not have very good experience, but time next 6 years I think for the equity market.
So IPOs make money for the merchant bankers. Do they make money for retail investors?
Yeah, it should be a win-win situation, and it will be win-win situation for both.
Right.
Yes.
Andrew, could I quickly come back to you, because you've always been the voice of caution, if I'm not mistaken, whenever there's been euphoria in the market. And I think you've been saying, I mean, quite often over the last couple of days, that this market is overplaying the hope rally. And I think you also seem to suggest that the market is ignoring a lot of global factors that could impact Indian equity markets, whether it is China, whether it is the appreciating euro, whether it is Ukraine, whatever. So would you like to sort of introduce an element of caution at this point of time?
Yeah, it's a pretty lonely place to be, being cautious in these markets, that's for sure. Listen, FIIs have been coming into India, and it's not just on the fact that everyone expects the BJP to win and Modi is going to be the leader. It's also that India's stood out from this kind of dirty linen basket, which includes Brazil and Russia and Turkey and Indonesia and China to that extent. So there's been allocation shifts towards India. I think you'll find that most India-dedicated funds offshore are still receiving no more money, and so Jyoti will agree with that. They're not receiving any money, so people are not banking on India in terms of the BJP. They're finding that it's a relatively great outperformer in a global scenario, which isn't looking very good for other emerging markets. The momentum is there. It will continue till it stops. Now, what will stop it? Could be many different things, but reality always bites, and it always bites very hard. So, we could see a bit more of a rally, but it'll always go back to fundamentals. I don't want to be too negative, because the retail investors have hardly even started in this bull market for the next 3 years, and it will be a bull market. So I just want to put the caution, it's the short-term caution, not the long-term caution.
Thanks, Andrew. Prashant, can I quickly come to you, because you had mentioned this magic number of a multiple of 15 on a 1 year forward. And you said that whenever investors have invested in markets that had a forward multiple of less than 15, they've always made money. Right now, I think the multiple is closer to 15 than it is, further away from 15. I mean, give it 14.5, give it 15, depending on the estimates that Jyoti could give us. So does that mean that investors may actually lose money because we're closer to 15, or there is still a lot of opportunity for investors to get back into equity and make money?
See, India is an economy where the nominal GDP growth, even in weak times, bad times, is around 15%, 14-15%. If you look at last fiscal, 13-14, because of high inflation, the nominal GDP growth was still 13-14%.
Right.
So we have experienced in India trend growth in profits of around 15% per year. And when you look at buy into a 15 PE market, what that implies is that 3 years from today, the PE multiples would be in single digits. And in single digits, it is very hard to for you not to make money, because bond yields in India, even if they are at 8%, 8.5, 9%, then bonds become bonds are more expensive than equities. So what I wanted to say is that at 15 PE multiples or below them, over the next 3 years, returns have been very good in the past, and I see no reason why that should not happen again in the next 3 years.
Thanks for it. Jyoti, you've been pointing out in many of your strategy reports that FIs are broadly brought a mix of defensives and rate sensitives. So, they have avoided things like global commodities, PSU banks. So, given the fact that there seems to be a broad market rally, you think the foreign institutional investors will start getting into the broader markets, will start looking at sort of cyclicals, will start looking at smaller caps, or will they continue to act the way they're acting?
Yeah, I think they'll start rotating their portfolio. In fact, till 5-6 months back, I think they were only into exports, basically. So, software and pharma were probably the big overweights, and people had a mix of some private sector banks and consumers. Over the last few months, we've seen that rotation into more domestic names. So everyone on the margin has been trimming their exporters and buying more of domestic plays. And I think that trend will continue as the Indian economy starts to improve.
Nipun, if I may flip the same question to you, where do you see value in this market at this point of time? Because I mean, there is a fair amount of euphoria. Multiples have gone up to 15. Many of the stocks where the FIIs were in have already moved up significantly. So where do you see value in this market? And if a retail investor needs to get in, what would be the best strategy or opportunity for him?
So really, if we again look at the last, maybe the shorter term now, in which we've seen that this rally, or even if you look at it from a 2 to 3 year perspective, it was, you saw a fair amount of FI liquidity moving into IT, it went into pharma after that, FMCG prior to that, a lot of defensives were invested in. And when you look at the valuations today, vis-a-vis what could still be maybe 3 years down the line, or the discounting that a lot of these companies will have 3 years down the line, still there is some way before which they could move. But given the fact that a lot of these FIIs do tend to invest more in large caps, we've seen limited investment happening in a lot of the mid caps where there is a lot of value, which is where typically we do see retail investors taking a lot of positions. We've seen rotationally several sectors actually move up. They could be actually benefiting out of what could potentially happen after the elections, or how corporate earnings could scale up, or how reforms could change or be beneficial to a lot of the sectors post-elections. So we've seen rotational movement. What we probably haven't seen is the impact that the positive impact that could that a changed government or a faster reform could have, or faster approvals could have, probably on capital goods, probably on infrastructure. Clearly, when you look at the kind of infrastructure spend that was happening, or let's say when there was a capex cycle that was active, say sometime in 2005, 2006, 2007, when there was clearer visibility of earnings for the next maybe 3 or 4 years or 5 years, you saw a huge amount of capex actually happening. You haven't seen that happening now currently, simply because of the fact that there is still a lot of surplus capacity that a lot of these companies have. So as you see potential visibility of demand that could be happening in some of these sectors, you're likely to see again the capex cycle probably turning around, with the capital goods sector benefiting, based on the government focus on infrastructure, on ports, what has probably been indicated in various manifestos, the kind of stress that could be there on infrastructure building up. That's where again, when you compare valuations of capital goods or infrastructure in 2006-07, which probably was significantly higher than what they are. I remember the stocks like L&T, Siemens, I mean several of these companies which were probably quoting upwards of 30, some of them even 40 times their earnings. What you see today is obviously a reflection of lower execution and lower earnings potential that these companies seem to be having, and obviously the burden of high interest costs that are there. But in a say 3 to 4 quarter scenario or beyond, clearly a lot of these companies are expected to benefit. And our sense is, when you compare those valuations today, not necessarily with the kind of valuation that was there in 2006 or 7, but clearly with the changed potential for execution that could be there, and the stress that could be there on infrastructure, as well as a changed capex cycle, there could be still some amount of leeway in some of these sectors.
So thanks. I'll get back to you on this, the cyclicals which you are so bullish on. But Dilesh, if I may, quickly come back to you on the macros. And I'm sorry I'm asking you this question because, I read Warren Buffett's 2013 report, and he said forming macro opinions or listening to macro or market predictions is anyway a waste of time. But I'd still ask you that question. See, you'd mentioned, and I think a couple of our panelists also mentioned, that there are improving macros. Now, when we talk about improving macros, I'm not too sure about what is the kind of time frame most of us refer to. But if you look at growth, GDP growth for that matter, 4.5 or 5.5 is, something just there. I don't think it's a significant improvement. If you look at inflation, and if you listen to many of our panelists in the last panel in the bond markets, nobody seems to think that inflation is going to come down in a hurry, and the 10-year is going to be still at around 9.25 for at least some time to come. Yes, the panel before that, the Forex guys did talk about improving current account deficit and, a little bit of change out there. But, this broad brush statement that many of us tend to make, that there are improving macros and therefore the economy should do well, sometimes puzzles me. And I thought maybe I'd, get an idea as to, where do we actually see this improvement, and how is this improvement going to make a big change to equity markets?
So Warren Buffett can afford to make a statement that don't bother about macros, it's waste of time, because he is actually creating macros with his investment. But for people like us who are putting small money to work, we need to worry about macros. In some sense, if macros are in your favor, then you are running on a downward slope. If macros are against you, then you are running on an upward slope. And obviously when you are running on a downward slope with little effort, you will have better speed. Second thing, that 4.5% GDP to 5.5% GDP, 1% increase in GDP growth apparently creates 18 lakh new jobs. Now in a country like India, 18 lakh jobs makes a huge difference. And today morning I met someone who is just passing out of the college, and he's saying that even his seniors, and this is at graduation level, not at post-grad level, a lot of his seniors after 1 year haven't found a suitable job. And it's creating tension at home, it's creating tension in their personal life. So job creation, courtesy, this 1% GDP growth increase is significantly superior. The reason why we think that right now India is on a improving macro, or the markets will run on a downward slope, is one, your current account deficit has come under reasonable control. Rupee, instead of falling like a stone, is now slowly but steadily appreciating. Second, when your current account deficit is very large, you have to spread your hands in front of foreigners. Not that it is wrong, but if you can fund your growth through your own savings and augment it with foreigners' savings, then it's even more beneficial. So we think growth will now get supported by both domestic as well as global savings. Third, the fiscal deficit, howsoever optical, but that's under control. At least the next government, while they'll have to face some of the headwinds, will still probably look at controlling fiscal deficit rather than going into fiscal profligacy as we saw with the previous government. Fourth, GDP growth after 2 years of below 5% will be now above 5%. IMF is projecting 5.4. A lot of other brokerage houses and analysts are predicting between 5 and 5.5. I think the number, whatever it may be, but will be on the higher side. Your inflation in real sense is coming down, and we will see CPI inflation, after remaining above 10% for some time, come to probably about 6-7%. There's one interesting thing about our CPI. 25% of our CPI is housing related thing, and in that, housing is calculated based on HRA allowances rather than imputed rent. Now all of you know that HRA allowances in any company will continue to go up 10 to 15%, whereas rents have probably remained stagnated for last 5 years. That stagnation of rent is not reflected in CPI inflation, but increase in HRA allowance is reflected in CPI inflation. And most importantly, HRA and other allowances are increased based on CPI number per se. So it's a virtuous cycle we are creating for employees, but not necessarily for the economy. So put all these things together, we will actually see our macros improving. Now the speed of improvement can increase significantly if we have a good government which can revive the investment. Then I'm not sure about this year's growth, but also about many next year's growth. So we are on a slightly stronger wicket.
Sure. So that sounds good in terms of the fact that, yeah, you do believe that the macros are changing for the real. Andrew, if I may quickly come to you, because Nipun was talking about, cyclical stocks, but you've been making a very strong case for remaining in defensives. I think you've been saying stick to defensives because this hope rally may not be for real. Seems to be a contrarian view, because as many people have said, there has been this rotation where People have moved out of defensives, moved into cyclicals, but you seem to take a view that it's better to remain in the defensives rather than actually take, this bet on the hope stocks, if I may call it that.
Yeah, I'm not quite sure where you got that from, because in October of last year we actually said we should move out of defensives, mainly pharma and consumer, into the cyclical sectors. So I might have been some.
So you hold the same view that you must move out of defensives and.
Yeah, so we've had that view for since October of last year. But going on to what Nilesh said, I think there's a few points here. Is that 5.5% GDP growth and then 7% GDP growth the year after. Because it's going to be infrastructure led, it has a huge multiplier effect on the economy, and it's all about confidence thereafter. And if you go to the UK, I was in the UK last November, and the place is absolutely booming, and its GDP is hardly anything, but it's all about confidence. I mean, the pubs are usually full at 5 o'clock in the evening. They were full at 4 o'clock in the evening. So, I think if India has its confidence back, and people feel that, their jobs and their kind of careers and their wages are going to go higher, they will start to spend again. And the operational gearing of Indian companies, we've all forgotten this for so long now, because we've been seeing GDP growth fall, is huge. I mean, a company's going from manufacturing capacity of 65 to 70%, all goes through to your bottom line. So, that's why we think the cyclical sectors will do well. They're still undervalued as far as I'm concerned. But don't look at, the PE of 15 now, and I'm not saying that's not a way to look. But, look 2 years hence and say, where will the earnings be? And there'll be the multiples of where the analysts are saying they will be today. So the market, to my mind, over the next 3 years is cheap. Don't mind who gets in terms of the political parties. And if confidence comes back, then we'll continue to see that the cyclical sectors will do well.
Andrew, I think that's the difference between UK and India, because after 5 o'clock, everybody in UK is in the pubs. After 5 o'clock, everybody's sitting out here. Right. So, Subhash, may I just come back to you in terms of retail investor behavior? I think you sell a lot of other products. You sell commodities. You sell agri commodities. Hard commodities. So, have you been advising retail investors, to look at other asset classes rather than equity at this point of time, or has your advice been that they should continue to look at equity at least for the conceivable future?
Normally we advise to our retail clients, if you want to invest, you go to mutual fund and invest in their scheme, because on research basis you can earn better. And if you will invest directly, you will always running the risk of losing money. So our first advice is like this. Secondly, regarding commodity, if somebody understands the commodity market, and if you want to invest money as a arbitrage person, then we can recommend him that you hold this as a commodity, agriculture commodity. It will give you Badla type return, which we normally can see in the market, the physical commodity in the market and the forward rate. So both after comparing, we can get the difference. So we advise to only those clients who understand that. So normally we tell them that ultimately retail investors should invest through mutual fund. That is the best if he is not aware about many intricacies of the market.
So you would suggest that this is the time to seriously start looking at well-performing equity mutual funds and put your money into such kind of funds. Yes. That's what you would suggest to retail investors.
Yeah, that we always tell them, if you don't want to lose money and if you want to earn in long term, you should go through mutual fund. And moreover, the Indian economy, we are very confident. Indian economy will do better once this government, this election. I think if they consider to be growth-oriented government, if NDA comes into the I'm sorry.
Okay. Yeah. So it's okay. I mean, whatever our preference. Prashad, may I quickly get to you, because that seems to be an endorsement to retail investors to come into mutual funds. And obviously, mutual funds have the ability to sort of have diversified portfolios. And I mean, especially going by your own investment philosophy and the way you've managed funds over the last many number of years, you've always been a bottom-up stock picker. And I think, I read somewhere, somebody attributed this to your to the style that you have, that picking up stocks that are in the throes of agony. Sounds a little sort of flowery, but that's how they attribute to your style. Do you think there's an opportunity at this point of time, because there are a large number of sectors like power, gas, coal, mining, which are completely beaten down? They still seem to be fairly undervalued, could be in the throes of agony. You think there's an opportunity, especially as a long-term investor who creates value for retail investors through these kind of portfolios?
Just two things I want to say here. One is, if you look at the pattern of mutual fund inflows or outflows into equity funds, it is very surprising but very unfortunate also. Below 15 P's, no money comes in. Actually, money has always gone out. And bulk of the money in equity mutual funds has always come in above 20 PE multiples. Always. So I think what the retail investor is doing, he is not focusing on PE multiples. He or she is simply focusing on the past returns. And whenever the past returns are very high, people chase those returns and a lot of money comes into mutual funds. And you can see 1992, P's were 45 times, one of the best years for mutual funds. 1999, P's were extremely high, again a very good year for mutual funds. And last was 2007, again 50,000 crores the industry collected, P's were about 25 times. And below 15 P, actually hardly any money comes and actually money goes out. And last 2-3 years, mutual funds have seen large redemptions. So again, I think this behavior of investing after high returns is detrimental to long-term investing. So that was one point on how to invest in mutual funds. Invest when P's are low. Coming to sectors, I feel that consumer, pharma and IT, in these three sectors, in my opinion, there is very limited room for multiples to expand. And in fact, there are some headwinds to earnings growth also. On IT and pharma, I think from a stable to appreciating currency, and in consumer from a slowing growth. And I think the growth expectations in this sector are still driven by what happened over last few years, which I don't think is the new normal. So I would say that this index at 22,000 is actually in two parts. One part of the index, IT, pharma, consumer, is maybe at 50,000 index. And rest of the other than these three sectors, they are probably trading at 10-12,000 kind of index. And the average of these two is 22,000. In my opinion, if the economy improves as is expected, then the other sectors stand to, in my opinion, see some multiple expansion and also drive good earnings growth. So risk reward is probably favorable in sectors other than these three.
Thanks, Prashant. In fact, just to extend that argument, Nipun, if I look at the multiples that I see, 1 year forward multiples I see across most sectors, if you assume that the Nifty has a multiple of something like 14.5, the only sectors I could actually pick out which had multiples of significantly lower than the Nifty 14.5 were sectors like oil and gas or metals, mining or power, which had multiples of anywhere between 9 to 11 times. And Prashant was just talking about PE expansion in some of these places. So do you think that it's a good idea to look at these, well-managed companies in these spaces and expect a PE expansion over here? Or do you see the market PE is itself expanding? There's nothing to stop the market PE from going from 14.5 to 19. We could well be what the Dow Jones is today possibly. So which do you see is a better possibility? First, expansion of these beaten down sectors, and then an overall expansion in the PE multiple of the market?
So if you look at this mentioned, the sector that you mentioned, particularly oil and gas, metals, the common thread behind underperformance of all of these sectors is clearly government regulation. So you have administered pricing for oil and gas. You've got again metals, which have metals and mining, which have their own issues, whether it is in terms of coal or iron ore. Again, affected by LME prices, China demand supply, and a lot of that. So clearly, these are not sectors which, on their own, in terms of the sheer private sector performance that we've seen in a lot of the others, where there is really very limited government intervention in terms of business. So these are not necessarily sectors which can really shoot up or move upwards along with the market momentum unless there are these kind of changes. So yes, probably some of these sectors do move up or would move up. They would have some PE expansion, but re-rating is not something that you can easily see with a lot of these sectors. That's always going to be difficult. So when you look at participation probably going forward, yes, some of these sectors, given the kind of PE differential that you have with consumer durables and IT and pharma vis-a-vis some of these, which is your 50,000 and 10,000 index, yes, probably to bridge the gap partially you could see some movement, but surely unless there is greater reform happening or lower government intervention happening in terms of pricing of a lot of these or mining or import of a lot of these, some of these goods, really you're not likely to see a re-rating happening. So from that sense, probably there just could be other sectors which could be included, which we don't form a part of these 4 or 5 sectors that you mentioned, which could include banking, which could also probably ensure further a bit of expansion that could be PE expansion that could be there on some of these sectors which probably have already run up and which could be there at a 50,000 index, probably lower in terms of market outperformance. There would be lesser market outperformance. But really, it would need to be a mix of a lot of these in terms of market outperformance that you'll see going forward in terms of how PE expansion happens. So
it has to be a mix of a PE expansion and earnings growth, which will then bring me back to Jyoti, because Jyoti's latest strategy report talks about the bad news is that profit growth continues to be concentrated. Is this what you said in your last report, Jyoti? And therefore you seem to think that, you don't see earnings except in a couple of places, international subsidiaries, I think you mentioned, and something else, exporters, right, if I'm not mistaken. So if that's the bad news, I mean, we're going to have PE expansion that could possibly be limited, and you believe that earnings growth is concentrated, then, where's the hope for this market?
Yeah, so, this is the current. So, if you see the last 3 years and this quarter also, most of the earnings growth has come in software and pharma, consumer to some extent, and the international subsidiaries. And that needs to change if the market has to go up. So, the real hope for the market is, I think more than PE expansion. We'll probably get a PE expansion this year on the hope that things will improve next year. But if you look at current margins of corporate India as a whole, so it will include software, pharma and everybody else, the margins are at an 18-year low. And if we get these margins reverting back to mean, then earnings will double. And if we get into history, that's how bull runs start. Basically, if you see most bull runs, it is when margins are at a low, margins start picking up, you probably get like a compounded 20-25% earnings growth for 5 years. And typically most of the bull runs have started at a PE of 10, which we don't have this time. So you get earnings doubling over 5 years, you get PE expanding from 10 to whatever 17, 18, and that's why you get markets going up 3 or 4 times over 5 years. This time we probably don't have the PE expansion which will be very strong, though it will happen this year. But I think it's the earnings expansion which can be quite strong over 4-5 years. We could get earnings doubling out.
So you think the earnings expansion will move, further from these international subsidiaries and exporters to a lot of other areas?
A lot of the other areas. So if you see that breakdown of, why earnings are at an 18-year low, margins are not at a low for a lot of these sectors. Margins are at a low for everything else. And it is that everything else which will participate if the domestic economy starts to fall into place.
Sure. Andrew, may I quickly come back to you, because in one of our previous panels which was the Forex panel, they seem to be fairly optimistic about money coming into India. If you look at global markets, if you look at the US market, the S&P is almost at its all-time high. FTSE, DAX, in spite of the fact that Europe is not doing all that well, are still trending upwards. But do you believe that this global rally is sustainable? And if it is not sustainable, then what does that mean to money coming into India in terms of allocations?
in terms of the global factors, what concerns me is that everyone's saying there's abundant liquidity and therefore it continues to find its way into global markets, including emerging markets. But my scenario is slightly different in that I think the US is really, the economy is starting to pick up very quickly. Confidence is back. It's the same in the UK. And so we'll talk about when interest rates are going to be raised in the US, not just about tapering, but when US will raise rates. And I think that will start to suck liquidity out of the system. And therefore there'll be less money to go to emerging markets in the very short term. So that's why I'm more cautious in the very short term about Indian markets and global markets, is that we're banking on everything being the same, liquidity still being in abundance, and that's simply not going to happen when interest rates go up. So I think that's what worries me about that. But I just want to I want to move away from FIIs. Why would FIIs come in? And it goes back to what we've been talking about, is that it's very simple that if you go back to 2003 and look to 2006 and look at why sectors moved, why did operational gearing kick in? It's because the economy starts to pick up. So, when you think about the market, don't think about where the index is going. Think about which sectors to be in, because those are where you're going to make most of your money. So, the PE might remain at 15 because you have some very heavyweight sectors which are all on very high PEs, which probably are not going to move in this scenario. It's going to be the steel companies which move from 8 PE to 12 PE, but really they're actually only on a 4 PE because the earnings are going to be so strong. That's what I think investors need to look at.
Sure. Nilesh, you were talking about macro, so I just want to quickly revert back to that. The business sentiment ultimately is going to get sort of impacted if the investment cycle returns, and quite a few of our panelists seem to suggest that they think that the investment cycle will revert. But what do you think will actually sort of ignite this investment cycle, or get it back in action? Will it be lowering interest rates? Will it be higher savings, as you seem to suggest? Will it be deleveraging? What would be those key things that we would need to look at to sort of help us understand that the investment cycle is reviving and possibly it is the right time to look at some of the cyclicals?
I think investment cycle will revive more by the sentiments, and that sentiment will get positive if they see action on the ground. And I'm now quoting Arun Shourie from his article in day before yesterday's Indian Express. So his wife is not very well, and he receives a summons, non-bailable warrant from a Faridabad court saying that your wife has to be produced to the court. And he says actually she is ill, and why suddenly non-bailable warrant? So the person says that we have served 5 summons on you, you didn't accept any one of them, and now hence the court has issued a non-bailable warrant. And then Mr. Shourie goes to the court and requests the judge that my wife is not well, and we had never received any summons, and why this non-bailable warrant? So the judge says that, look, we are going by the record which says that 5 summons have been served. So if you didn't accept, it's the record. Whether it reached you or not, that doesn't matter. The second was that, okay, what was the crime? So the crime was that you have a farmhouse, which is illegal. But Mr. Shourie said that, look, neither me nor my wife has any farmhouse. So he said, this is on a land which you sold 5 years back, but someone else who bought that land has constructed a farmhouse, but we believe in record the farmhouse is belonging to you. Now suddenly Mr. Shourie had to bring her wife to the court, even in that critically ill condition, for a land which didn't belong to him, for a farmhouse which was not built by him, for summons which he did not receive, but they had to appear in the court of law. Now this is somewhere, every person who is part of the governance system is becoming a judge and jury in himself, and instead of supporting commerce, they are all creating barriers on commerce. The multiplicity of regulations, it's creating speed breakers and sometimes speed walls in terms of growth of commerce. We need to remove that. Once that is removed, then many other things will start falling in place on its own. And today we have been given a great opportunity by rupee depreciation. I am a Gujju Bhai. A lot of my cousins are in businesses. At 45 rupees to a dollar, they were all traders. They were all going to China, importing containers and distributing in parts of India. At 60 rupees to a dollar, all of them have restarted their factories. Their container imports have come down. And if they get the support of government in terms of better regulation, better support on the ground, I can assure you that they will create, many more manufacturing industry in the country. So we need this sentiment booster through proper execution.
So more than interest rates and the rest of the stuff, it's actually governance and better governance that can actually bring back the investment cycle. Prashant, may I quickly get back to you on the retail investor? Because I think the retail investor has this unfortunate habit, as you rightly said, of trying to time the market. So when there's momentum in the market, he starts getting into equity. And, when there is complete pessimism in the market, he tends to exit. And I think we've seen this happening with equity mutual funds on and on and on in every cycle. How do we break this cycle? How do we get, investors into equity mutual funds to really buy into the idea that, investing in equity is a long-term business, and so long as they can, if at all they need to time the market, they could actually use something like a 15 multiple and keep or stay invested so long as the multiples remain there.
I think there are no easy answers to this, and if answer was easy, it would have been done by now. I think it's a question of financial literacy, education, explaining to people, and change of mindsets takes very, very long periods of time. And Subhashji mentioned that 100 index in 1979 has become 22,000, so money has become 220 times. If you had put money in 1979 in a bank FD, it would be 20 or 30 times. So you have done nothing, but simply equities have made your money 10 times more, and that's the power of compounding. So I think the only answer is simply, to my mind, education. But it is not going to be easy. And I think generations will also have to change, because maybe 2 generations back people used to believe only in real estate and gold. My father's generation and even my generation believes largely in bank deposits. Maybe it's the next generation, by the time they come around, capital markets will be more acceptable.
Sure. So I think retail investors actually have a great opportunity to still create wealth for themselves by getting into equity even at this point of time, and even equity mutual funds. Before we open out the session to questions and answers, I thought I'd do a quick, rapid fire round around here, just to get a couple of views. And the first question I would ask is, from a fundamental perspective, what do you think is going to be the style that's going to be in vogue over the next, next year or so? And I'll give you those styles. So I'll start with Nipun. Would it be value over growth, or would it be quality over junk? Would it be defensives over cyclicals? Would it be large cap against small caps? Would it be consensus buys versus contrarian bets?
Well, what we've seen in the Indian markets really is, these are real tons of choices.
Possibly some of our investors out here would take, heart from that and, be able to get some ideas.
If you really see over the last...
So would it be value over growth? Let me ask you that simple question.
I would think it'll really be value over growth.
It'll be value over growth.
Yes.
Quality or, not so good quality, like, a lot of the stocks you mentioned.
No. Always quality, but at the peak of the market...
defensives versus cyclicals, you answered it, cyclicals, right? You already told me that. Large cap versus small cap?
Mid caps?
Mid caps, wow. Okay, large caps versus mid caps. Okay, mid caps, fine. Consensus buys versus a contrarian investing style?
I think contrarian will make a difference.
Contrarian, okay. Prashant?
I think equities over bonds.
Yeah, equities over bonds is bond. That's why you're on this panel. Right, so value versus growth.
I think value, see, these things keep on changing. If Capex...
Yes, so I talked about next 1 year, maybe.
No, if Capex revives, the Capex becomes a growth business. That's why it is confusing, but I would say value over growth.
Yeah, okay, quality versus, this seems to be a simplistic question, but there are a lot of people who say that, this is the time to look at less quality companies. I don't go into the...
I would say the quality premiums in India are extremely high today, and they need to
So
come
you could
down.
go down the quality
Yes,
curve.
yes, I
Fair
think
enough. Defensive versus cyclicals?
I think other than those three sectors, I think I would say, cyclicals, and that
okay.
encompasses a lot of things. Yes.
Large caps versus mid caps, and I'll be careful out here now.
I think this is not so simple because these markets are polarized or valued more along sector lines and less along capitalization lines.
Okay.
So maybe all consumer companies have high P multiples.
So you mean the capitalization would not be material to making that decision?
I would think so, yes.
Right. And consensus buys or buying into momentum or contrarian?
See, I genuinely don't know. Maybe Jyoti will be more, because I do not track what is consensus and what is contrarian. But I feel the same thing, that other than those three sectors, they should do better. That would...
Sure. Jyoti, value versus growth?
I think value will become the growth over the next 2-3 years. So, what is today value will actually be called growth.
Right. Quality versus lower down the quality curve?
Lower down.
Lower down, okay. Defensives versus cyclicals?
Cyclicals.
Cyclicals. So there seems to be a consensus building up on cyclicals, that's good. Large cap versus mid caps?
Mid cap.
Mid caps, okay. And consensus buys versus a contrarian style?
I think consensus buys will do well because all of us have been on consensus on cyclicals.
Okay. So we'll all be in the same direction. Right. Andrew, they ask you value versus growth?
This is over 1 year, right?
Yeah, over 1 year.
All of them will play.
Okay. So
all the scenarios will play out.
All the scenarios.
If I had to pick one, it'll be growth.
Right. You'll pick growth, okay. So here we've got a little bit of a difference. Quality versus... No, I need to complete with you.
No, but all of them will play out. Every scenario will play out.
Okay. So you wouldn't choose. That's what you're trying to say?
No, I'm saying growth will be the main factor. Now,
Yeah,
whether I go down quality or low quality, it doesn't matter.
Okay.
These two need
Defensives
growth.
or cyclicals, it doesn't matter. So you think growth will be the only important thing that will matter. Fair enough. Nilesh? Value versus growth?
Cyclicals, mid cap. This portfolio.
So I heard cyclicals, I heard
value,
mid-cap.
cyclical and mid cap.
Value, cyclicals and
If you
mid-cap.
can create a portfolio which has these three characteristics, I think that overall should do better than the rest of the market.
Sure. Subhash?
I think if you compare this rally, high cap...
So value versus growth?
Growth.
Growth, okay. Quality versus lower down the quality...
Quality.
Quality, okay. Defenses versus cyclicals?
Cyclical.
Cyclicals, okay. Large cap versus mid cap?
Mid cap.
Okay. And consensus buys versus contrarian buys?
Consensus.
So I think more or less the panel seems to be fairly clear on what their investment style would be in terms of, there seems to be a consensus, you're right, in terms of, so I mean, except for Andrew who seemed to plumb for growth, I think most people still seem to think that value is what will play out, but I think Andrew sort of qualified that, saying that, all these will fall under growth. I think
Actually, Andrew said the same thing which I said. The value of today will become the growth over the next 1 year. So that's why he's also pushing
most people
the same.
seem to think that cyclicals would be the better play at this point of time. Mid caps seem to be where people think you'll make more money. And before we close, I just want to ask another quick round of what do you think will be the key drivers of the equity markets in, let me say, the next 6 months. I mean, I'm not even talking about the next 1 year. And you need to just tell me one of them. I just list out what I thought could be possible drivers. Politics, and that's obviously the election outcome. Economic reforms, global factors, RBI's monetary policy, and just to give you an outlier, the monsoons, because everybody talks about El Nino nowadays.
I think economic reforms very clearly will stand out.
Economic reforms. Prashant?
I would go with that same.
With economic reforms.
Yeah, it's going to be re-rating on hopes of economic reforms.
Yeah, economic reforms. Andrew? And I hope you don't say economic reforms and you tell me global factors.
Global factors.
Okay, no, but on a more serious note?
No, I think it's the confidence. Confidence has to come back to India. If you've got confidence, everything else will flow through. So, sorry, confidence is the factor I'm looking for.
Sure. Nilesh?
In May election, June economic reforms and budget, July monsoon. In August, if nothing of this, will reinvent something else.
Yeah, so Nilesh is talking like a true mutual fund manager, like he's spreading his risks.
Yeah, economic reforms, otherwise all are important.
Right. So you heard it from the panel as to what they think is important, and maybe we'll just open out for say 2 questions, or I think okay, maybe 1 question then, yeah, if somebody's got one. So whoever gets the mic first is the lucky guy. Oh, you don't need a mic. So whoever doesn't need a mic is the lucky person, right? No. So you need to give her the mic. Go ahead.
In fact, it confirms with what I wanted to say. I think in the entire deliberations today and towards the end, I see that when you're talking about investment sentiments or behavior, mindsets, etc., I specifically want Mr. Nilesh Shah to answer this, that when 24 became 240, your perspective, is there any gender perspective? Do you see female investors? I don't see in any of your talks that, and would it make a difference? For me, suppose if my mother wanted 100 grams of gold to be given as Dahej, can my daughter say that, no, I want 10,000 shares of this company, and would that be socially accepted? And is that your agenda anywhere? Like, okay, I would be very happy when, as the experts, we start thinking on that note, because ultimately if domestic savings and investment are important, the decision maker, let it be still a female who is going to play important role. Thank you very much.
So I have bought Dahej for my daughter, and I'll be giving my son-in-law my co-shares, and I'll be giving it in physical certificates. I hope my son-in-law will be smart enough to accept that as a Dahej, even though accepting Dahej is not a legal thing. So it's not a Dahej, but I will be handing over my co-shares in physical certificate to my daughters. The second thing is that she will always have that choice, but as a father I have done my job. The second thing is that, on a serious note, whenever I have listened to my wife's advice on investment, that has been far more productive for me than taking my own decisions. And I'll give you a live example. We were going to buy a particular property, and I was on a leave and I couldn't put my application on time, so I got it at 200 rupee higher than what my colleagues purchased. And then my wife's advice was that at the end of 1 year, where do you expect the property price to be? So I said much higher. Then he said, instead of 1, buy 2 properties, you will be happy. So I think that commonsensical thing which comes to ladies is not gifted to men by God. It is scientifically proven. It is scientifically proven that women have better multitasking capabilities. Imagine a man who can do this kind of task: open the door, manage your kids' tuition, also manage the kitchen. I don't think so we can do that. So listen to your wife, or better part in the life. I think in investment that will always work well.
Thanks. So we close out here. You can take those questions offline. So I think, Nilesh, thanks for closing over there. Yeah. So I think the message which Nilesh left at the end of it is, I think universal to. I mean, it is gender neutral, if I may say. That so long as you can keep things simple and don't swing from the fences, as Warren Buffett said, you will make money in this market. Let me thank everybody on this panel for that wonderful discussion. I'm sure you've enjoyed it as much as I've enjoyed conducting it. Thank you.
I would now request Mr. S.K. Mitra and Mrs. Deena Mehta to hand over mementos to our panelists and the moderator.
Photo.
Finally, we thank all of you for being here, and we would like to thank our sponsors, the principal sponsor BSC, our pillar sponsors Reliance Capital and SBI Mutual Fund, our booklet sponsors SMC Global, the co-organizers ICSI, NJ India Invest, BSC's Broker Forum, Sher Khan, Network FP, AIWMI, Ambition Learning Solutions, Skies and Rays Equities, and Asitsi Mehta. We request the guests to deposit their feedback forms. Thank you.